Thank you for choosing this course and for setting aside the time to study it. As someone who's been trading and investing in crypto since 2013, I know that being in this space can be very challenging. Trading and investing is a difficult thing to master, and the addition of cryptocurrency can make it even more so. Those who want to make money in this space not only need to know about chart reading and fundamental analysis, but we also need to have a solid understanding of cybersecurity, market psychology, tokenomics, as well as a keen awareness of how our own emotions can play against us. I created this course as I wanted to pass on the knowledge and skills learned in over 9 years of trading crypto. It wasn't an easy road at first, but after many years of experimenting with different trading and investing strategies through multiple bull and bear markets, I was able to become a consistently profitable trader and investor. The crypto market is very volatile, and it contains its own unique risks which can make things difficult for crypto traders and investors. I'd like to share my knowledge, skills, and highly profitable trading and investing strategies with you so that your journey towards financial freedom can be as stress-free as possible. By gaining the knowledge and skills contained in this course, you'll be positioned to take full advantage of this amazing crypto revolution that we're so fortunate to be a part of right now. In part 1 of this course, you'll gain a good understanding of how blockchain technology works. You learn about the history of crypto and the different types of cryptocurrencies, as well as how to secure your wallets effectively using techniques such as Shamir Secret Sharing for wallet backups. You learn how to set up a secure laptop for your crypto trading, which will help to protect you from hackers and thieves, and you learn how to quickly and easily buy and sell crypto on Binance. In part 2, you learn about the skills and techniques needed to become a consistently profitable trader, such as technical analysis, risk management, and emotional management. You learn how to use TradingView on your computer and your phone, and you learn about chart setups, drawings and alerts, as well as hidden features that can level up your trading. Then, we'll delve deep into technical analysis, where you learn about the most common candlestick patterns that occur in crypto. We won't be looking at boring theoretical patterns. Instead, we'll be looking at real patterns that occurred in a variety of cryptos over the years. I'll share with you my Momentalt strategy that was highly profitable in the bull market of 2021. And you'll learn how to build your own custom trading and investing strategies that are a perfect fit for your lifestyle. In part 3 of this course, you'll gain the skills and insights of an informed and profitable investor. You learn about the most important aspects of fundamental analysis in crypto as we cover how tokenomics and supply and demand incentives can make the difference between profitable and unprofitable investments. You learn how you can survive bear markets in the Bear Market Survival Guide, as well as how to identify and invest in amazing crypto opportunities so that you'll be well positioned when the market shifts to the upside. You'll gain the skills needed to thrive in bull markets as you learn how to create a detailed take-profit plan with the Excel calculator included in this course. In the 4th and final part of this course, you'll learn about the core principles of DeFi and the Metaverse and how these will change our world. You learn about crypto staking, advanced MetaMask features, as well as how to use decentralized exchanges such as Uniswap and PancakeSwap. By the end of this 4-part course, you will truly have what it takes to be an informed and consistently profitable trader and investor who will be ready to identify and capitalize on the amazing investment opportunities available to us in crypto right now. Firstly, I'd like to state that I am not a financial advisor and I do not provide financial advice. Please pause the video and read this disclaimer before proceeding with the course. So this lesson is just a little backstory into how I became a crypto trader and investor, and some of the mistakes I made when I started out that almost cost me all of my crypto. Now, I know it seems kind of weird that this is the first lesson. I mean, after all, you wouldn't be looking at a trading and investing course if you wanted to keep your day job. But the reason I put it at the beginning of the course is because I want to talk about the right way and the wrong way to start trading and investing in crypto. So let's go back in time a little. The year's 2010 and I just graduated from uni with a degree in graphic design. Even though I just graduated, I was feeling pretty miserable as my job prospects were pretty bad at the time due in part to the lingering effects of the 2008 financial crisis and the recession that followed. So I was sat in a pub with a good friend of mine, and he worked as a coder at a hedge fund in London, and he was doing really well for himself. He was a few years older than me. But even though he was making really good money, he didn't enjoy his job, as he basically worked for a bank, and banks were an institution that he was starting to despise due to their role in the financial crisis a few years earlier. So this friend of mine told me that he found something really interesting that might just change everything about the way that we look at money. Something that could free us from the evil banks. Now, what this thing was digital money. And he said it was peer-to-peer and decentralized. And because of this, we wouldn't need to depend on the banks in order to make transactions. Now, his eyes were wide with excitement. And he said that I must look into it, because he thought that it was going to change the world. He thought that it would ignite a financial revolution. The problem was that at the time, this sounded kind of weird to me, okay? I laughed at it and I said, yeah, I'd look into it later. But I didn't look into it. So now we go forward 3 years, and it's the spring of 2013. And I realized my mistake when I was reminded about this little thing called Bitcoin. But it wasn't so little anymore. So this was around the time of the Cyprus banking crisis, and Bitcoin was in the news as an unlikely savior for many Cypriots, because many Cypriots were turning to Bitcoin as a way to protect themselves against what was going on. And my mum saw the news and she told me about Bitcoin, and I was like, how do you know about Bitcoin? I thought this was a really nerdy thing. But I thought I better look into it if my mum knows about Bitcoin. So at the time, I was working in a really boring, low-paid office job at the time, in a field that was completely unrelated to my degree. And this just set off a spark in me, this whole Cyprus thing that was going on, remembering about my friend telling me about Bitcoin all those years ago. I knew that I just had to get into it. Okay, I knew I couldn't miss this opportunity again. So I sold most of my stuff, and I combined the money from selling my stuff with the small amount of savings I had to buy as much Bitcoin as I could possibly afford. Okay. And then a few months later, my small investment turned into a life-changing amount, truly life-changing amount, an amount I never thought I would have at that age. Okay. And because of that, I thought I was a trading genius. I could not have been more wrong about that. Okay. Now, this brings me on to the first mistake I made. So the time now is November 2013. The Bitcoin just kept going up and up and up and up and up. And at the time, crypto YouTube wasn't really a thing. I mean, there were a few YouTubers on talking about crypto. Well, there wasn't really crypto, it was just Bitcoin back then. There was a small number of them, but it was such a niche thing, you didn't really hear much about it. But despite this, there was still loud voices on YouTube, on Reddit, who said that Bitcoin would never stop going up. And being the naive investor that I was at the time, I listened to them, okay? And my aspirations grew bigger than my crypto portfolio. So it's now December 2013, and the market had already peaked, but I didn't know that yet, okay? And in the space of a few days, Bitcoin fell 40%, and I was sickened to see that my portfolio was almost cut in half. But the mantra at the time, and the mantra even now, is to hodl. So I hodled like a good Bitcoiner, okay? Because that is what Bitcoiners do, they hodl. And, that seemed to pay off. Bitcoin rose up to $989, okay? This was the December 10th. I remember it exactly. And I thought I was in the clear. I thought that Bitcoin would keep going up. And then over a week later, Bitcoin went even lower. Okay. And my portfolio was now down over 50%. So I knew that I had this friend who traded Forex. So I reached out to him and I asked him for advice, as I knew nothing about trading or investing at the time. And he told me that trading is the way to go. You do not want to invest in Bitcoin, he said, because Bitcoin's too new. It's too new to be a reliable investment. It's not like Apple stock or Amazon stock. So I took his advice and I sold my stash because, I wanted to at least keep something. Okay. And I still had a decent amount, even though my portfolio was cut in half. And at the time I was having not a great time at work. And I had this money just sitting there in Bitstamp, which was the account I was using at the time, the crypto account, the Bitcoin exchange. So I decided to quit my job because, I didn't like the job and I had this money I made from trading and I felt like I was a genius trader. I had a natural talent. So, I'd use the profits and become a full-time Bitcoin trader. This was the second mistake I made, and this mistake was almost fatal to my crypto. Okay. So, despite the losses, I still had more money than I ever dreamed I'd have at such a young age. But my problem was that I confused my early luck trading Bitcoin with skill. Okay. I thought I had a natural talent for trading, and I saw trading as the perfect way to escape the rat race. So I spent the next year trying and failing to make a living from trading Bitcoin full time. I bought all the trading books. I watched all the YouTube videos. I bought trading courses. The problem was back in 2013 and 2014, all of these resources were tailored mostly towards forex and stocks. So the education that I was getting wasn't a good fit for crypto. And as time went on, as the months went on, my portfolio kept getting smaller and smaller and smaller because Bitcoin was in a bear market. I didn't really know what bull and bear markets were until, we were midway through. And my portfolio was getting smaller, but I still had to keep paying bills every month. I still had to keep selling Bitcoin. And I knew that if I kept going like this, I would burn through my portfolio. I would burn through my Bitcoin. And I would burn through this amazing opportunity that I had. So reluctantly, I got another job. And then from there on, it took 2 more years of failures before I built up the skills and experience needed to finally be able to make a full-time living from trading crypto. And during those 2 years, okay, when I was working, every month I'd buy a little bit more Bitcoin each and every month, okay? And then 2 years later, right? So this is around 2016, 2015, 2016. This was when I started trading Bitcoin full time, and I've been trading crypto ever since. Okay. So before you quit your day job, trade on your days off, build up a track record of profitability before you decide to trade full time. You should also have at least 1 year's worth of living expenses saved up that is separate to your crypto portfolio, so you don't have to dip into your trading account to pay your bills. Now, in this course, we're going to look at the many pitfalls in crypto, and we're going to look at how you can avoid them. Now, these pitfalls are not just related to trading and investing, they're also related to the management of your crypto. You need to learn how to avoid these pitfalls before you can become a consistently profitable trader and investor. Because crypto is still quite new, and even though it's much safer now than it was a few years ago, it's still the Wild West, and there's still many scams that you need to avoid. So we're going to be covering aspects of crypto security that I've never seen anybody else talk about in this crypto space. And then you'll learn how to fit crypto into your lifestyle and how to craft the lifestyle that you want. You'll learn how you can become a trader and an active investor so that you can keep your profits and turn those paper gains into real gains that you can either use to make positive changes in your life or that you can use to buy back even more crypto. Now, this is all about being financially independent. It's about being a financial sovereign, which is something that's becoming increasingly important in this world that we're in right now, which is becoming increasingly uncertain. Okay, there's lots of opportunities. There's many opportunities available to us, but there's also a degree of uncertainty. So it's important to become financially independent during this time. So thank you so much again for taking the time to look at this course. And I really hope you enjoy the rest of it. Thank you. Part 1. Introduction to Cryptocurrency Trading and Investing. There are many cryptocurrencies built for a constantly growing amount of use cases. The crypto communities behind these projects all have differing priorities, but most of them adhere to these 4 key tenets. Cryptocurrencies are cryptographically secured. Encryption and validation techniques allow people to send crypto safely and make it difficult for bad actors to make fraudulent transactions. Cryptocurrencies are immutable. The blockchain is the record of all the transactions made on the network. The most important aspect of a cryptocurrency is that transactions cannot be reversed. Once a transaction has been made, it should be immutable. It should remain forever unaltered. Cryptocurrencies are decentralized. Almost all true cryptocurrencies have some degree of decentralization. Their networks are distributed, and transaction validation is a community effort. Decentralization is needed in crypto as it makes networks more robust and resistant to attacks, censorship, or takedown attempts. In order for attackers to damage a network, they would have to overpower the majority of the crypto community. Decentralization makes this prohibitively expensive. Cryptocurrencies are open source. Unlike software that comes bundled with most computers and smartphones, the source code of most cryptocurrencies is open to anybody to review and improve. In science, the peer review process makes ideas transparent and open to review, critique, and improvement. This helps to prevent bad science. Open source software is just like this, and because of this process, it helps to prevent bad code from being in crypto. Not all cryptocurrencies are created equally. The implementation of these key features determines how trustworthy a cryptocurrency is. To understand how blockchain works, we're going to look at a transaction between Alice and Bob. Alice has done well with her investments and wants to treat herself to a brand new Tesla. Bob wants to accumulate more Bitcoin, so is happy to sell his Tesla to Alice for 1 BTC. Blockchain transactions are kept in a ledger that essentially shows deposits and withdrawals of funds to and from addresses. Here we can see the transaction between Alice and Bob. When Alice sends 1 Bitcoin to Bob, that Bitcoin is deducted from her address and is added to Bob's address. Blockchain transactions are added to blocks that store many transactions. Each block contains 4 key pieces of information. A block number. This is the total number of blocks since the blockchain's existence. The current block number is referred to as a block height. Some data. In this block, we can see that the data stored is Alice and Bob's transaction. Blocks also contain a hash and the hash of the previous block. A hash is like a digital fingerprint. Each block has its own unique hash number that is cryptographically generated in the process of block creation. Here we can see the blocks in sequential order. Each block has a unique hash code. In addition to the block's own hash, each block contains the hash of the previous block. This acts as an anti-tampering measure. If the hash of a block is tampered with, it will make the hashes of all subsequent blocks invalid. Each block contains a number of transaction records. The complete set of records is mirrored across all the nodes on the network. Any user who wishes to download the full blockchain can do so, whether they're someone who's simply using a wallet or someone who maintains the network by running a full node. Every user has access to the full record of transactions in the blockchain if they wish. As this contains all the records of every transaction in history, a user would need quite a lot of space to download the whole blockchain. In 2022, Bitcoin's blockchain is around 400 gigabytes in size, and Ethereum's is over 900 gigabytes. This is quite a large amount of data, though it's still small enough for anybody to be able to download with consumer-priced hardware and a bit of patience. The distributed nature of blockchains like Bitcoin and Ethereum is what makes them so resistant to attacks and takedown attempts, as any potential attacker would have to fool over half of the network's participants in order to make just one fraudulent transaction. In order to see where crypto is going, it's useful to look at where it came from. Whilst Bitcoin has only been around for 13 years, there were many advancements in cryptography and data processing, as well as new ideas about the nature of money that led to Bitcoin's creation. In the 80s and 90s, a vibrant community of cypherpunks and forward-thinking technologists worked on projects that would later become a foundational part of cryptocurrency. Despite many failures, the lessons learned from these endeavors would pave the way for Bitcoin and blockchain technology. DigiCash was an early attempt at a cryptocurrency. The project began in 1989 and was created by David Chaum, a privacy advocate who believed that the financial system was becoming increasingly threatening to privacy. While studying at UC Berkeley, Chaum invented blind signatures, a form of public key cryptography that allowed users to sign transactions without revealing their identity. Throughout the 1990s, DigiCash enabled its users to make electronic payments without being traced by banks or governments. As DigiCash ran exclusively on the company's servers, if the company failed, then so would the project. Unfortunately, that is exactly what happened when DigiCash Incorporated went bankrupt, due in large part to the cost of having to validate every transaction by themselves. Hashcash was the first proof-of-work system proposed by Adam Back in 1997. Its aims were to limit email spam, which was becoming a big problem back then as more and more people were coming online. Hashcash was designed to impose a cost on email in the same way that there is a cost to sending a letter in the post. In order to send an email, the user had to complete computational tasks and prove that the work had been completed by adding a Hashcash stamp to the email header. The idea was that spammers wouldn't be able to send emails to Hashcash users as it would be prohibitively expensive to do so. B-Money was an early proposal for a cryptocurrency created by Wei Dai. In 1998, Dai published a paper called B-Money, an anonymous distributed electronic cash system. He put forward a number of key concepts that would later become essential components of today's cryptocurrencies. B-Money proposed the use of the Hashcash proof-of-work system as a method for both validating transactions and minting new units of currency, which could be rewarded to those who expend resources whilst running the network. It was intended that the transactions would be distributed through broadcast of a collective ledger, and that transaction validation would be done by the community of users as opposed to a central entity. This was seen as essential in making the network decentralized and resistant to takedown attempts or the failure of a single entity. Liberty Reserve was a centralized digital currency service founded in 2006. Users would fund their Liberty Reserve accounts using bank deposits or credit cards. Those funds would then be converted to Liberty dollars, which could be sent to a recipient who could convert those funds back into US dollars. Users could simply sign up with a name and email address. There was no identity verification. After a multi-year investigation across 17 countries, the company was ultimately shut down in 2013, and its founders were charged and arrested for money laundering, fraud, and other offenses. Although Liberty Reserve was a payment processor whose digital currency lacked essential aspects of cryptocurrencies, their payment system had some interesting features that are present in cryptocurrencies today, such as the concept of dollar-pegged digital currencies, which we now call stablecoins. In 2008, a personal group named Satoshi Nakamoto published an 8-page white paper that outlined the workings of a peer-to-peer electronic cash system. The proposed system included key elements from earlier cryptocurrency attempts, such as peer-to-peer networks and a proof-of-work system similar to the Hashcash system, which would make it prohibitively expensive for one to make fraudulent transactions on the network. Most importantly, all of this would be done without the need for a central authority, as the proposed network would be distributed, which would make it resistant to censorship or takedown attempts by governments. On January 3, 2009, Bitcoin was born with the creation of the Genesis block. This digital container immortalized the first transactions on the Bitcoin network, which were most likely test transactions made by Satoshi Nakamoto. In the block, Nakamoto encoded a message, The Times, 3rd January 2009, Chancellor on brink of second bailout for the banks. Many see this cryptic message, which references the newspaper headline of the day, as a mission statement about Bitcoin's purpose as an alternative to the flawed banking system. One of the first participants in the Bitcoin network was Hal Finney, an avid member of the cypherpunk movement who helped develop PGP email encryption protocols. In the 2000s, he helped create an early proof-of-work system which inspired aspects of Bitcoin's design. On January 12, 2009, just 9 days after the creation of Bitcoin's Genesis block, HAL received 50 bitcoins from Satoshi Nakamoto. This is the first known Bitcoin transaction sent from one person to another. Up until 2010, Bitcoin didn't really have a universally accepted price, as the only people who used it were hobbyists, and there weren't any public exchanges where people could exchange their government money for Bitcoin. Laszlo Hanieks was one of the first people to give value to Bitcoin when he bought 2 pizzas worth $40 from his local Papa John's for 10,000 Bitcoins. At the time, this would value each Bitcoin at 0.004 cents. Today, those 10,000 Bitcoins would be worth over $400 million. Many laugh at people like Laszlo, who in the early days of crypto spent huge amounts of something as valuable and scarce as Bitcoin on something so seemingly trivial. If it wasn't for people like Laszlo, Bitcoin may not have had any value at all today. Those early transactions are what helped people to realize that there could be a viable alternative to government currency. Prior to 2010, the only way to get Bitcoin was to either mine it yourself or acquire it directly from someone online or in real life. People would send money via PayPal to forum members or arrange meetups in person to exchange cash for Bitcoin. These informal person-to-person exchanges exposed people to great risks. This began to change with the rise of escrow services catering to people who wanted to trade Bitcoin, where each party would agree to the terms of the exchange. The escrow service would serve as an arbiter, ensuring that each party traded fairly. This was still a very slow and clunky process, which all changed when order book-based exchanges appeared in late 2010. These exchanges operated in a way that's similar to stock exchanges, in that there was an order book with bids and asks which enabled buyers and sellers to quickly trade with one another, which created a fluctuating exchange rate. One of the first exchanges was Mt. Gox, created by Jed McCaleb. Originally a trading card exchange, Mt. Gox quickly changed to a Bitcoin exchange to serve what was at the time an unmet need. At its peak, the exchange accounted for 70% of Bitcoin's transactional volume, though this wasn't without issues, as the exchange suffered from security and stability issues since its inception. The exchange was later sold to Mark Harpelez in 2011. In 2011, the Silk Road online marketplace was launched. The website operated on the Onion network, which meant that it could conceal the identity of those who visited the site. Users could browse the site anonymously and buy and sell anything they wanted using Bitcoin. Due to the anonymous nature of the website, it became known as the go-to place to buy items of questionable legality online. At its peak, the Silk Road accounted for 5% of Bitcoin's daily transactional volume. 2011 was the start of Bitcoin's first bull market. It started the year at 29 cents and rose to a peak of $31.90 in May, a rise of over 11,000%. It then fell 93% in the subsequent months, making 2011 one of Bitcoin's most volatile years. Up until this point, Bitcoin had been the only cryptocurrency in existence. That was until Namecoin came on the scene and became the first altcoin. Forked from Bitcoin's codebase, it became the first of many cryptocurrency forks and was designed to store domain name records in a decentralized way on the blockchain. Namecoin showed the world that there could be an alternative use case for blockchain technology other than money. On October 2, 2013, Silk Road, the online marketplace, was seized and shut down by the FBI. Its founder, Ross Ulbricht, was arrested on money laundering, drug trafficking, and computer hacking offenses. At the time, Silk Road accounted for just 5% of Bitcoin's daily volume, though people thought it accounted for much more, and that Bitcoin would not survive without the Silk Road as a use case. Due to this fear and uncertainty, the price of Bitcoin dropped 33% in a single day. During the 2012 banking crisis in Cyprus, economic fears drove people towards an unlikely safe haven. The limits on bank withdrawals on the island nation made people aware of the control that banks can exert over our money and saw Bitcoin as a viable alternative to the banking system for storing one's wealth. This increased demand helped push Bitcoin up to $268 in April 2013. The price then fell 80% shortly afterwards, before going on to make a new high of $1,177 in November. During this time, Mt. Gox users began reporting significant delays with withdrawals, with some having to wait months before receiving their Bitcoin. At this time, the Japan-based exchange was the biggest by far, accounting for over 70% of Bitcoin's volume. On 24 February 2014, Mt. Gox halted all trading shortly after the website went offline. A leaked internal crisis management document showed that the company was insolvent due to the loss of 744,408 bitcoins in a series of thefts that went undetected for years. Angry customers flew to Japan and protested outside the company's offices, demanding a return of their funds. Lawsuits were filed against the company, and a fierce legal battle ensued that continues to this day. A new blockchain called Ethereum launched on July 30th, 2015. Ethereum introduced the concept of smart contracts to cryptocurrency, making it possible for decentralized apps to run on the blockchain. This development would greatly expand the capabilities of blockchain technology, allowing for a vast range of peer-to-peer applications. In 2016, a decentralized autonomous organization launched on Ethereum. The DAO was created by a company called Slockit.io, who envisioned a sharing economy with smart locks that would be connected to Ethereum's blockchain. In this world, users could send Ethereum to smart contracts, which would unlock real-world assets for rental, such as bicycles and hotel rooms. The DAO was intended to give the users of this platform full democratic control of the project's direction. Shortly after raising $150 million worth of Ether in a wildly successful crowdfunding campaign, an attacker drained the smart contract after finding an exploit in the code. This sent shockwaves through the community, as this had a big impact on Ethereum, which was only a year old. A hard fork was proposed that would in effect cancel the theft. This was very controversial, as cryptocurrencies are meant to be immutable. Transactions, however damaging, are meant to be final. In the end, the community voted for the hard fork, which cancelled the theft and in effect returned the stolen funds to the victims. This split the community in two and gave birth to Ethereum Classic, which was the unaltered original blockchain. In 2017, there was a huge altcoin bull market that was primarily led by Ethereum and Ethereum-based tokens. Crypto projects now found a way to raise capital that sidestepped traditional forms of venture capital, which was only open to wealthy accredited investors. The initial coin offering, or ICO, was born, and it enabled anyone to invest in a crypto startup simply by participating in a crowd sale and sending Ether to the project's address. This democratized venture capital, which was previously only open to a small elite of wealthy Silicon Valley venture capitalists. Whilst this made startup investing more fair and democratic, the complete lack of regulation attracted a fair share of scammers who found no shortage of investors to exploit. 2017 was also the year that bespoke art collectibles, known as non-fungible tokens or NFTs, became the most popular tokens on the Ethereum network. Out of all the NFTs, CryptoKitties were the most sought after by far. During the peak of this craze, many of these collectible cats were sold for hundreds of thousands of dollars. Towards the end of 2017, CryptoKitties became so popular that it accounted for a quarter of Ethereum's network traffic, which led to growing concerns that the project would make the network unusable. Some other interesting projects launched this year that would widen the scope of Ethereum's utility. Maker, an algorithmic stablecoin protocol, and EtherDelta, a decentralized exchange, were some of the key projects that marked the start of decentralized finance. 2017 was a big year for Bitcoin too. Despite the growing demand for altcoins, there was no shortage of Bitcoin buyers. By the end of the year, Bitcoin rose to 19.6k, an almost 2,000% move in a year. Institutions signaled an interest in Bitcoin by launching the CME futures contract on December 17th, which opened the door to Bitcoin-based derivatives and institutional investment products. After peaking in January 2018, the 2-year-long crypto bull market came to an end. In the space of a few weeks, hundreds of billions of dollars were wiped off the total cryptocurrency market cap. Despite the downturn, the pace of crypto innovation continued. Now that the hype had died down, the focus was on building the infrastructure needed for the next phase of crypto. One piece of that infrastructure was Chainlink, an Oracle network that would make it possible for smart contracts to connect to external data sources, such as price feeds from other cryptos, national currencies, and even the stock market. This began an era of interoperability that paved the way for a wide range of decentralized financial products, such as synthetic assets and smart contracts that interacted with real-world data. In the crypto community, the summer of 2020 became known as DeFi summer. It all started when Compound rewarded users for lending and borrowing with comp tokens. Other DeFi protocols followed suit, and this started the practice of yield farming, where users would lend and borrow different tokens in an effort to maximize their yields. The price of many DeFi tokens rose massively during this time due to high demand from yield farmers. In 2021, the total crypto market broke the $1 trillion barrier for the first time. This market was quite different from previous ones due to the addition of institutional demand for crypto. Previous bull markets were mostly driven by individual retail buyers, but this time, large crypto-focused funds such as Purpose ETF bought large amounts of Bitcoin. The total crypto market cap peaked at a high of just over 3 trillion, and Bitcoin peaked at just under 69k on November the 8th. 2021 was the year that NFTs gained widespread mainstream acceptance, as digital art was now seen as just as valuable and valid as traditional art. NFT marketplaces such as OpenSea and Rarible provided a platform for content creators to showcase their work. Although many saw NFTs as nothing more than overpriced JPEGs, there was much more to it than that. The NFT that accompanied these JPEGs served as a certificate of ownership that was highly prized by owners. Each NFT was fungible, unique, and limited in number. Whilst a JPEG could be copied an infinite number of times, the NFT was finite and could only be transferred from one party to another by the NFT's owner. It was a record-setting year for the art market, as a piece by Beeple titled The First 5,000 Days was sold at Christie's for $69 million. 2021 was the year that crypto entered the gaming world. Popular play-to-earn games like Axie Infinity, The Sandbox, and DeFi Kingdoms rewarded players who completed quests with crypto. The Metaverse, an idea that was once the stuff of fiction, started to become reality as people started spending more and more time in virtual spaces like Decentraland, the bustling VR world with a booming virtual real estate market, all priced in Mana, the in-game currency. Though the Metaverse is still in its infancy, technologies such as crypto, NFTs, and VR are combining to create some truly compelling experiences and spaces that people will want to spend increasing amounts of time in. The three main categories of crypto are blockchains, tokens, and stablecoins. Blockchains are cryptographically secured, decentralized digital ledgers like Bitcoin, Ethereum, and Avalanche. They are the base layer of a crypto ecosystem. Blockchains like Ethereum and Avalanche are what's known as Turing complete. What this means is that they can support advanced functions, such as smart contracts, which allows these blockchains to host tokens with different use cases. Popular tokens like Chainlink and Synthetics are on multiple blockchains. However, not all tokens are on all blockchains. As you can see in the graphic, Decentraland is on Ethereum but not on Avalanche C-Chain. You could think of it like a video game that's available on PlayStation and Xbox but not on PC. Stablecoins are just another type of token. What makes them special is that they're pegged to national currencies. This means that one stablecoin is of equal value to one unit of a national currency, most often the dollar. Unlike cryptocurrencies like Bitcoin and Ethereum, stablecoins don't have a fluctuating price. They are designed to always be worth $1, and they rarely fluctuate by more than a cent away from this price. This is useful for traders and investors who want to essentially lock in their crypto gains in a stable currency like the dollar while still remaining in the crypto ecosystem. Stablecoins can be sent peer-to-peer, just like any other cryptocurrency, and they can be held privately in a user's cryptocurrency wallet. There are two main types of stablecoins. There are dollar-backed ones like USDC and TrueUSD that are backed by dollars in an audited bank account. And there are algorithmic stablecoins like DAI, which is backed by collateral in the form of crypto assets, such as Ethereum and other crypto assets. The asset units in this algorithmically controlled basket go up and down depending on the price of the assets. Here's a fun fact. The DAI stablecoin is named after Wei Dai, the cypherpunk mentioned in the History of Crypto section. Wei Dai's ideas were so influential to cryptocurrency that the smallest unit of ether, which is called Gwei, is inspired by his first name. You may have heard the terms Layer 1 and Layer 2s being used, but what do these terms mean? Well, a Layer 1 is basically another word for a blockchain. Bitcoin, Ethereum and Binance Smart Chain are Layer 1s. Tokens such as Chainlink or USDC are not Layer 1s. Layer 2s are cryptocurrencies that work as a scaling solution to early proof-of-work Layer 1 blockchains like Bitcoin and Ethereum. These blockchains have speed constraints. Currently, Bitcoin can process just under 5 transactions per second, whilst Ethereum can process a maximum of 15. Layer 2 networks are scaling solutions that dramatically increase the total transactions per second of these blockchains. Users of these Layer 2s get to experience much faster transaction speeds as well as cheaper fees. Blockchains like Binance Smart Chain, Avalanche and Solana can natively handle high transaction speeds. Because of this, there aren't any Layer 2s running on these blockchains. EVM chains are blockchains that all share Ethereum's smart contract language, which is called Solidity, whilst operating on completely separate blockchains. A good way to think about this is how you can have people speaking the same language whilst living in completely different countries. Due to their shared root language, EVM chains can share smart contract information through the use of bridges where data can be moved from one blockchain to the other. Due to the success of this language and the open source nature of cryptocurrencies that allows people to freely copy and improve upon software, other crypto projects decided to create their own blockchains using Solidity as the programming language. Doing this made the process of blockchain creation easier, but most importantly, it allows different blockchains to share the same features. Multiple EVM chains can share addresses, which allows coins on different blockchains to be sent to the same address. To illustrate how this works, let's imagine a house called EVM House. It's at address 0x3R7. Each room in this house is a separate blockchain. There's an Ethereum room, there's a Binance chain room, there's a Polygon room, and there's a Phantom room. Whoever owns this house has access to all the rooms as the doors are all unlocked. If Ethereum is sent to this address, then it will only go to the Ethereum room. If Phantom is sent to this address, then it will only go to the Phantom room, and so on. As I mentioned before, each room is a separate blockchain. They speak the same language and can share information, but they don't open each other's mail. This house is like your wallet. If you have an Ethereum address on a compatible wallet such as MetaMask, then any EVM coin that is sent to your address will be accessible to you so long as you have the key to that wallet. NFT stands for non-fungible token. It's essentially a contract or certificate of ownership that grants the owner certain rights over the item that the NFT represents. Digital art and assets are the most popular use case for NFTs. NFTs can also be used for physical things such as houses or land. Future use cases could include stock certificates or voting rights. To understand what NFTs are, we need to look at the word fungible and look at what the difference is between a fungible token and a non-fungible token. Money is a fungible token. What that means is that if you lend someone a £10 note, they can legally give you back a different £10 note, or £10 in coins, or even in pennies, without the borrower breaking the terms of your loan. However, if you lent someone an artwork and that person gave you back a different artwork, then there would be a problem, as you would want the exact same artwork back because art is non-fungible and you would legally be entitled to the same piece of art that was loaned. Money is fungible. One £10 note is the same as any other. Art, however, is non-fungible. A copy of the Mona Lisa is not the same as the Mona Lisa. Unlike traditional investing, crypto investing exposes us to a unique set of significant risks. If someone hacks into your bank or brokerage account or steals your credit card, any theft that occurs can often be remedied by a friendly customer service agent. If you lose your bank card or forget your PIN, all it takes is a phone call and you'll be able to access your funds in minutes. In crypto, this is not the case. Whilst crypto has become a lot more user-friendly than it used to be, being your own bank is hard. In this module, we will cover some essential security and admin practices that you can apply, which will help to protect you from hacks, scammers, and accidental loss of your precious crypto. How to avoid getting wrecked. The word rekt is often used in popular crypto memes. For those who don't know the word, it was coined on June 6, 2011 by an Urban Dictionary user who submitted an entry for the term rekt, defining it as text message slang for the term wrecked. Something that's caused many traders to get wrecked is exchanges, not just due to an individual account being compromised, but through whole exchanges being hacked. You really have no way to prevent this. You can mitigate the risk, but there's no way to prevent it completely, as you never know which exchange is going to get hacked next. So in this picture, for anyone who doesn't know, it's a headline about an exchange called Mt. Gox, which up until early 2014 was the biggest Bitcoin exchange by volume. It accounted for around 90% of total exchange volume at the time. It was basically run by this real amateur who bought the exchange from a guy called Jed McCaleb, who initially meant for Mt. Gox to be a trading card exchange. That's where the name Mt. Gox comes from. It means Magic the Gathering Online Exchange. This trading card website was hastily turned into a fully fledged Bitcoin exchange to take advantage of the niche that was at the time unfulfilled. The exchange's security was so lax that it was basically non-existent. The wallet where they were storing all the customers' Bitcoins in wasn't encrypted, and the site was riddled with security holes. It turned out that over the course of 2 years, over 740,000 Bitcoins were stolen through hacks, which the exchange managed to conceal because everyone didn't want to withdraw their funds at the same time. A lot of people lost money, and this guy in the picture holding up the sign flew all the way from the UK all the way over to Japan, demanding the return of his Bitcoins from this latte drinking oaf who, as you can see, really doesn't care. So yeah, basically, you really want to avoid this kind of situation as much as possible. Now we're going to talk about our own exchange hack scenario. It's a fictional scenario I've created called The Hackening. In it, we have these 4 traders and investors, and at the start of this scenario, they all have the same balances. But at the end, their balances differ, and some of them differ quite a lot. So here we have our 4 traders and investors, and they all have £10,000 worth of crypto. Now they all stored the crypto in their portfolios in different ways. The 3 main places they stored their crypto are hardware wallets, app wallets, and exchanges. And these methods of storage all have varying levels of security. So if we look at Akin, he's basically got 60% of his portfolio in a fairly safe location, as the keys are in his possession. If you store crypto on an exchange, then you basically don't own that crypto anymore. This is especially true with unregulated exchanges. You've basically given it to the exchange to hold on your behalf, and it essentially belongs to them. They give you an IOU, but if anything happens, if they're unable to return those funds, then you're out of luck. So Akin has £1,500 worth of crypto stored in exchange A, £1,000 stored in exchange B, £1,000 stored in exchange C, and £500 stored in exchange D. Then we have Ben, who is what is called a hodler in the crypto community. He's not worried about trading, he just holds his crypto and he has £10,000 worth of it stored in his hardware wallet. Then we have Claire, who's taken a bit of a balanced approach. She has 70% of her crypto in her possession, with the majority of it in a hardware wallet, and she has £750 of crypto equally distributed amongst 4 exchanges. Then we have Darren. Darren really likes Exchange A. He's a huge fan of it. He loves Exchange A so much that he's put his whole £10,000 crypto portfolio into the exchange. Then this happens. A devastating theft of 190,000 bitcoins from Exchange A. The alleged perpetrator is this guy here, an individual who goes by the name Totally Rekt. So this hacker stole crypto from the exchange and he has no intention of giving it back. Industry pundits believe that if the exchange is not able to retrieve the crypto, then bankruptcy will be inevitable. So where does this leave our traders and investors? Well, Akin is not having a very good day. He has the majority of his trading balance in Exchange A. 15% or £1,500 is now lost, and he now has £8,500 left. It's going to take him a while to earn that back, and it's going to be difficult, but if he saves, he may be able to recover from the loss. Then we have Ben. As Ben is a hodler who has no crypto in any exchanges, he hasn't lost any crypto from the hack, so he's safe in that respect. Although he hasn't lost crypto, the hack sent shockwaves through the market, so the value of the crypto he has had a slight decline. But at least it's temporary, unlike actually having the crypto stolen. Claire's lost 7.5%, but she's really not done too badly. She's actually been very smart with the way she's allocated her funds to the exchanges, as they're all equally distributed amongst the 4 exchanges. She's lost 7.5%, which isn't nice, but she can make that back. And as she has funds in other exchanges, she may actually be able to profit from the short-term volatility caused by the hack. Then we have Darren. Well, Darren liked Exchange A so much because it was fast, it was slick, and it had a really nice interface. He liked it so much that he put his entire crypto portfolio in there, and now he's literally lost everything. Darren is totally wrecked. He suffered a complete loss of funds, which has basically put him out of the investment game. When it comes to trading and investing, it's a good idea to segregate your funds. You want to have a portion that you basically hold on to as a long-term investment, and another portion that you use for portfolio growth. The way that Claire has structured her portfolio is a fairly good way to get started trading crypto. You want to have 70 to 80% as a long-term investment when you first start, and then gradually you can increase the amount for active investing and trading. The crucial thing is to equally and evenly distribute your trading balance across multiple exchanges so that you can significantly reduce the risk of total loss of funds. In this lesson, we're going to cover some important security terms that refer to essential aspects of crypto security. The terms we will learn about are public key / crypto address, private key / recovery phrase or backup seed, and checksums and file hashes. A public key is like your home or email address. It's something you give to people in order to receive something. In crypto, your public key is displayed as your crypto address in the form of letters and numbers or a QR code that can be quickly scanned with phones. When you want to receive crypto, you give this address to a person or a crypto exchange. Be aware that anyone who has this will be able to see all of your previous and subsequent transactions that you make, so be sure you share it with care. A private key is similar to your house key or email password. Possession of a private key enables you to access your property. When you own crypto, what you really own is the private key to a set of crypto addresses, as that is what enables you to access coins that are stored on the blockchain. When you send a transaction, your wallet signs it with a private key. Private keys are long strings of characters that look similar to the picture displayed on the right. As this is difficult for humans to write down or remember, crypto wallets translate it into a 12 or 24 dictionary word mnemonic that's easy for us to write down and store safely. Dictionary words are much better than random characters, as there's only one way to correctly spell them, which minimizes the possibility of mistakes during backup and recovery. This 24-word mnemonic is referred to as a private phrase, but it's also called a backup seed or seed phrase. Your recovery phrase is never shared, as anyone who has it will have full access to your crypto. If someone asks you for your recovery phrase, they are a scammer who wants to steal your crypto and should be treated as such. A checksum is a means of verifying if a downloaded file is genuine and hasn't been tampered with. Many wallet providers post checksums on their websites so that users can check the authenticity of the file. The checksum is a unique cryptographic code based on the contents of a file. If any part of the file is changed, then it will generate a completely different checksum. After downloading a file such as a wallet app, a user can compare the checksum given by the website with the checksum of the app to ensure authenticity. If the checksums don't match, then the app has been tampered with and it should not be used. The different types of crypto wallets. Here are the 3 main wallet types that you will encounter. There are software or mobile app wallets, hybrid wallets like MetaMask, and hardware wallets. Each of these wallets have their pros and cons and can be used in different situations. App wallets are some of the most accessible and easy to use. They are usually free to download and come in the form of desktop programs and mobile apps. The mobile apps are very convenient and can be used anywhere. The downsides of app wallets is that they are highly vulnerable to keylogging malware. As your recovery phrase is visible on screen during setup, malicious apps can easily steal the recovery phrase and any crypto that is currently in the wallet or is added to the wallet in the future. This makes app wallets an easy and popular target for hackers. App wallets do not protect users against phishing attacks. Hardware wallets are one of the most secure ways to store your crypto. They are devices dedicated to the sole purpose of storing crypto, and they are designed to keep your private key cryptographically safe and away from the prying eyes of hackers. Unlike app wallets, the recovery phrase is only shown on the screen, so a thief would literally have to be standing behind you in order to see it. Funds can't be spent remotely. So long as your recovery phrase is kept safe, the only way funds can be spent on your hardware wallet is by unlocking it with your PIN and physically pressing buttons on the device. Despite all these good things, there are some downsides to hardware wallets. When it comes to cybersecurity, there is always a trade-off between security and convenience, and hardware wallets aren't the most convenient of things to use. Their tiny screens and limited buttons make them unintuitive to use, especially during the setup and recovery process. As they have to be tethered to a laptop or phone, they are best suited for home use. Hardware wallets do not protect users from phishing attacks. Hybrid wallets are ones that can be used as app wallets or with hardware wallets. The most popular hybrid wallet is MetaMask, which works great with DeFi and Web3 applications, such as NFTs, crypto gaming, and decentralized exchanges. When secured with a hardware wallet, hybrid wallets provide an excellent balance of security and usability. As with all things in crypto, there are some caveats. MetaMask's default setup is as an app wallet. If you store your funds in MetaMask as opposed to your hardware wallet, then you won't get any of the benefits that hardware wallets bring. MetaMask's mobile app doesn't work with hardware wallets. The popularity of MetaMask makes it a big target for hackers, so it's absolutely essential that it is only used with hardware wallets, especially when storing large amounts of crypto. Due to its popularity in DeFi applications, MetaMask users are especially vulnerable to phishing attacks. In a later lesson, we will cover how you can secure your MetaMask wallet with your hardware wallet. You may have noticed that none of these wallets protect against phishing attacks. That's because phishing attacks are psychological, not technical. They exploit you, the user, and the only thing that can protect you against that is yourself. To protect yourself, ensure that you're on a legitimate website. Carefully check the URL to make sure that it's accurate. Save websites that you visit often as bookmarks rather than searching for it in Google. Never respond to suspicious requests for funds or your recovery phrase. I promise you that such requests will always be from scammers and should be treated as such. Legitimate support staff from exchanges or crypto wallet companies will never ever ask you to send them your recovery phrase. The only people that do this are scammers. Get into the habit of treating any crypto-related email, phone call, or text message as a scam. Hybrid wallets such as MetaMask can be a great way to store DeFi tokens and stablecoins. They can be just as secure as hardware wallets, but only if you set up your hardware wallets to work with them and store your coins in the hardware wallet's address rather than the default MetaMask app address. During setup, MetaMask displays the recovery phrase on screen, which potentially exposes it to malware that may be on your device. I hear way too many stories about people losing their entire crypto life savings because they stored it all on an app wallet or in MetaMask's default address instead of securely on a hardware wallet. The safest way to store your crypto is on your hardware wallet's address, whether you do this via your hardware wallet software or via an app such as MetaMask. As long as you sign your transactions directly on your hardware wallet, this is the safest way to store long-term investments in crypto. So in this tutorial, we're going to download and install MetaMask, and we're going to secure it properly using our hardware wallet. We're going to be securing it with a Ledger hardware wallet. And using hardware wallets is the best way to secure your MetaMask wallet. So we're doing this in Firefox, but it works very, very similarly in Chrome or Brave browser. Now, the best thing to do is to go directly to MetaMask's website, which is metamask.io, and then it will show you which browser you're using, and it says download for Firefox. If you're using Chrome, it will say for Chrome. It will say the same for Brave browser. You click download and it will take you to the link that you should be using, the download that you should be using, which is the genuine one. So you click on here, add to Firefox, and that will just take a short while. You confirm up here. Okay, and it's added. So then we click on the icon. And we click Get Started. So we're setting up a brand new wallet. So we click Create Wallet. Now on this page, personally, I don't really like to send data to companies that I don't need to send. So I click No Thanks, but it's up to you. You can click whatever you want to click. So we just set up a new password on this bit. Okay, and agree to these terms. So here we have a short instructional video, but you're watching this amazing video, so you don't need to watch this. So you click on Next. And now this bit here, this bit is crucial. This will illustrate exactly why you do not want to use MetaMask in the default way that MetaMask comes. So I click here, and this is my private key. This is my recovery phrase. Now, if I was to put funds in here, if I had funds in here by the time you see this, and you copied this phrase and you put it in your own wallet, you could steal those funds. I'm sure you won't do that because you're lovely. But, if say you have a virus on your computer, right? If that virus, if that keylogger or some kind of snooping virus was able to see exactly what you see on your screen, if it sees this phrase, an attacker could basically steal all of your funds. And we don't want this. So that's why we're going to go through these steps, because you have to. That's the only way you can set up MetaMask. But I will show you in a few steps. I'll show you how you can secure it properly using your Ledger wallet. So first of all, you have to copy this phrase. and you have to paste it in your, wherever you keep your private key. So you can either write it down or you can put it wherever you keep them. Okay, so then we click next, and now we have to enter it in the phrase in the correct order that it comes in. So I'm just going to do that now. Okay, now that's all done. So this is the default account for my MetaMask wallet. Now, I'm not going to use this because it's not very secure, and you've seen why it's not very secure, because someone could steal the funds. So what we're instead going to do is we're going to instead use our hardware wallet, which is the best way to secure your crypto. Okay, so you want to unlock your hardware wallet and you want to click on Ethereum. So I've selected Ethereum, and now I go up to here and I click Connect Hardware Wallet. So I click this and I have a ledger. So I'm going to click on Ledger, click Continue, and it will just take a couple seconds to find my ledger. Okay, so now these are all the addresses on my ledger, and you can click one of them, or you can click multiple and add multiple. So it's up to you really. You may have one address for DeFi stuff. You may have one address for decentralized exchanges. You may have another for NFTs. It's up to you. But today we're just going to add 2 addresses. So then we click unlock. And now we have 2 addresses in MetaMask. So this is basically how you do it. So anytime you want to send funds to your MetaMask account, you don't click account 1, because account 1 is the default MetaMask account that is secured by the private key that you all saw. None of you have seen my ledger private key, so that is perfectly safe. So I could put funds in this address, which is the address that you want to use. You want to use one of the ledger ones, and nobody will be able to steal it because they won't have the private key. So then when you want to add funds, you just copy that address and then paste it in the exchange or whatever service you're using to add funds to your wallet. So that is how you secure your MetaMask using your Ledger hardware wallet. So you've just gotten yourself a brand new hardware wallet, and you need to write down your backup phrase. This small piece of paper with 24 words on is probably the most valuable piece of paper you will ever own in your life. The question is, where will you keep this piece of paper to ensure that it and your crypto remain safe? You could just keep it in your house, in a safe perhaps, or maybe in a biscuit tin under the stairs. But what would you do if you came back to your house in flames? Can you be sure that your hardware wallet and that little piece of paper with your recovery phrase on won't be turned to ash? But of course, you've got a backup copy at your grandma's house, so your crypto is safe from fire risks. If the house burns down, it's no big deal. You can just go to grandma's and recover your crypto with the recovery sheet you kept there. But what would happen if a thief decided to enter your house? Could you be sure that he wouldn't find your recovery phrase? Did you really hide it that well? When it comes to crypto, critical tasks shouldn't have a single point of failure. In this picture, we can see 2 missileers. They are responsible for firing missiles, some of which are nuclear. If there was just one missileer and that missileer had a bad day and decided to launch the missile, then the consequences could be catastrophic. That is why missile silos always have 2 who both need to turn their switches simultaneously in order to launch a missile. This philosophy of redundancy should also apply to the critical task of keeping your crypto recovery phrase safe and secure. Crypto philosophy says that you can be your own bank. It sounds great, it sounds liberating, and it is, but being your own bank is hard. Banks have IT departments and admin departments, and most importantly, security departments. All that responsibility falls on your shoulders. If your bank card gets lost or stolen, it's no problem. There's a number to call with friendly people on the other end of the line who will make all those problems go away. If your crypto wallet and recovery phrase gets stolen, who will you call? There's a solution to this problem. It's called Shamir Secret Sharing. It's a novel secret sharing technique that offers redundancy and concurrency, which can protect your crypto from life's most tragic events. Instead of writing your complete phrase on one sheet of paper and storing it in one place, the phrase is written partially in a special sequence on 3 pieces of paper. These 3 pieces of paper are then kept in 3 different locations. In order to recover the full 24-word password, you just need 2 out of the 3 pieces of paper. Any 2 will work just fine. For example, you could keep 1 sheet in your house, 1 at a relative's house, and 1 in a safe deposit box. If any out of those 3 sheets were destroyed or stolen, your crypto would remain safe. This backup solution is infinitely more secure than the default backup method that crypto wallet providers suggest. In this video tutorial, we will show you how to back up your wallet using this method with the recovery template sheets included in this course. In this tutorial, we're going to look at one of the most secure ways that you can back up a brand new crypto wallet. This is far more secure than the default method where you simply write 24 words on 1 sheet of paper. When done properly, this wallet backup method will help to protect your funds from theft, loss, and fire risks. This tutorial is for those who want to set up a new crypto wallet. If you already have a crypto wallet backed up using the default method and you'd like to move to this more secure method, then you can simply copy the 24 words written down on your existing backup sheet onto the free recovery template sheets included in this course. Please take your time when backing up your wallet and create a practice wallet first to make sure that you can recover your funds if you need to. Before starting, you'll need to download and print the wallet recovery template sheets included in this course. You can also pause, screenshot, and print these 2 pages if you choose. Firstly, you'll want to write down your wallet type, as well as any names or labels you've given to your wallet. Repeat this for the 2 remaining sheets, so that all sheets have the same wallet details and date. Plug in your hardware wallet and set it up as a new device. Be sure to follow the on-screen instructions. The wallet we're using is a Ledger Nano S. Most hardware wallets work in a similar way. If you have a different wallet, make sure you carefully read and follow its instructions. Once you've set up your PIN, the wallet will prompt you to back up your recovery phrase. This step is very important. Your recovery phrase is the key to your crypto, so it should be treated with great care and respect. The wallet will show words in numerical order. When you see a word, write it down on all sheets that have a corresponding number. Here, we can see that word 1 is candy. Word 1 should be written on sheets 1 and 2, but not 3. This is just a tutorial. You should not be writing down the words in this tutorial. Write down the words that your wallet tells you to write. Word 2 is never. Word 2 should be written on sheets 1 and 3, but not on sheet 2. As you can see, you only write the words in the white numbered boxes. Do not write any words in the grey boxes that have no numbers beside them. When you have finished, your sheet should look like this. Each of the 3 sheets should have 16 out of the 24 words on. If one of the sheets gets lost or stolen, you won't have to worry, as the thief would need all 24 words in order to steal your funds. If the worst happens and your wallet along with one of the recovery sheets gets destroyed in a fire, you will still be able to recover your funds so long as you have access to the 2 remaining sheets. In order to get the redundancy and security benefits of Shamir Secret Sharing, you should keep each sheet in a separate location. Do not keep all these sheets in the same house. This is the power of Shamir Secret Sharing. It offers greater redundancy and security than simply writing down all 24 words of your recovery phrase on one sheet of paper. In this tutorial, we are going to learn about how to create an account with a really good password manager. The password manager is Bitwarden. It's free and it's open source, which means, it has all the goodness of open source. The source code is open. People can verify that it's safe and secure to use. Open source is why part of the reason that we love crypto so much. So this is a really fitting password manager for crypto. It works on Windows, Mac and Linux, which is all great. And so you go to bitwarden.com and then you click create free account. Okay. And then we want to basically set up a new account. So I'm just going to put my email address in here and my name. And we just need one password, one master password. Okay. Put that in there. And then agree to these terms and submit. Okay, and then we just put the master password in again, and then we can log in. And then we got to do these annoying capture things. It's not too annoying this time. Okay, so now it's all set up. So all you have to do here is verify your email to unlock all the features. So you just click send email and then check it and verify it. Okay, so the account is now verified. So now what we have to do, this is really important, this bit here, is we want to set up 2-step verification, 2-factor authentication. So what that will do is it will require that anytime you want to log in, you have to enter in a one-time password that is always changing. And the reason we want that is that so, if someone wants to get hold of your username and password, that won't be enough to log in. They'd need this extra piece of information. So you click on security and then you click on 2-step login and then you click on one of these. Now, personally, I think the authenticator apps are they have the right balance between security and ease of use. But if you have a YubiKey or you have any of these authentication methods, you can use these. I wouldn't use the email authentication method. That's the least secure out of these. So today we're gonna use the authenticator apps. So we're gonna click on here, and then we have to re-enter our master password, and we put that in and we click continue. So on this step, what you want to do is you want to get out your phone and you want to download an app called Authenticator. So there's many different authenticators. There's one called Authy, there's a Microsoft Authenticator, there's Authenticator Pro, there's all kinds, there's open source ones. There's anyone, they all work exactly the same. It really doesn't matter which one you use, they all work. So what you want to do is you want to click on your phone, open up your Authenticator app, and you want to scan this code here. So we scan this code and then it will basically show you a one-time code that's always changing. So you enter that one-time code in to confirm. But the first thing you want to do before doing that, there's just one thing we want to do first, is you want to record this number here. Okay, so I think it's a good idea to print it out so you have a hard copy and screenshot this code here and print that out as well, so that if you lose your phone, you can still log in. Okay, It's a really, really important step to do. So once you've done that, you enter in the one-time code to confirm. And now you have two-step login confirmed. So in order to see how it works, what we're going to do here is we're going to log out. Okay, and now next time we want to log in, we need our username, which is here. We need our password, and we click login. But we can't just go straight in. We also need the third piece of information, which is the second factor authentication. So then I put my code in here and I click continue, and now I'm in and I can save my exchange passwords. I can access my passwords and do all of that stuff. So once you have your account set up and you have your two-factor set up, it's quite useful, it's quite convenient to have the app set up so you don't have to keep going into this app every time you want to log into Binance. So you click on get the apps, and you can download a desktop app or you can download a browser extension. It's entirely up to you. They work pretty much the same. Desktop apps and browser extensions, they work the same. But for this purpose of this tutorial, we're just going to use the browser extension. And we already have it on here and we're already logged in. So now we want to log into our KuCoin account using the password and username saved in our Bitwarden password manager. So we simply right click here and we right click on Bitwarden and just click autofill, and it will fill both fields for us and we log in. And then we just do this to say that we're not a robot, and it's running these really annoying captchas that always comes up with crypto stuff. Okay, and that's it. In this tutorial, I'm going to show you how to correctly secure your crypto exchange accounts using two-factor authentication. Now, we'll be doing this on KuCoin today, but this works on absolutely any crypto exchange. Pretty much any crypto exchange that is not a scam has the ability to secure your exchange using two-factor authentication. Now, this is an absolutely essential step that you must do before you put any crypto or any funds into a crypto exchange. And it's not only useful for crypto exchanges, you should also do this for the email addresses associated with those exchanges. So I'm just going to log in here now. And I'm going to enter the password using my password manager. Just log into here. Just have to do these annoying captchas. Okay, so now we are in. And then you want to find settings on your exchange. Now, they are often in different places, but it's usually under account security. And then we want to go on to this thing here that says Google verification. Now, different exchanges call it different things. This verification is not really a Google thing. It's an open standard, but the most commonly used verification app is called Google Authenticator. But there are many ones. There's Authy, there are open source ones. There's all kinds of different authenticators, and they all have their pros and cons. But they all use this open standard. So once you've logged in, you click on configure, and then you need to send yourself a verification code first. So I'll just do that. Okay, so I have my verification code and I've put it in, and now I am presented with this. So this is called the 2FA, which stands for two-factor authentication verification. So what you need to do here is you need to basically get out your phone and you need to download an app called Authenticator, one of the Authenticator apps. Today we're going to use Google Authenticator just because it's the most commonly used one, but you can use any that you like the most. And then you want to get your phone out and you want to scan this code here. Okay, and once that's done, you are ready to go ahead. But before we do that, what we want to do first is we want to make a screenshot of all of this information here. So you want to screenshot the QR code and you want to screenshot this number. And you shouldn't save it on your computer. You should screenshot it, put it in a Word document or something and print it off, and then just delete that file. And the reason you want to do that is in case your phone breaks, say your phone breaks or you lose your phone, unless you're using 2FA apps that back up your keys, then you will lose your two-factor authentication key and you won't be able to get in. So it's really important to back up this information. So once you've successfully backed it up, you need to open up your phone app, and then you need to enter in the one-time password that it gives. It will give you a new password every 30 seconds. So here's the one it has now. So I'll just put this in. Okay, and I click activate. Okay, and that's done, and it's basically set up now. So next time I want to log in, what I need to do, I'll log out and log back in again so you can see how this will work. Okay, so I'm now logging back in. I want to put in the password using my password manager. Okay. To do the annoying capture again. Super annoying. Okay, so this is the extra step. So you just saw we put in the username and password, but we now also have to put in the one-time password. So I'm putting in the one-time password now. Okay, and submit. And now we are logged in. So now every time you want to log in again, you'll need to put in not just your username and password, but your one-time password as well. And that's how you set up two-factor authentication. And you really need to do this on everything. So you need to do this on your email address associated with your crypto account. And to be honest, I like to add two-factor to everything that's important to me, because it's just an extra step. It's an extra layer of security that you can use to help to protect your privacy. Whilst crypto has gotten much safer in recent years, there's still a high risk of having your crypto stolen if there's malicious software on your computer. That's why it's a great idea to have a separate laptop that you only use for accessing crypto wallets and exchanges. Just think about all the apps, games, browser extensions, and torrent downloads that you have on your main computer. Can you be 100% sure that your main computer is safe and virus-free? By having a separate laptop with minimal applications on that you only use for crypto, you won't have to worry so much about the risk of being hacked. On this computer, you should install a Linux operating system, as these are by far the most secure operating systems available today. The great thing is that all your favorite crypto wallets have native apps on Linux. This is because these wallet developers know that Linux is the most secure place for your crypto. Browser extensions like MetaMask and Kepler Wallet will work too, as Chrome, Brave, and Firefox have Linux versions. Unlike Windows and Mac OS, Linux operating systems are open source, which means that they are built by a community of hundreds of thousands of the world's brightest minds instead of just a few thousand employees in Silicon Valley offices. Vulnerabilities are known by the community and fixed far quicker than closed-source operating systems. Linux is far more secure than Windows and Mac computers, which are vulnerable to millions of viruses and keyloggers. This is far less of a concern to Linux users, as its architecture makes it far more difficult for viruses to run. The beauty of Linux is that it isn't just one operating system. Just like crypto, there are many different types of Linux. These are called distributions, or distros for short, and there is one for every kind of Linux user. The vast majority are open source and free to download, so you can try them out to see which one works best for your needs. Not only is Linux very secure, but it can be much more stable than Windows, and there are now many distros that are super intuitive and easy to install and use. The Linux distro we will be installing today is called Ubuntu. Ubuntu is one of the most user-friendly Linux distros. You can install it on almost any laptop, and it's easy to get up and running in under 90 minutes. In this tutorial, we will download Ubuntu and then we will install it. We will then download and install the necessary wallet apps so we can have everything we need to manage and trade crypto on a safe and secure laptop. To get started, we need to download Ubuntu. Go to ubuntu.com and then go to download. Under Ubuntu Desktop, click this button here that says 22.04 LTS. It will now download to your desktop. Then we need to download this app called Balena Etcher. It works on both PC and Mac, and it will write the Ubuntu image to a USB stick. You'll need this USB stick to boot into Ubuntu on your desktop. What you need to do is click here, and then choose whether you want to download for Windows or for Mac. Once you've installed Balena Etcher, open the app. Then plug in an empty USB stick into your computer. Once that's done, you want to drag and drop the Ubuntu disk image into Balena Etcher. And then select Target and select your USB disk. Then click the flash button and agree to any prompts that your system shows. Balena Etcher will now write the Ubuntu disk image to your USB stick. It should take 5 minutes, so make yourself a cup of tea and just wait for it to complete. Plug the USB stick into the laptop you want to install Linux on. Then press the button needed to get into your BIOS menu. For most laptops it's the escape key, but for some laptops it's the enter key. When you're in the BIOS menu, scroll down to the boot menu and select the USB stick that you just entered. Then press enter to select try or install Ubuntu. Click the try Ubuntu button. Now you'll want to click on install Ubuntu, and then you simply follow the prompts. So we click continue. Select your region, and I usually like to click this. It just makes the whole setup process a lot easier. It downloads all the drivers that you need. And what I like to do is I like to click on advanced features, and then I like to click on LVM, and what that will do is it will encrypt your laptop. So just as we have encryption in crypto and encryption on our hardware wallets, we want to encrypt our crypto laptop to keep it safe and to protect our privacy in case the laptop gets stolen. So you click on here and you click OK, and then you click install now, and you want to choose a password, a nice secure password. Okay. And that's it pretty much. You can select to have a recovery key. So this can be quite useful if you forget your password. And then you just click install and it will install for you. Now we're just going to click continue. I'm going to enter in my name. My password in. And press continue. And now it will install for us. So you can just make yourself another cup of tea and sit back and relax. Once the installation has finished, you'll need to click Restart Now before proceeding any further. After restarting, you'll see this menu. Press Skip. It's up to you whether you want to send any information. Personally, I'd rather not, so I just click No. And I'll keep this off. And then you're ready to go. You can see many familiar apps like Firefox and Thunderbird. And here is our file manager. So this is where your files are. It's really nicely laid out. It's a really nicely designed system. And it's, in terms of ease of use, it's just as easy to use as Mac or Windows. In fact, I'd say much more easy to use than Windows. And up here, we have all of our controls. So you have your internet controls, you have battery there, settings, your power controls. So what we're going to do first is we're going to open Firefox because we want to download some of our apps. So first we're going to download Ledger. Okay, so we want to download Ledger Live. And we click download the Linux app. And this app is downloading. It's an app image. So we'll just let that download. And for you Trezor users, I haven't forgotten about you. Let's download the Trezor app as well. Okay, and it shows that we're using Linux, so we can just download the desktop app. Okay, so we'll just wait for that to download as well. Okay, so now that we have our wallet apps downloaded, we need to prepare our system to install these apps. So what we need to do is we need to press this button here that says Show Applications, or you can just press Start. And then we will need to select the terminal, which is this one here. Now, I know you're probably not used to seeing terminals if you're a Windows or Mac user, but it's actually quite simple. What we need to do is just download some libraries. So we paste this in here. I'll show it on the screen for you. And then you put in your password. And you press Enter. And it will just install that for you. Shouldn't take too long. Okay, that's done. And now the next step is to right click on this app image and you go to Properties, then you go to Permissions and you go Allow Executing File as Program. Now that's done. And we just double click on Ledger Live. Okay, and now Ledger Live is set up. So there may be one extra step that you'll need to do in order to connect your Ledger to your Linux laptop and get it working. So what we do is we open up Firefox again and we're on the Ledger site. And then we click on Support. And then in here in Search Documentation, you type these words UDEV, UDEV, and you press Enter. And we click on this article that says download and install Ledger Live. And then we see these things about UDEV rules. So you click on that. And then you scroll down to Linux installation. And I know it looks really, really complicated, but all you need to do is you need to go down to number 4 here. And you need to copy this line here on number 4, and you just copy it, and then you go back over to your terminal and you paste it. Now you can't Control V in terminal, you have to press Shift Control V. But once you've done that, you just press Enter. And when you see your name it's all good. Everything is good. You can now plug your ledger in and it will work just as it would on your Mac or on your Windows computer. Okay, so now we're just going to do a little bit of cleanup. So first we're going to close the Ledger Live app. I'm going to close this. Now the thing with these files, they're app images, they're unlike Windows or Mac installation files where you just click on it, install it, and then it's on your system. App images are portable, so everything needed for the app is in here. It doesn't actually install it. It just, you click on it and it opens. So you don't want to delete these or you won't be able to access your wallet. So what you want to do is you want to copy, then you want to go to home and create a new folder, and you can call it whatever you like. I'll just call it app images. And then you paste it in here. Okay. And now what you want to do, we want to install the Trezor app because we haven't done that yet. So you right click, we click permissions, allow executing file as program, and then we just double click. And our Trezor app will open for us. Okay, so now you can connect your Trezor and you can use your Trezor just as you would on your Windows computer or your Mac. Now, whenever you want to use it again, you just open files, go on app images, and then you just click on one of these to open your wallet, and that's it. Okay, so now we have two more things we need to install that most crypto users, these are apps that most crypto users would use. So the first one obviously is MetaMask. I mean, you can't be in crypto without using MetaMask. So we just go on here and we can click download for Firefox. Or you don't have to use Firefox. You can download Chrome and you can use Chrome, or you can use Brave browser. Just use the browser you prefer. But I quite like Firefox, so I just download it for Firefox. And while I'm waiting for that to download, I like Bitwarden. So I'm going to download Bitwarden as well. And you can use whatever password manager you like. Most of them work on Linux because most of them have browser extensions, so they'll work on Linux just fine. Now I want to add Bitwarden. Okay, so now we're pretty much all set up. This is just finishing off. So now we have pretty much everything you need to use crypto on your Linux laptop. We have our Ledger wallet app, we have our Trezor wallet app, we have MetaMask up here, we have a password manager. That's pretty much everything you need to get going. So yeah, have fun. In this tutorial, we're going to learn how we can quickly and easily turn our government money, so that's our pounds, our dollars, our euros, into crypto using Binance. Now, Binance is a pretty good place to get started with crypto because it's quick and easy to set an account up there, and they have a very, very extensive range of cryptocurrencies that you can buy. So first of all, what we need to do is click on this tab here that says Buy Crypto. And as you can see, there's a number of different buying options. You can buy via bank deposit, you can buy via credit or debit card, you can do peer-to-peer trading, you can do cash balance. There's all kinds of ways. But one of the quickest and easiest ways to buy is just using a credit or debit card. Now, you really wouldn't want to use a credit card. You should not be buying crypto on credit. So just use a debit card. Do not use a credit card. So we just click on this one here. And then I'm in the UK, so I pay with pounds. And I want to buy 1 Ethereum today. So I go down to Ethereum, I click on that. And then I just type in 1 for 1 Ethereum. I can see how much it's going to cost me, £880, 25 pence. And if you want to, you can do a recurring buy. So it's good for a dollar cost averaging strategy if you want to buy the same amount every month. But I just want to buy one today. So once that's done, I just click continue. And then basically after that, you just add your card, you put in your card details, you press continue and follow the prompts, and that's it. You have your Bitcoin or Ethereum or any crypto you want. And that's a good way to get started in the crypto ecosystem. And once you have some crypto, you can move it around to different exchanges, or you can trade it within Binance for other cryptos. So now that I have my Ethereum on Binance, I feel like I want to swap it for something else. So how do we do that? Well, what we do is we go to trade and then we go to Binance Convert. And then I'm going to click on this drop down menu here. And I'll select my Ethereum. And I want to swap all of it for Bitcoin. So I'll press max. And then I can see Bitcoin down here. So it will swap Ethereum to Bitcoin. But if I don't want to swap it for Bitcoin, if I want to swap it for another crypto, I simply click this. And these are all the cryptos you can swap it for. So there's quite an extensive range. Here, but I just want to swap it for Bitcoin. So I have max selected, and what I need to do next is press preview conversion. And this will show me how many Bitcoin I can get for my Ethereum. So I can get 0.0048. And every 5 seconds, this will change because it gets a new exchange rate. So when you're happy with, the amount that you're going to get in your swap, you just press refresh again, and then you click convert. Part 2. Crypto Traders Masterclass. In this course, we will cover the differences between trading and investing, how to use TradingView, technical analysis, trading strategy, risk and money management, managing your emotions, and trading alerts. Are you a trader or investor? This is probably one of the most important questions we should ask ourselves, as these activities are not the same and require completely different mindsets. These mindsets can make or break an aspiring trader. A trader focuses on short-term time frames, a few minutes to a few hours, a few weeks at most when swing trading. Depending on the time frame a trader chooses to trade, being a trader can be more liberating than investing, as a trader can simply close positions before sleeping and doesn't have to worry about the possibility of incurring big losses the next day. The downside is that a trader always has to be active in the markets. Looking at screens all day, every day can take its toll. An investor doesn't worry too much about the day-to-day movements, as they are in it for the long haul. The primary focus here is on catching big multi-month to multi-year trends and picking great projects with great teams and good fundamentals. Investors rarely sleep easy though, especially these days. As we witnessed repeatedly since March 2020, a global crisis overnight can cut a portfolio in half by the morning. It's important to make a clear distinction between trading and investing, as they are two completely different activities requiring different mindsets that can sometimes be contradictory. Most in the crypto space are not only traders but investors too. This often requires such people to simultaneously believe contradictory things. For example, let's imagine a trader called Bob, who has long-term Bitcoin holdings while simultaneously holding a trading position in Bitcoin. If the price of Bitcoin were to fall sharply to the point that it was about to go below Bob's trade entry price, then he would be simultaneously bearish about his trading position to the point that he would close it, whilst remaining bullish about his Bitcoin investment as he is still in profit on his long-term holdings. It's very important to identify your reasons for trading. This will help you take profit and cut losses when needed. Doing these things will help you to become consistently profitable. In crypto, the concept of HODL culture is very prevalent. For those who are unaware, HODL is an acronym for Hold On for Dear Life. This crypto meme adds humor to a market that can be extremely volatile, where wild swings can make a portfolio lose half of its value in just a few hours. The HODL mentality can calm the nerves of an emotional investor, as the wild swings are all part of the journey. Investors are constantly reminded of the person that sold their bitcoins in the flash crash of 2013, only to miss out on being a multi-millionaire a few years later due to a moment of weakness. Whilst this mentality can serve an investor well, it is detrimental to the success of a trader, as a trader needs to have clearly defined risk and reward levels and needs to be able to quickly change their opinion about the market or a particular asset at a moment's notice. This tutorial is an overview of the basic functions in TradingView. Now this is for the TradingView website. We will be doing a more specific one for the app later on. So basically in TradingView we have these four main sections. We have the top bar, which has your symbol search, and we have our different time frames for our charts. We have different types of charts. So we have candles and line chart here, indicators, indicator groupings, indicator templates, alerts. On the left hand side we have our drawing tools. So this panel is to do with everything to do with drawings, and we'll have a more specific drawings tutorial later on. And in the middle here obviously we have our chart, and we can have our chart indicators here. And then on the right panel, this is for our favorites, and our favorites can be organized into different sections. So we'll start off with the top. So here we have the symbol search, and you can search for any asset you like. So you can search for all the cryptos obviously, but not just crypto, there's forex and futures and all those other things. But what a lot of people miss, and which is a really, really useful feature, is these formulas here. And it can be quite useful for cryptos that aren't on big exchanges yet. So stuff that just trades on Uniswap, for instance, or other dexes. And there was one particular that I remember from 2021 that wasn't on a centralized exchange at the time. And I wanted to create a chart for it in US dollars, so it was more easy to see what the price was. And that crypto was over. As we can see, it has a USD pairing now, but at the time it didn't. At the time, this one, the wrapped Ethereum one on Uniswap, was the only one that was available. So if I click on this, it shows the OVR price in Ethereum, but I want to see what the price is in dollars. So how do I do that? Well, I go back to here, and we have this one selected over wrapped Ethereum, which is WEF. And then you basically click on this over WEF multiplied by FUSD, Ethereum USD. And you just press enter basically. And now it shows it for us in dollars. So it's the over in Ethereum multiplied by the Ethereum price by US dollars, which is 85 cents. And you check that that's accurate. Let's look at what the over price is in US dollars on one of these exchanges. And we have a USDT pair, and it's 85 cents. So that's a really, really useful feature for the more obscure cryptos that aren't yet on TradingView. On the top bar, we also have our interval settings. So these are all chart settings on the top bar. And these are my favorites. So to set a favorite, you just click on it, click on this star here, and then that will be one of your favorites. And you can also set custom ranges, which is quite interesting. So if you have a trading strategy, for instance, that revolves around, I don't know, say like a 3-week chart, right? You just type 3 into here, and then you select weeks, and you can add it. And then once it's here, you can then star it. So it's actually one of your favorites here, 3-week charts. And you can click on that, and you can now have 3-week chart for Bitcoin if you want. You can also set different candle types, different chart types here. So we have candles, we have line charts. Line charts are very useful when it comes to easily picking out areas of confluence, so confluence zones or support and resistance zones. So we can easily see here that this top here intersects with this bottom here. Now, the thing to point out with the line chart is it doesn't show all the price data. It only shows the closes. So each of these lines is based on a point, and the point is the closing price, right? You can change that in settings if you want to. You just click on settings. As we can see here on symbol, it says price source close. You can do these different options, but line charts are a very low resolution way to see price data, and low resolution can be good when you want clarity, when you want to get rid of the noise. Because if we go back to this, we can see it's very noisy and there's lots of information that we may not necessarily need. Like, here we can quite clearly pick out that here is a strong support level, right? But all of this extra information isn't necessarily that necessary. If we click on the line chart, it more clearly shows this as a support level. So that's just something to bear in mind. There's also this chart, which is called a Fibonacci chart. And this is another way to make information clearer to you as a trader. Traders, we're exposed to so much information, so it can be really useful at times to simplify things. And the beauty of a Fibonacci chart is that it simplifies the trends. It can show you trends very easily. You can clearly see this as a downtrend, and you can clearly see these blue lines, these blue bars are uptrends. Whereas if you go back to the candles, yeah, you can see it, but it's not as visually striking. It's not as immediately striking visually. And then over here, this is our indicators. So all our indicators are on here, and there's thousands of indicators on TradingView, right? So for instance, if we want the RSI, we just type in RSI, and we have relative strength index here, and you click it, and it's added to your chart for you there. And another really cool thing you can do is that you can, let's look for another RSI. So there's RSI candles. I've never used this one before, but say we want to add it to our favorites. We click favorites, and it's now in our favorites. We just go on here, and then we can find the RSI candles here. Another really cool thing you can do is create indicator groups. Now, this isn't a brand new feature, but it's fairly new. It's quite a new feature. So the purpose of this is, say you have a strategy where you want more than one indicator. So say we've already got the RSI, and we want some moving averages as well. So we'll have a moving average here and a moving average here, and we'll make this one a 50 period moving average, and this one a 200 period. Click on style. We'll change the color so that we can tell them apart, and click OK. So we have these three indicators now. We have our RSI, we have our 200 period moving average, and we have our 50 period moving average. So if we want to save this as a group, we click on here and we click Save Indicator Template. And we'll call this, let's call it ABC template. Nice and simple. Another thing you can do, which is really useful, is you can click on here so it remembers the symbol. So for instance, if you're looking at Ethereum and then you want to go to your Bitcoin strategy, which is comprised of these three indicators, you can simply have it remember the symbol, and it will just go straight to that. And you can also remember the interval as well, which is quite useful. Okay, so we've just saved our indicator template, and let's go to one with no indicators. So this is it with no indicators. So we're looking at this chart, and then we want to get our indicator template up. We click on this, and we click on ABC template, and it brings all those indicators up for us. So that's a really useful way to save multiple indicators on one template. To make things even more convenient, you can save your indicator templates up here, your favorite ones. So to do that, we just go down to ABC template and we click on the star. And now if we want to reach it, we just click on here, ABC template, and it will come up for us. Moving over, we have the alerts button here. If you click on this, you can set your alerts. We're going to do a really in-depth video about alerts later on, so we won't do much more about that. But you can click on this button if you want alerts. And then moving over again, we have our layout selector. So depending upon which tier of TradingView you have, you can have up to eight different charts in the same window. So you have to have the pro version, the top tier version for that one. But I believe even with the free version, you can still have up to 4 charts, which is really handy, having 4 charts in one window. And that brings us on to a really cool feature with multiple charts that I use with 2 charts. So it's really good for comparing stuff. So say you want to compare Bitcoin against the dollar index, which is quite a useful thing to do because they tend to trade inverse to each other. We can have the dollar index on the bottom chart. So we type in DXY for dollar index. And we just press auto like this. It's all lined up. And then we click back up to here and we can synchronize the crosshair. And that's quite useful because then you can line it up and you can see if you click on here. So we're having the same time frame on both charts. Everything is lined up perfectly, which is really quite useful, right? You can see that Bitcoin clearly moves inversely to the US dollar index. So that's quite a useful feature to have. But we're going to go back to one chart now, and then we're going to start going down here. So if we open this up, we can see that we have our favorites here, and you can organize them into different sections. So to add a favorite, you just click this plus button, and say you want to add Avalanche. So we type in Avalanche, and we just click on the plus button, and it will add it for us. It adds it at the bottom, but you can move them anywhere you like, basically. You can move it all the way to the top if you want to, like so. And you can add these really useful sections. So you can add a section. I've got a crypto one. I got a world markets one. So what's our new section going to be? I don't know. Let's call it Forex. I don't really trade Forex much at the moment. But if we wanted to, we can have a Forex section and we can move that down. And then we can add Forex stuff to there, like so. So yeah, that's a basic overview of this panel here. This panel is quite useful. It's a bit of a dynamic panel. It will show different things. So if you click on alerts, it can show all of your alerts that you have saved up. You can see news on here, news headlines. I don't really use this, to be honest. We have a data window that shows data for the current ticker. So we have Bitcoin open. You can see the open, high, low, and close, and all these metrics here. You can have hot lists here. There's a calendar. There's all kinds of useful stuff. But the most useful really are the watch list, the alerts. You can see all your saved alerts and you can tweak them. And what's also useful is these the drawing object tree. So I have a number of drawings saved here, and I have them all saved in folders. So if I unhide this one, you can see that there's some drawings in here. We've got to really zoom right into to see these drawings, but we can see them here. So you can have as many drawings as you want, and you can organize them into folders, which is really quite useful. Again, this is something we'll go into in more depth later on in our drawings tutorial. But this is just a basic overview of some of the most useful features in TradingView. In this tutorial, we'll be looking at the TradingView app. So this is it's the same TradingView that's on the website, but it's still an app. So it's quite handy to use when you're out and about. And there are some similarities to the website version, and there's some differences. But overall it's laid out in a quite intuitive way. You just have to play around with it and get used to it. So we'll go from left to right. So we'll start off with the watch list. The watch list is just the same as the web version. You can just have all of your cryptos here, and not just cryptos, but anything else you're watching. And you just click on the one you want and it comes up. which is quite handy. And then if we move over to here, we have our search box. So say we want to search for a crypto. Let's search for Avalanche, AVAX. And we click on AVAX USD on Binance, and we have it here. And we have some drawings that I did before on there. And if you want to do your change your interval, you can do all of that on here. Click on this and you change the interval. And now the plus button. So the plus button is for adding things. So you can add drawings, indicators, alerts. You can compare, and you can look at your templates as well. The templates are your indicator templates, which we covered in the TradingView web overview video. So if I want to add a drawing, I click on drawings and I want to add a trend line on here. So I want to add a trend line between this point and this point here. So first of all, you move the crosshair, you just drag your finger along to move it. And then when you have your starting point, you tap like this. And then you drag it along again, and then you tap again to finish it. And that's your trend line set there. So that's quite handy. And then if we click on these three dots at the end, this is the more section. So here you can change the chart type. So we can change it from candles to line charts if we want to do that. We can also do alerts management. So we can click on this and we can change our alerts. If we double click on it, we can change the parameters of the alert. We can delete the alert. And we can also set new alerts. If we click on this one up here, we can set a new alert. So it's really, it's a really full-featured app. You can really do, I'd say, a good 90% of everything you can do on the web app. Obviously, it's a bit more fiddly because you're using your fingers as opposed to using a mouse. But it's still very, very handy when you're out and about. It's a very, very handy way to look at your charts and manage your alerts and do all the things like that. Another really useful thing you can do, at least on Android phones, is that you can add your watch lists as a widget on your home screen. So to do that, you just press and hold and add your widgets as you normally would do. You type in TradingView. And the one I like to add is the third one, the watch list. You press and hold and you add it. And then you can choose which watch list you want. So if you have multiple lists, you can choose from any one of them. And you can set your theme. I like dark mode and I like to hide the logos. You just do those settings there and then you click OK. And then you have your watch list. And you can resize it. Just unlock the home screen. You can make it any size you want so that you can at a glance see all of your favorite cryptos on your home screen. In this tutorial, we're going to be looking at the drawings and layers features of TradingView. So it's all about this panel here on the left. This is the drawing panel. And if we start off with a simple trend line, we'll just click on this trend line here and we'll start it here. And let's drag it down here. So this is quite an interesting trend line actually, because we can see that this trend line acts as resistance. It's resistance here, it's resistance here, it's resistance here. The resistance gets broken through and then it gets tested as support. So that's an interesting line that we'll keep there. And you can see that anytime we put something on here, it shows up in the object tree. And we can do some interesting things with the object tree. We can lock drawings so that we don't move drawings by mistake. And we can hide drawings if we have too many drawings. But we want to keep this drawing on here. We'll keep it locked, but we want to keep it visible. So now we want to do some more drawings. So what other drawing tools do we have? Well, what's interesting is we have a parallel channel. So let's add a parallel channel. And right now I can see that this is an interesting zone for a parallel channel. So you just drag it along the bottom and click, and then you raise it up. So here is our parallel channel. So now we have two things on our chart, a parallel channel and a downtrending line. But if you add loads and loads of different drawings and they're all the same color, it can get quite a bit hard to tell stuff apart. So that's why we want to change the colors. So for our downtrend line, we'll make that one red. And for our parallel channel, which is going up, well, we may as well make that one green. So there we have two drawings on our chart. Now we want to add some other things to our chart. So we want to add some Fibonacci levels. So we'll drag this down from the swing high all the way down to the swing low. And we have our levels up here. And let's also add the measuring tool, which is quite handy. So with the measuring tool, you can measure in all directions. So it shows percentage move up and it shows the number of days. So that's quite useful. But what I find even more useful is ones that do just one thing. So one that just does the date range. So if we want to measure the date range from here to here, we can do that. And it shows us that it's 75 days. And if we want to measure a price range from here to here, we want to measure the price decline. It's 52%, 52.84%. So we have quite a lot going on this chart already. And for good measure, let's add some fun symbols. So these are some really, really cool symbols here. And because it's crypto, we love rockets. So we'll add a rocket. You've got to have a rocket in crypto, right? What else do we want to add? We want to add a moon. People love moons in crypto. So you can add those things there. Now, this chart is looking very, very busy, right? We've got a rocket, we've got a moon, we've got fib levels, we've got trend lines. It all looks a bit busy. What if we want to hide stuff? Well, we don't really need the rocket and moon. It's there for fun, but we don't need to see it all the time. So we can select them, put them in a folder, and the folder is automatically named group 1. We can rename it if we want to. So we'll call it, I don't know, Celestial. And then we just click on this and it's hidden away. We don't need to see that all the time, but it's still there. It's still there. It's not going anywhere. And we can have our price and date range in another folder. We can call that folder ranges. So we just click, you have to click it in the right place. Otherwise it brings up that. So we click on type in ranges. Okay. And we can hide the ranges. We don't need those all the time. And we can hide our fib level and we can put these all in another folder. We'll just have that called group 1. So if you click on that, now you have no drawings at all. Another quick way to get rid of all of your drawings at once is just to click on this I button here and it hides all the drawings. It doesn't delete them, but it hides them all for you. Be very wary of this button because if you click this button, it deletes all your drawings. So you can remove drawings, you can remove indicators, you can remove drawings and indicators. So be careful about that there. So that's basically how you manage your drawings and your indicators on TradingView. In this tutorial, we are going to look at how to set alerts in TradingView. Now, there are many different kinds of alerts you can set. There's price alerts, percentage alerts, moving average alerts, indicator alerts, trendline alerts, recurring alerts, all different kinds of alerts. And we're going to start off with a simple price alert. So there are two ways you can set price alerts. We'll start off with the simple way. And this is actually the most intuitive way. And it's to do it visually on the chart. So I'm going to show you a resistance level here. And it's going to be marked by this line, which will make red. So we want to know when the price crosses this resistance level because that could be a bullish sign. So all we do is we drag this up here and we line it up with that and we click this plus button and you simply click add alert for ETHUSD at 1716. So you press that and now we have an alert and we can see that there's this orange arrow here that points to the alert. So that's one way you can do it visually. Another way you can do it is you can press alert on here and you can add the price in manually. So you can type in 1716 and depending on your TradingView subscription level, you can alerted. You can set it to alert you once, so it will only do it once, or you can select it to do it every time it happens. So if you have a premium account, you can have it open-ended and it will just keep on repeating forever. If you don't, you won't be able to take this, and you'll have an expiration time of a month. So a month from today, whenever that day is for you, it will recur up until a month, basically. So you can just do it like that. And yeah, that's how to do simple price alerts. So those are the two main ways. Another way is you can do it by putting an alert on a trend line. So say we have another line here. You can have a line here like this, and we can either click this alert button here, or we can right click directly on the trend line and click add alert on horizontal line. And we can modify the alert, so we can do it once per bar close, once per minute if you like. And again, that's another one you can make open-ended. And you just click create, and that's an alert on there. And you can see there's an alert there because it has a trend line little alert symbol. But it's not just horizontal lines that you can do alerts on. You can also do alerts on any kind of line, really. So say we have a trend line going like this, and you want to be alerted when Ethereum breaks out of this trend line. Again, all you have to do is right click on this trend line and add alert on trend line. And then you check the parameters, and if it's all okay, you click create. And we can see there's another alert on this trend line, and you can see this little alert alarm clock here to show that it's been set. So that's how to set alerts on trend lines and simple price alerts. Other alerts you can set are moving average alerts, or any indicator alert for that matter. So again, there's two ways you can do that. You can directly click on the alert. So in this case, we want to know when the price of Ethereum goes above or crosses the 21 period moving average. So right click on that, we click add alert, and then this pops up. And this is the condition, MA21 close. So it says crossing, and it says a value. So we can do a number of things. We can go crossing up, so it will only tell us if it crosses up. We can do crossing down, it will only tell us if it crosses down. And we can do only once, or once per bar. So that means that every time a bar goes above the 21 period moving average, it will alert us. Now, these are really good alerts to have open-ended. And even if you don't have a premium TradingView subscription, I would still recommend setting this as open-ended. And if you don't have the subscription, simply just set it like a month, up to a month ahead. You can do that on, I believe you can do that on most accounts. And what I did before I got a premium account was that I put a calendar alert in my phone, just to tell me to redo my alerts, essentially, because these are really good alerts to have in the background. So it can tell you when the price of Ethereum goes above the 21 period moving average, for instance. Now, when it comes to moving averages, what I really like to do, the alerts I really like to do are crossover alerts. So first of all, I'm just going to clean up some of these lines on here because we have quite a few lines and it's looking a bit busy. So that's much better. So a moving average crossover, as you can see, is when the slower moving average crosses over the faster one, or vice versa. And if we look back, we can see that that signals a trend change. So if we go all the way back here, we've got two moving averages, the 21 period and the MA period. I'm on the 1 week chart. So when the fast moving average, which is this light blue one, crosses over the red one, that signaled a trend change to the upside. Now, it's good to be alerted of that when that happens, because, I mean, as we can see, this trend lasted quite a long time. Let me just get the measuring tool out. So this trend, that one, the date measuring tool we want. There we go. Yeah, this trend lasted, got to go all the way over here. So this was a 693-day trend, right? That's a very, very long time for a trend, all the way from April 2020 through to March 2022. So you want to be alerted of a trend change when a trend change happens, basically. And the way you do that is you simply, we'll delete that there, you simply click on the alert button and you can click on the MA21 and you want to put crossing, and where it says value, you put MA34. And you can just leave it as crossing, because if you just leave it as crossing, anytime it crosses either above or below, it will alert you. And I like to set this as once per bar and open-ended, and then I just click create. So anytime now, going on into perpetuity, anytime that this crossover happens, I will be alerted. And this is really good because it alerts you of major trend changes. This is such a useful thing to have. This is such a useful alert to have. This kind of moving average alert that alerts you of these long-term trend changes. Another alert that's really useful is a price percentage alert. So for instance, say you have a trading strategy where you want to buy every time Ethereum falls by 20%. I mean, that could be a useful strategy to have. So how do you implement this? Well, you click alert and then you move down here to condition and you select moving down percentage and you type in 20%. Now this bit here is really important because it says bars. So it says when it moves down by 20% in 1 bar, it will alert you. 1 bar on this chart equals 1 week. So you may want that, but you may not want that, right? What if you want it to be on a day? And I think I'd say that's a more useful time frame for this kind of alert. If a price moves down 20% in a day, it's most likely going to bounce. So you probably want to get in on that. If it moves down 20% in a week, I mean, that's not so advantageous to have that kind of alert. So we'll set it to 1 day and then we'll make this alert again. And we'll click on this, moving down percentage, 20% in 1 bar, which is 1 day. And I want it to tell me once per bar. You can do once per bar close, but I think that because you have to wait until the bar closes, the alert won't trigger until that happens. So by the time that happens, it could be too late for the move. So I just click once per bar and then I just click create, and that's your percentage alert set. Now you can do percentage alerts to the upside as well. And it's a very similar process. So if you click on here, you can go moving up. So you can go moving up. If it goes 20% in 1 bar, once per bar, the same thing will happen to the upside. So that's basically how you do percentage alerts. Another useful alert you can do in TradingView is an indicator alert. Now you can set indicator alerts on pretty much any indicator in TradingView, and the type of alert you can set depends entirely on the indicator. So we're going to set an alert on the RSI. Now to do that, we just click on the RSI and we click add alert. And then we can choose to be alerted when it goes above a certain value. Now, generally on RSI, a value over 70 it indicates that the asset is in a overbought condition. So we want to put that in there. So we want to be alerted of that. And again, as with all alerts, you can make it trigger once per bar, only once, or however often you want. And you simply click create, and that's set. That's how you set indicator alerts. Now, when it comes to alert messages, you can do some really interesting things. So the default message is just down here, and it depends on what the alert condition is. So if you put crossing up, it automatically changes to crossing up. But what if we want a specific alert, a specific alert message, and we want to add stuff to it? Well, you can do some really interesting things. So you can have, instead of crossing up, you can have something different. And instead of ETHUSD, you can put something different. So for instance, you can put these two brackets here. And if you write ticker like so, this is like a placeholder for any ticker, right? And instead of crossing up and having the price there, right, you can just put these two brackets and you can write close and to close those brackets again. And inside of here will be the closing price. So whatever price it is, you can put in there. And you can literally write anything on here. So you could say time to buy, for instance. And the great thing is, if you have TradingView on your phone, this will pop up on your phone and you can instantly see what the ticker is, what the asset is, and you can see the condition and you can see the closing price and you can see your custom message. And you can even put interval on there as well. So we can put two open brackets and we type in interval like that. And say we want a minute, we just put M like that. So that will show us how many minutes it is. So if it's a 2 hour, then that will be 120 minutes. And you can just copy and paste this and click create. And then when you create another alert, and it could be on a different asset. So this one was on Ethereum, but say we do this one on, so you want to have the same alert on Avalanche. We type in AVAX USD, and we want to add an alert. We can simply paste that in. And instead of having to write out AVAX, it will just do it for us because it has the ticker placeholder for us. So this is a really, really good way to make custom alerts with custom messages. And it can be really useful for your trading strategies. If you want to see more special placeholders, you simply click on this question mark here. And you can see in the TradingView help section, you can see that there's all of these different placeholders that you can use. And you can really have a lot of fun with it, creating these alert strategies using these different placeholders. And we'll go into more details about this, about the kind of alerts you can set and alert strategies you can create in the strategy section of this course. But yeah, it's well worth having a look at this section, looking at all the things you can do with alerts. Technical analysis is the practice of using price data to find statistically significant trends and patterns that can help a trader identify potential opportunities and risks in a given market. Market technicians form their opinions on current price behavior by looking at the outcome of similar price behavior in the past. Common chart patterns are the result of centuries of chart analysis that show statistically significant probable outcomes after the completion of certain chart patterns. For example, if we look at 100 charts that look like this one, where there is an ascending triangle formation, we will see that they break to the upside over 60% of the time. In addition to chart patterns, market technicians study other price data such as trends, moving averages, volume, support and resistance levels, and oscillators. In this section of the course, we will cover all of these aspects of technical analysis. By studying these factors, a trader can build up a picture of the supply and demand dynamics at play, which can help traders to make buying and selling decisions. Some technical analysts believe that all the information about an asset or the organization behind the asset is displayed in the price. However, technical analysis is only part of the puzzle when trading and investing. In order to build up a more complete picture of an asset's probable direction, technical analysis works best when combined with fundamental analysis, which is the study of real-world factors that contribute to an asset's price. In this tutorial, we'll be looking at the chart patterns that every trader and investor should know about. In technical analysis, there are two main types of chart patterns: There are reversal patterns and there are continuation patterns. With reversal patterns, you have a trend that's going in one direction and then it pauses and it forms a pattern that signifies a change in the original direction. And with a continuation pattern, you have the exact opposite. With these, the price is trending, it then pauses for a while, and it forms a pattern that signifies a high likelihood that the price will continue in the direction of the original trend. Unlike the vast majority of chart pattern tutorials that focus on theoretical chart diagrams or really old data from the 1970s that nobody can remember or relate to, we'll be focusing on Bitcoin's recent price history from 2019 onwards. This is better as it's much more relatable and it's rooted in reality. The first pattern we'll be looking at is a double top. This is a very, very important chart pattern because it signifies a change in trend, a change in the market's direction. Now, if we look at this one here, we can see that there's a high and there's a lower high. And if we go back in time, we can see that each of these peaks is higher. Every peak is higher than the previous one. So we have this peak here in November, right? That peaked up here at like almost 20K. And then we had a peak in December that peaked a little bit above that. We had a peak in December that peaked at like 23,000. Peak here that peaked at 42. A peak here that peaked at 58. This one at 61. This one at 63. Then we had a pullback. And then the next peak was lower. So if we look back, all these major peaks were successively higher than the last. But then this major peak was lower. And to investors who are watching, savvy investors, they can see that that can signify the possibility that the trend will change its original direction. And that's exactly what happened. What happened from then on is that the price fell, and it fell by quite a bit. Let's measure it and see how much exactly it fell by. So from this lower high, the price fell 51%. Okay, so that is why these reversal patterns are really, really important, and especially this double top pattern. It's a very important pattern to master and recognize. The second chart pattern we'll be looking at is a double bottom. Now, this is basically the opposite of the double top, but it's still a reversal pattern, so it signifies a trend change, a change in the trend's direction. Now, with this one, it's actually quite helpful if you switch over to the line chart, because if you look at the line chart, it just looks so much clearer. And that's why I think it's really important to constantly be switching between the normal candlesticks and the line chart, because the line chart really simplifies things, and we can really see clearly that we have a low here and we have a higher low here. Whereas if you have the candlesticks on, you can still see it, but it's a lot harder to see. There's a lot more noise. So it's quite useful to have this in place. So we'll go back to this and we can see that this pattern signified a trend change because the price was going up and it came down here, up, down here, up and down, right? And then it made a high and then it came back down and it looked like it was just about to break this low, right? But it didn't. It made a higher low, and we have a successive higher lows here. But this one was very, very significant because these two lows are very close together, right, in terms of time frame, whereas the other ones aren't so close together. And as we can see, from then onwards, we had a massive trend change, and we can measure how far it went up from there on, right? So from there on, it went up to 64% higher. So this is really important, this chart pattern, and it's really useful when looking at all chart patterns to switch between charts. So you want to switch between the line chart and the candlestick chart and vice versa. This chart pattern is called a reversal diamond bottom, and it's quite a rare one. We don't really see many of these, but I chose to include it as they're very, very significant. Whenever you see one, the likelihood that that it will play out as it's meant to in the textbook is very, very high. And the reason it's so high is because they're just so rare. We rarely see them. And we had one of these in Bitcoin between 2019 and April 2020. So it took a long time to play out. It took, quite a few months, just over 4 months to play out. And as we can see here, we have a run up, and then we have the flash crash, the March 2020 flash crash caused by the pandemic. And then the price went up and it came to this kind of center point here. It came up, and then this is the crucial bit. It's a very, very small detail that's easy to miss. But it came up, broke through this trend line, which is a long trend line, right? A long lasting trend line. It tested it, right? It made a higher low, and then it continued on in this new direction, okay? So the previous direction was down. Well, it's a weird one because it's an up, down, and then up pattern. And the same can happen in a bearish sense as well, where it can go down, up, and then down again. So when you see one of these patterns, they are quite high probability patterns, and they're ones that should really be taken notice of. So we've just looked at 3 reversal patterns. We're now going to be looking at continuation patterns. Now, this is one of the most common continuation patterns. This is a bullish triangle, bullish ascending triangle, and it's marked by these. You need at least 2 points to make it. So you have a low here, right? And then you have a series of higher lows here. So we can draw this ascending trend line, and then it's marked by a flat top. And what makes it even more likely that it will turn out as it should do is when we have a breakout, right, above the flat top, and then the price comes back down to test this top, which was previously resistance. It was resistance here, it was resistance there, and there, and there, and now it's come up and it's come back down to test it. And then that's just serves as like a confirmation that this pattern is actually valid. And we can see from there on, the price just rallied upwards really, really strongly. Now, with these patterns, one important thing to bear in mind is that a lot of people, when they draw them, they think that it's just going to go on in this pattern and zigzag all the way to the apex. But that very, very rarely happens. Most of the time, with most of these I've seen, and I've been trading since 2013, I've seen a lot of these chart patterns. They usually break out around 60% of the way to the apex. So, you can just visually see this. This is around the halfway point of this triangle is around here, and this is about 60% towards the apex. So it's usually between 60 to 70%. What happens when, in my experience, what happens when the price just continues to get tighter and tighter and tighter all the way to the end of the apex? Like 9 times out of 10 when that happens, it's going to be an invalidated bullish triangle, which will result in, maybe it will pump up a little bit outside of it, but then, 9 times out of 10, it will just come straight back down to the downside. So that's one thing to bear in mind with these ascending triangles. The price breakout has to happen between 60 to 70% of the entire triangle, right? And then to make it even more likely that it is actually valid, right, the price needs to come back down, test the previous resistance as support, and then bounce strongly off of it. And that's what we have here. Here we have another continuation pattern. Now this one is called a bullish measured move. And it's basically a series of, there's 3 elements to it. So you have a channel, a trending channel, and then you have a small sideways movement, right? And then it continues upwards in its original direction. Now, the important thing, the crucial thing with this is that when you have this small sideways movement, right, you're going to have a high and a low, and that's going to mark the beginning of your sideways trend. Now, what you can't have happen is you can't have the price come back down and make a lower low that's significantly lower than here. It's okay if it's a little bit lower, but if it's like all the way down here, then that invalidates this pattern. Now this pattern is a really beautiful one because we have a nice trend upwards. It makes one sharp low and then it goes up, it goes sideways a bit, and then it breaks out. And once it's broken up here and come up here, that's when we can see that the likelihood that this will continue much further upwards is very, very high. Okay, so again, the thing to remember with this is that during this sideways pause, we cannot have a really strong move downwards, a really low low that is far below this one. That cannot happen. Here we have another continuation pattern. Now this is a descending triangle. It's a bearish continuation pattern, and it's marked by a series of higher highs and flat lows. So the lows are all fairly flat, but the highs are always lower. And as we talked about with the bullish ascending triangle, right, what signifies that this is actually going to be a valid move, is that the breakout needs to happen between 60 to 70% of the entire move. So if it takes all the way until it gets to this apex to break down, it's probably going to be an invalid bearish triangle, right? It will probably go to the upside and make new macro highs, right? So that's one really, really important thing to bear in mind with this chart pattern. This chart pattern is a bullish pennant. It's a continuation pattern, and it's marked by a series of higher lows and lower highs. Okay, so it's basically a continuation pattern. We have trending upwards movement here, and then a pause, and then it continues on its way. Okay. This is a bear flag. Now, this is a bearish continuation pattern, and it's quite an interesting one because when you're in here, looking at it, it looks like it's actually going to be a reversal pattern. So we have a clear downtrend here, all the way going down here, and then it starts going sideways. And what do we have? We have a series of mostly higher lows and higher highs. But it's actually very bearish. Okay, this is a very, very high conviction bearish pattern. And when you see one of these, what usually happens is the downside move from the local top all the way down is equal to this move here. Okay, and to illustrate that, we're going to copy this line and we're going to paste it, and we're going to move it like this, right? And you can see that it moved all the way down like this. So, this is a very, very high conviction bearish chart pattern. Another bearish pattern is the bear triangle. Now this is marked by a series of higher lows. So we have a low here. Yeah, there's some wicks that go down, but the general trend is the low here, a higher low, a higher low. Okay, and then we have a series of lower highs. But it is in fact bearish. As we can see, it broke out to the downside, and it's a continuation pattern. Okay, you can see that the market is trending down here. It consolidates sideways into this bearish triangle, and then it continues on in its original direction down. Here we have a bull flag, a continuation pattern to the upside. So it's marked by a series of lower lows and lower highs. Now you've got to really be careful with these ones because it can trick people into thinking that the market's going down. Like if we look in here, zoom in here, it looks like a downtrending market. But if it happens after a strong uptrend, okay, more often than not, it's a sign of continuation. Here we have just a simple parallel channel. Now these patterns, they can be quite fun to trade and quite easy to trade for those who like trading low time frame. And they're easy to trade because you can literally see where you should place your buy and sell orders. Now you have to be careful because as we can see, this is the general sideways trend. These are the boundaries of the general sideways trend, but it can deviate above and below it a bit. So you have to bear that in mind. But we can see here that, if you just buy here, sell when it gets to here, buy close to this line, sell at this line, buy close to this line, okay, sell up here, then you're going to do quite well with this. But you just have to bear in mind that it can overshoot a little bit, both to the upside and to the downside. And you're not really going to see that this is a channel until, it's really started to establish. So not till it's gotten to around here. Okay, that's when you'll start seeing it's a channel. But, even then, you can still have quite a few nice moves inside this short trading range. So this is really good for short time frame trading. So anything from 5 minutes up to 15 minutes generally. But even longer term trading, when during a bear market, there's often periods where the price just goes sideways for weeks and months. And you can use these strategies in terms of as part of a swing trading strategy during those kind of markets where the market just goes sideways for many weeks or many months. You can just draw these two parallel lines, right? Once the trend is established, and just set your buy orders here and set your sell orders there. In this tutorial, we'll be talking about indicators. We'll be talking about which ones you should use, how you should use them, and the limitations of indicators. Now, you may have noticed that I don't really speak about indicators that much in this course. And the reason that is because I actually don't use a lot of indicators in my daily trading. There are some indicators that I use very heavily and that I really like using, that I find very useful, but these are few and far in between, okay? Most indicators, they don't really give you any added value. They don't give you anything that you can't get just by looking at the charts. And indicators can be helpful to new traders, but new traders have to be very, very careful that indicators don't become a crutch. I know when I started trading, right, when I was first starting as a trader, I had loads of indicators. I had at least 5 indicators on the chart, at least 5, sometimes more. And then as I became more experienced with trading, I learned that I didn't actually need them. And it was giving me too much information. Okay, as a trader, you really want to go on an information diet. You want to be very, very careful about the information that is presented in front of you. Because oftentimes, if you have too many pieces of information, it can be contradictory and it can make it harder for you to make a decision. But I'm going to go over the indicators that I think are useful and how you should use them. So the first indicator we're going to cover is my all-time favorite indicator, and it's an indicator I've built a number of strategies around. And this indicator is the moving average, just a simple moving average, very, very simple. So you just type MA in indicators and strategies and you click it. Okay, and we have a moving average up here. And the way you use this is its default is 9, but you may not want 9. You may want to change it. And there's a number of moving averages that are quite useful. Okay, so these moving averages are the 100 period moving average, the 50 period moving average, the 200 period moving average, the 21 period moving average, and the 34 period moving average. And these ones are the ones that are most useful when it comes to trading crypto. And that's on a variety of time frames. So right now we're on the monthly time frame. So let's go in a little bit. I quite like the weekly time frame. That is a very important one for crypto. And we're going to change this moving average from 9. We're going to change it to 50. So we go to inputs and then we go here where it says length and we change it to 50. And I am not too fond of this color, so I'll change it to this one here. Okay. So that's the 50 period moving average. So the reason this indicator is so useful is because it's not like most indicators. Okay. Moving average is calculated by looking at the average price. Okay, so when I say price, what price am I talking about? I'm talking about the closing price. You can change it, so you can set it so it's the open price, the high price, the low price, but it's best if you just leave it at the close price. So when I say close price, what am I talking about? Well, if I go on this candle here, 3rd January 2022, okay, you can see up here, it's changed now because I've moved my mouse off of it. But if you look up here, right, keep your eye on this and I'll go back to it, okay? So 3rd January 2022, you can see that the closing price is 41,875.81 cents, okay? So it's taking that information and it's making an average out of it over 50 periods. So over 50 periods, the average for this moving average on this day is 48,376, okay? So it's looking back, it's averaging it out over time. That's why we have, whilst the price chart is a zigzag, the moving average is a nice smoothed out line. So you can use that to your advantage. The way you can use that is that you can see that when the price deviates from the average, then something is different. That's a trend change. And we can quite easily see this on here, okay? The price was trending upwards. Bitcoin's price was trending upwards from May 2020, okay, all the way through to here, through to the 12th of April 2021. Then it started trending downwards, but it was still in a general trend, a general uptrend, okay? And it was able to maintain that trend all the way until January of 2022, okay? And that's when it deviated from the trend. So if we close this, if we turn this off, it's not clearly apparent, okay? It's not clearly apparent when the trend deviation occurred. But when you turn it back on, you can clearly see, so it was maintaining the trend all the way up here. It looked like it would break from the trend when it got to down here, but it didn't. It held it, and it went up, and it kept on maintaining the trend until it got to here. And this is where it broke the trend, okay? And we can also see here that this was the point where it tried to regain that trend, okay? This moving average line acted as a form of resistance. It was a resistance line. And it was at that point where it tried to regain the prior uptrend, and it clearly failed, that the market just reacted very, very negatively, and the downtrend got even worse. So this is the power of just one moving average, okay? When you add more moving averages, things get even more interesting. So we're going to add one more moving average. So let me just add it here. And we're going to change the color to red. And we're going to change the length to 200. And now we're going to look at different time frames, okay? So right now we're on the weekly time frame. Let's see what the 3-day time frame. Well, first let's look at the 1-day time frame. 1-day time frame. So we can see that the 1-day time frame, it can be a pretty good indicator of bull and bear trends, okay? But if you look at something like this, it can get you into, quite a lot of trouble. You can get in here, okay? Getting in April 2019 at $5,000, okay? And then getting out when it crosses under at $8,000. That's a nice trade, okay? But then we have all of this. Now I know it's a black swan and it's something that people didn't expect, but this moving average combination would have gotten you back in again at $9,500, okay? And then out again at $7,000, only to get back in again at $8,000. Now, it doesn't matter what combination you use. Every strategy, not just moving average strategy, but every trading strategy will have periods like this where the trading is just pretty crazy. It goes sideways and you lose money. But from an investment standpoint, this may not be very good for you. Okay, if you don't really want to trade too much, if you don't want to invest too much, if you don't want to spend too much time doing that, maybe something that's more smoothed out would work better. And that's why you really have to look at what time frame works best for you and your lifestyle. Because if we look at the 3-day chart, the 3-day chart is much smoother. Okay, if you traded this using the 3-day chart, the 3-day crossover, right? When this crossed over, when the blue line crossed over the red line, Bitcoin was at around $10,000. Okay. Now it did go down. It did go down a fair bit. Let's see exactly how far down it went from there. If you would have gotten in here. So it did fall 60% in the flash crash. But, you know, that is a flash crash and these things happen. These are black swans. But it did go up. It did go up over 300% from that point before it signaled to get out. So that is a very good swing trade, or that is a very good active form of active investing. To get in at 10,000 and to get out at 30,000, I mean, you know, that's a pretty good trade for Bitcoin, which, as we know, Bitcoin doesn't move very much nowadays compared to other cryptos. So in terms of active investment, that's a pretty good return on your money. Plus, you miss out on all of this noise here that you would have been caught up in had you traded using the 1-day chart, which was much more noisy, much more noisy. Okay, going in, then out, then in, then out, and in and out. You know, it all depends on your time frame and what works best for you. Now we're going to look at the relative strength index. So this indicator here, it's an oscillating indicator, and it oscillates between high and low values. So a high value is anything that's over 70, and a low value is considered to be anything below 30. So when it's above 70, right, the asset in question is considered to be in an overbought condition. So when something's overbought, that means that the buy volume relative to the norm is higher than usual, okay? And that a reversal is likely. And when it's oversold, that means that the selling volume, the volume of sellers, is higher than the norm, and it's likely to reverse at some point. Now, you have to be very careful when you use this indicator. It can be quite good in terms of gauging market sentiment, in terms of gauging, you know, the strength of a rally or the how long a decline is going to continue for. But it should not be used on its own to trade, because as we can see here, so this was October 2020. You know, if you just traded this with the intention of selling whenever the price gets into overbought territory, okay, and buying in oversold territory, then this would have said to sell here. It would have said, yeah, sell at 12K during October 2020, you know, and if you would have done that, then you would have missed this entire move all the way up to 19K, and it just went on and continued going up. And this is what you should bear in mind with this indicator and all oscillating indicators. All oscillating indicators basically have this problem where they can be at extremes for a very, very long time. And if you trade on them, if you get in or out based on the extremes, then you could miss a lot of the move. So it's something to bear in mind. It's a good indicator of market health, but it should not be an indicator that you use solely for your trading decisions. Okay, it should be combined with other things like, you know, combining it with the moving averages, or combining it with support and resistance levels, or combining it with Fibonacci levels. It should be always used in conjunction with something else, as should all indicators. You should never use any indicator just on its own, but this is especially true with the relative strength index. The indicator we're going to look at now is the volume. So we just type in volume and then we get that. and it's these bars at the bottom. So I'm just going to make them nice and big so it's easy for you to see. Okay, here we go. So the thing with volume, it can be quite useful when you're looking at trends and trying to get an idea of when the trend might reverse, when it might change its direction and go from either bullish to bearish or bearish to bullish. And if we look at, if we look back to October of 2021, we can see something quite interesting here. So we can see that Bitcoin made a high of just over 67K on the 20th of October. It then started to come down, and then it went back up and it made a new all-time high of 69K on the 10th of November. And, you know, if we draw a line here, and I'll make this line green because it's trending upwards, we can see that we made a higher high here. But it's not the entirety of the story, okay? If we look at the volume, we can see a different story emerging around the same time. So we have increasing price, obviously, but the buy volume is clearly in a downtrend. Okay, that's clearly downtrending buy volume. You have a high here and then a series of lower highs. You have a lower high here, a lower high here, a lower high here, whilst the price is going up. And when this happens, this is called a divergence. So there is a divergent activity between the price and the volume. The price is going up, but the buy volume is going down, whilst the sell volume is remaining fairly consistent. It's fairly flat. I'll put another line on here just to illustrate that for you. And we'll make this line white. The sell volume is fairly consistent. The price is going up whilst the buy volume is going down. Okay, so that means that the sellers are gaining control. And then if we look at the RSI as well, we can see that the RSI is moving downwards. So it's going from oversold, right, and it's declining. So when you add all of these pieces of information together, right, increasing price, declining buy volume, sell volume that remains the same, and an RSI that is falling, that presents the case that the price is about to go down. And this illustrates the power of indicators and how they should be used. Because if you was to just use the RSI and go off that, then that would be insufficient in terms of getting an idea about the general direction of the price. If you were to just use the volume without anything else, then that wouldn't be enough. But by using these three pieces of information, okay, we're using the price, we're using the volume and the RSI, and we're combining them together, it's more evidence to build up a picture for your case. So when you're trading, you should think like a lawyer. You're building up evidence for your case, right? And that's what we want to do as traders. We want to build up evidence for the case that we should be bearish or bullish. And that's how volume can be useful in your trading. It's another piece of evidence. Fibonacci is a great tool that traders and investors can use in order to get an idea about potential support and resistance levels in the future. Fibonacci ratios occur in everyday life and are visible everywhere. They are in nature in the form of fractal shapes of plants and animals. They are in the faces that people find most attractive as they adhere to Fibonacci ratios. And these ratios occur frequently in things that can be quantified in human societies, such as financial markets. It's not clear why this happens. Perhaps it's something to do with the way our brains perceive information. It could be the way the universe works, or it could simply be a self-fulfilling prophecy where it happens because people expect it to happen. Whatever the cause, it's clear that it has a big effect when it comes to markets. In this tutorial, we're going to learn about the Fibonacci tool, and we're going to learn about how we can use it as traders and investors to get an idea about potential support and resistance levels and even potential price targets. So to start off, what we need to do is we need to click on these 4 lines here. It might not show on yours because I use this tool frequently. So if it doesn't show, if it's not immediately here, you just click here and it's the top one. Okay. So you click on it, and then what we're looking for is a major swing high and a major swing low. But the beauty of Fibonacci is that it works on pretty much any time frame. Okay. So a lot of indicators and a lot of technical analysis tools, they only work on a specific time frame. Some only work on the long term. Some only work on the short term. But the beauty about Fibonacci is it works on pretty much every time frame. Okay. So what we want to do is we want to draw it from this swing high here in December 2017. And we want to drag it down to the swing low. Okay. And to give us some perspective, because it's all very well doing this in retrospect, okay? To give us some perspective, let's imagine that we are here, okay? Let's imagine that we're here. We're in February 2019 and that none of this has happened. So to clearly illustrate that, right, I'm going to put this line here, okay? And on it, I'm going to write you are here. Okay. So we're here, and what we've just witnessed, because we can't see any of this, we can't see into the future, right? What we have just witnessed is that we've had a major capitulatory low. This is clearly a capitulation. Price has come back up, and then it's come down, and it's made a series of higher lows. It made a higher low here, it made a higher low here, it made a higher low here. But the main one is this one, okay? This is the main one. So it looks like the market has bottomed and it's starting to go up, okay? So why would we draw the Fibonacci retracement? Well, the reason we draw it is because we'd want to see potential resistance levels in the future and potential support levels once, you know, the prior resistance levels have been broken through, okay? And we want to see that so we can see potential take profit levels. And we can clearly see here that the price ran up all the way up here. Okay. Let's see how, by what percentage it ran up from this low. So it ran up all the way 325% before it encountered significant resistance. And where was it that it encountered significant resistance? Okay, it was at the 0.618 level, which is a major retracement level, okay, in Fibonacci. It encountered major resistance here, and then it retraced a bit. But as it retraced, what happened? As it retraced, the 0.382 level was support, temporarily at least, okay? So if you were trading this, you could have made 319% on the upside, okay? Take some profit, and then on the bounce, make almost 30% again. This is the power of Fibonacci. It's incredibly powerful. It's something that really should be in your toolkit because it's clear that it has a huge effect on not just the crypto market, but you can see stuff like this in all markets on all time frames. So moving on, let's see how we can do it in a different way. So this time we are going to go from a swing low to a swing high, which is this high here. So in this scenario, we're going forward in time a little bit. We are now here after this move has happened and it started to pull back. We want to know where there is a potential support level. And again, this comes all the way down and it finds support between the 0.618 and the 0.702 levels. Okay. And when it finds support there, we have a 44% bounce. I mean, it does go all the way up to 45, almost 46, but nobody ever sells the wicks. So let's call it a 43% bounce, okay, from this level here. That's quite a significant bounce. But that's not all. If we really zoom out, because these things are fractal in nature, remember. If we really zoom out, what do we see from the first one we drew? Okay. We see that the 3.618 Fibonacci level basically marks the exact top. Okay. Now, obviously you're not going to know whether it's going to be the 2.618 level or the 3.618 level or the 4.618 level. There's nothing in this that will tell you where it will be. Okay. But we know that anything that's 618 is usually a major reversal area. Okay. So just knowing that piece of information alone, you can be prepared. You can, for instance, use this as part of your strategy to sell a little bit on every 618. So you can sell a little bit here, you can sell a little bit here, you can sell a little bit here, you can have a sell order here. Obviously, that didn't trigger in 2021. But having this as part of your toolkit is very, very, very useful as a trader, because these levels, they really do matter. They matter a lot. And, you can see that if you just set a few of these, use this information here to set limit orders, it can complement your strategy. As this is fractal in nature, we can see that it works on any time level. So let's look at this one here. So we're going from this swing high here in May 2021, and we're going to this swing low here, and we want to look for potential resistance levels on the way up. So this time we are here after this whole move has happened. Okay. And what do we see? We see there's resistance at the 0.618. We see that there's resistance at the 0.702 here. Okay. And there's resistance almost at the 0.786. So there's resistance levels along all of these levels here. These are all resistance levels. This is really, really important information that is hidden in here. And it's basically outlining possibilities. Okay. They're obviously not certainties. No form of technical analysis can predict the future, but they are highly likely areas of resistance. This is what it's basically outlining for you. And what I like to do with this is I just basically like to get these horizontal lines, and I like to mark these off as potential resistance levels, and I incorporate that into my trading. And as you can see clearly from this, these resistance levels and support levels continue on, and they flip. Sometimes it's support, sometimes it's resistance. So we had resistance here, and then if we zoom in, okay, between the 0.7618 and the 0.702, this is a support and resistance level, okay? And then we break up, we get to the 0.786 over here. We come back down below. Here's another one. Just saw that one there. The 0.5, that served as support, quite strong support actually. It served as support. Then we came back up. The 0.618 was resistance, okay? Came back down, broke the 0.5 support over here, see? And then we came back down. Where did we find support? We found support at the 0.382. Let me just extend this so that you can clearly see this. That one. This one. Here we go. So you can extend this all the way. So now it's clearly visible. Okay. So see how it found support at the 0.382. Then it broke resistance at the 0.5. Then it found resistance at the 0.618. It broke that. You see how these levels just carry on repeating, and this goes all the way back to here. So, and this occurred over a long time period. This was from May 2021 through to, I mean, this just goes on and on and on. Through till January 2022, these same support and resistance levels, they kept playing out. So you can incorporate this into your charts, and you can have these, you should just have these on your charts all the time, to use as buy and sell levels. It's very, very handy. In order to be a consistently profitable trader, it's important that you have a set of rules that you always follow. Having rules is one of the things that sets traders apart from gamblers. These rules need to be tried and tested in a variety of market conditions in a practice called backtesting, where a trader tests their strategy using historical data. Backtesting can be done manually or via an automated process, depending upon the strategy and its complexity. Doing this provides a trader with vital information about the kinds of profits and losses they can expect in different market conditions. When creating a trading strategy, you should consider your trading style. Do you intend to trade on lower time frames, like the 1 minute chart to the 1 hour chart, or higher time frames, such as the 4 hour to the 1 day chart? Your temperament, as well as your lifestyle, can help you decide which time frame you prefer to trade. If you can dedicate a set period of screen time on a consistent basis, and you feel that you can handle the fast pace of lower time frame trading, then it may be for you. Trading on the lower time frames is often referred to as day trading or intraday trading. This style of trading will give you many more opportunities to trade. However, you will be trading for much smaller profits, as there will be less time for big moves to take place. As all markets spend most of the time in a trading range, a range trading strategy would be best for this style of trading. If you prefer not to be sat in front of your screen too much, and would rather trade at a more relaxed pace, then you may prefer to trade the higher time frames. Trading on a higher time frame gives you the freedom of being able to do other things whilst your trade is in play. It also allows you to trade much bigger moves, which could potentially net you more profit. The downside is that you'll need to keep your positions open overnight if you're swing trading. Doing so exposes you to greater potential losses. Both time frames have their benefits and drawbacks. It's important not to just choose a time frame for your lifestyle, but also for the market, as different time frames suit different market conditions. In a slow, sideways market, a low time frame trading strategy works best, as there will be very few big moves, so the focus should be on small profits. In a trending market, the focus should switch to higher time frame swing trading, which can often yield far higher profits for far less time spent at a computer trading. The best strategies for trading on the lower time frames are range trading strategies. These strategies focus on a narrow trading range that is often based on key support and resistance areas that the price bounces between. Prices can move up and down in a predictable range for a long time. By charting out the upper and lower bounds of the range, we can decide where to place our buy, sell, and stop loss orders. We will cover these orders in more depth later in the course. Trend trading strategies are best for higher time frame trading. Of all the different strategies I've tried, strategies that use moving averages are some of the best when it comes to trend trading. In a moving average strategy, entries and exits are executed based on 2 or more moving averages, as well as where the price is in relation to those moving averages. In this example, the strategy is as follows. Buy when the 50 period moving average crosses over the 200 period moving average, and sell when the 50 period moving average crosses below the 200 period moving average. The benefit of this kind of strategy is that it smooths out the noise, so it's able to keep you in the trade for longer. The downside is that entries and exits are always in the middle of the move, so you won't be able to buy at the bottom or sell at the top. However, this isn't necessarily a downside, as it will be far easier to get in and out of a trade in the middle of the move as opposed to at the top or bottom of the move, as market tops and bottoms usually happen very quickly, leaving little time for an order to get filled. Momentalt altcoin strategy. My absolute favorite strategy for trading altcoins during the bull market of 2021 is what I like to call the Momentalt strategy. At the start of 2021, I created a separate trading portfolio as an experiment that grew to over 7,300% by the end of the year using this very strategy. As the name suggests, this strategy is all about momentum, so it only works in a bull market. The premise of this strategy is that coins that start rising first will continue to rise because in a bull market, people prefer buying coins that rise over coins that are flat or are falling. This strategy should never ever be used during a bear market due to the lack of consistent momentum in the altcoin market. This strategy is super simple, it requires no chart pattern analysis, and it only needs a couple of hours of trading each week. Step 1. Create a watch list of altcoins. During the bull market of 2021, I used a watch list with 52 coins in, though you can add as many as you like. Whilst you can see many of the coins that are in my list, it's super important that you don't just copy these coins, as many of them simply won't be relevant during the next bull market. You really need to take the time to craft your own watch list based on what's popular and most importantly, what's most highly traded during the next bull market. Step 2. Allocate a percentage of your portfolio for trading this strategy. During a bull market, you should have your main portfolio that is comprised of high quality, well-researched coins that you should hold for the duration of the bull market. In addition to your main holdings, you should allocate a percentage of your portfolio to swing trading, as this can be very profitable during bull markets. During 2021, I allocated 20% of my total crypto portfolio to a separate portfolio where I traded this strategy. The amount you wish to allocate is entirely up to you. Step 3. Add all the coins in your watch list to a brand new chart on TradingView. I call this chart Momentalt, but you can call yours whatever you like, as long as you can find it, that's all that matters. After setup, it will look like a jumbled mess of lines, so you'll need to set the chart to line chart style and click on percentage so that the right axis shows coins based on their relative value. Right-click on the axis and tick Symbol Name Label. This will show the name of all the coins on the axis, so it's easier for you to tell them apart. Step 4. Pick one day out of the week to trade. It should take you no more than 2 hours a week to trade this strategy. Pick one day that suits you best where you can consistently allocate the time needed to do your trading. This is your Momentalt day. Step 5. Open your Momentalt chart and click on 5-day in the bottom left corner. Then note down the top 5 coins on the chart. These are the ones that have risen the most. Once you have picked your 5 coins, you simply buy. Always spend an equal amount on each one and hold them for a week until the next Momentalt day. Step 6. Repeat each week. On your next Momentalt day, simply repeat step 5. Make a note of the top 5 coins in the Momentalt chart. If you're currently holding a coin in this week's top 5, you can keep them until they are no longer in the top 5. Any coins that you're holding that are no longer in the top 5 should be sold and the proceeds should be rolled over into this week's top coins. Step 7. Stop once Bitcoin enters a bear market. Keep repeating the process until Bitcoin falls below the 50-week moving average on the 1-week chart. When this happens, you should stop using the Momentalt strategy and sell your 5 Momentalt altcoins for cash, as crypto will most likely be entering a downtrend. Check out the alerts section of this course to learn how you can set up an alert that will tell you when this happens. Even though I only invested 20% of my portfolio into the Momentalt strategy at the beginning of 2021, by the end of the year, my Momentalt portfolio made far bigger profits than my main portfolio, which was focused on long-term holdings of select altcoins. As the Momentalt strategy is optimized for coins that are uptrending, it ensures that you're only holding coins when they're going up. As soon as a coin stops going up relative to other coins, you can swap to one that is, thus reducing the length of a drawdown in any particular coin to no more than a week. Using Bitcoin's 50-week moving average as a barometer of market health can protect this portfolio against market-wide drawdowns where all coins fall in value. Backtesting is an absolutely essential part of trading and is something that must be done before even attempting to trade a strategy. There have been many occasions where I have created a strategy that looked great on paper, only to see it fall apart during the backtesting stage. By backtesting the strategy first over a large data sample, it helps me to avoid substantial losses. Every strategy should be backtested on a minimum of 100 trades per asset, per market, per time frame, as a strategy that works well on Ethereum on a 1-hour chart during the bull market may fail miserably on Bitcoin on a 4-hour chart during a bear market. In this tutorial, we will be learning about manual backtesting using this backtesting calculator that is included in this course. Backtesting is absolutely essential when it comes to trading and investing, as the information that it can provide traders is invaluable when it comes to building a consistently profitable trading strategy. Manual backtesting can be quite time-consuming and tedious, but what is even more tedious is losing money week after week, month after month. Backtesting can help to prevent this, as it can highlight potential problems in a risk-free environment. It's a bit like flight training for pilots. Aeroplanes are expensive and human lives are precious, which is why pilots undergo extensive simulator training, testing the flight dynamics, learning about the controls, and about how the forces interact with the plane. As traders and investors, we need to learn about market dynamics and how trading strategies can perform in a variety of markets. The strategy we're going to be backtesting today is a simple moving average crossover strategy using the 200 period moving average and the 50 period moving average, and we're going to be backtesting Ethereum on the 1-hour chart, Ethereum versus BUSD on the 1-hour chart. And in our backtesting calculator, we can see the strategy conditions. So we buy when the 50 period moving average goes above the 200 period, and we sell when the 50 period goes below the 200 moving average. And that condition is the same for our stop loss. So when the market goes against us, we will get out when the 50 period goes below the 200 period moving average. And in here we have the pair we're trading, we have the interval. And once we've filled out this data series and we have a nice amount of data, it will show our total trades and our win rate. And the more data we have, the more accurate the win rate will be. And what you should do is when this is full, you should duplicate this so you can create a new one. And then you can try it on, say, Avalanche, or you can try it on Binance Smart Chain or Polygon. It's good to try the same strategy on different assets to see which works best. And you also want to try it on different time frames, and you also want to try it in different markets. So the market we're going to try it on now is going to be kind of pre-bull market, so around 2020. But you should try it in a full swing, full-on bull market. You should try it in a bear market. You should try it in a sideways market. It's good to try your strategies in as many markets as possible, because you don't want to be trading, trading the strategy in a bear market if it only works in bull markets and vice versa. And the way you will find that out is by sufficiently testing it on a sufficiently large amount of data over many different markets. So that way you will have a good idea about how this strategy can perform. And you can use any strategy, really. You don't have to use a moving average strategy. If you have a strategy of your own that you really like, just backtest it and use this to get an idea of how successful that strategy is. It doesn't matter what the strategy is, as long as it can be tested, as long as it's not a discretionary strategy. The only condition is that it has to have rules. Okay, it can't just be, oh, I want to buy when I feel like it, or I'll buy when CoinDesk says something really good about this coin. No, it has to have set rules, set parameters, and if you don't have that, you don't have a strategy. If you have rules, if you have set parameters, then you can backtest your strategy and you can trade it. We're going to start our backtest in 2020 because that was a very interesting year. So we'll go and open up the TradingView time machine and we'll press go to so we can go to 2020. So here we are. Okay, so we need to find an entry point where there's a crossover. And we found one here. And what I like to do with these is I like to get a vertical line out and I like to just mark it here. And the reason I do that is because I'm going to be going from this window to this window and back. So it's nice to keep track of where the crossovers happen for the backtest. So our first entry point, let's get it exactly where it would be, is here, 27th January at 5 o'clock in the evening. Now, this brings me on to an important point about backtesting. Well, there's 2 points. The first one is you should be very realistic with it. It's basically a digital representation of how you would like to trade. So you have to factor in your lifestyle. So you have to think, am I going to be around? Am I going to be able to trade at 5 o'clock in the evening? You probably will. Most people are awake and have access to their computers or their phones at 5 o'clock. But if you see a trade in your backtest at 3 o'clock in the morning, you have to think, are you going to be able to trade that? And if the answer is no, in order for your backtest to be to accurately represent how you will trade, you should not include that in your backtest because it's something that you just wouldn't trade. And another thing is you have to be realistic when it comes to entries, because we'd all like to buy at the bottom and sell at the top, but you're probably not going to do that. Nobody does. So what I like to do with backtesting is I just like to I look at the candle and I use the midpoint as the entry price. Okay, so this is our first trade. It's on the 27th of January. So we will put it in here, 27 of the 1st. And we will put in 169 as our buy price, 169 here. And let's move ahead in time to see where we would exit. I'm dragging this along with me as I go. So this is a very, very nice trend. Very, very nice run. Almost got taken out here, but it kept us in the trend. Okay, so this is our exit point. Let's zoom in to see where we exit, where we get off this train. So our exit point is here. This is at 2 in the morning. Well, I mean, I don't know about you, but I don't like to wake up at 2 in the morning. I usually wake up at 6. So we'll exit at 6 and we will exit here at 261. Okay, so that's a very nice trade. $1,089 profit, 54.44% gain. And as you can see here, our trading balance has been updated. So let's go on to the next trade. Let's see what the next trade has in store for us. Okay, so we enter here, 271. And where is our exit going to be? Yeah, this does not look good. So our exit is down here. Let's call it 247. So we've made a loss on that one. Small loss, 8.86%. Small in comparison to the gain we just made. Okay, let's look at the next trade. And as you can see, the win rate has already been updated. So we got a 50% win rate, one losing trade, one winning trade. So the more trades you have, the more accurate this will be. You want to get as many trades as possible. Okay, so we have an entry point here. Let's get it. Yeah, this is. There we go. That's our entry point. Let's see what price that is at 231. So we enter at 231. Okay. Where is our exit? Uh-oh, not too good. Another bad trade. So let's zoom in and see where we get out on this candle here. So let's say 202. Okay. Yeah, this is just before the big flash crash Black Swan event of 2020. So at least we didn't get out all the way down here, you know. At least in this scenario, we are staying well out of this mess. And we get back in here at 9 o'clock, 148. Okay, let's see where our exit is. Not too good on this one. 129 exit. Now you have to bear in mind with these backtests that it's just, you're just doing this to get an idea of your strategy. Your real trading will be quite different, you know. In the same way that a flight simulator gives a pilot a very, very good idea of how a plane works and the flight dynamics and how the forces exert themselves on the plane, it doesn't compare to actual trading, but you know, it's very useful. It gives a pilot a lot of information. So here we have an entry 137. And that was quite a nice trade there. We have a nice exit. Let's call it 156. So if we look at our backtesting calc, we can see that the quantity of Ethereum we can buy has gone up. We started off at 1183, which was all we could buy at this price with our trading balance. And now we can buy 1566. And we are at a 40% win rate. And our trading balance is now $244, $2,443. Okay, so we have that's an exit there. So let's look for our next entry. Here's our next entry here, 16th of April, 172. And that is a very nice trade. So we get out here, zoom in, get a good idea of where we get out. $204. So basically what you want to do is you just want to build this up as much as possible. You just repeat this process until you have at least 100 trades. And then when you have 100 trades, you will have a very good idea about how effective your strategy is, how much profit you can make, your win rate, and you know, what kind of drawdown you can expect. And you want to repeat this process throughout many different kinds of markets. You want to try it on different intervals. You want to try it on different cryptos, and it will give you a good idea about your strategy. Right now, we can see that it's made us $898 in what, like 5 months. So that's not too bad. I mean, it could be better, but you know, it's not too bad considering what kind of market it was back then. So yeah, this is a really good way to get an idea of your trading strategy and how well it works. What attracts many people to the world of trading is just how liberating being a trader can be. Those who trade at home, commonly referred to as retail traders, have no boss to tell them what to do and when to do it. There's no need to be at a certain place at a certain time, and retail traders never have to ask permission for breaks or holidays. As the saying goes, with great freedom comes great responsibility. We all need limits in life, and as a retail trader, you and you alone will be responsible for setting your own limits. Traders at hedge funds or prop firms have risk managers who impose strict daily limits on their trading and prevent them from trading if they attempt to exceed a certain risk level or make too many losses in a day. Ceasing trading after a string of losses is especially important as it prevents losing traders from trying to get revenge on the market in a futile attempt to make back prior losses. As a retail trader trading from home, you won't have the safety net of an external risk manager who will stop you from trading. If you wanted to, there's nothing to stop you from losing all of your funds in a string of bad trades. That's why we retail traders need to have our own set of ironclad rules and trading limits that we stick to no matter what. This isn't optional, it's essential for those who want to become consistently profitable traders. Consistency is what's key here. There may be the odd occasion where breaking your rules and limits resulted in a profit, but if this is done regularly, then it will create a bad habit and reinforce the idea that not sticking to limits is okay. This will lead to more risk-taking, which will eventually result in a catastrophic loss. The reality is that the best way to be consistently profitable in trading is to trade just like a robot would. I know I'm talking to humans here, so it's difficult to do this, but it's important to trade in a way that's as systematic and rules-based as possible. Trading limits are most important after suffering losses, which are an unavoidable part of trading, but the negative effect they have on a trader's mind is undeniable. When traders experience a loss, it's tempting to keep trading in order to make the money back. We can get angry at the market and we may want to teach it a lesson in an attempt to prove that we're right. By having limits in place, we can avoid this death spiral of revenge trading which can lead to cascading losses. A great technique that many traders practice after experiencing losses is to turn off the computer and go for a walk or hit the gym. This is a technique I've used for years and it's had a very positive effect on my trading. When I remove myself from my desk and get some fresh air, it acts as a mental reset. Once I hit my daily loss limit, I won't trade again until the next day. Doing this helps to diminish the negative emotions associated with losses that can lead to better trading decisions during the following day. So now we're going to learn about the different order types on exchanges, and we're going to be doing it on Binance. And the way we do it is we go to trade and we go to spot. Now most crypto exchanges are laid out like this in terms of their trading screen, and there's a few basic things going on here. So this is the crypto that's being traded, Bitcoin versus USDT. This thing here is called the order book. So this shows all the orders that are going on, and we can see the price and we can see the amount of Bitcoin being traded and the total being traded at that price. So there's a lot of information going on here, and it can be quite useful because you can see where the buyers and sellers are and how they're interacting with one another. And this is the chart, and we have our volume bars here. And in the middle, underneath it, we have our controls for trading. Up here, this is where you choose what you want to trade. So it's laid out into different categories. We have BUSD. So everything here is traded against BUSD. And if you want to trade USDT pairs, you click USDT. There's BNB pairs. There's BTC pairs. So that's like Ethereum, Bitcoin, Avalanche, Bitcoin, stuff like that. And you just basically choose the pair that you want to trade. And you can search for whatever you want to trade. So for instance, if I type in Ethereum, it'll show Ethereum versus all the pairs that are available on Binance. And I want to trade Ethereum versus BUSD. So I just click on that here. Okay, and this brings up this window. So there's a number of different orders we can do. So I have some Ethereum in here, and what if I think it's going to go up higher to a certain price and I want to sell it? So right now it's just over $1,050. What if I think it's going to go to, let's say $1,200? Well, what I'd do is I would put that price in here. So I type it in, 1200, and then simply drag this along. So you select the amount of Ethereum you want to sell at that price. So you can select as much of it or as little of it as you want. You can either type it in or you can just drag this. But let's say I want to sell all of it at 1200. So that's done. And I simply press sell Ethereum. Okay, and that order is basically put through now. So it's not sold it yet because we haven't reached 1200 yet. But if we look down here in open orders, we can see that the order is waiting. So it's just waiting until the price gets reached and then it would trigger. So that's one order type. That's a limit order. The other type of orders we can do are stop limit orders. So they are slightly different to limit orders. And the way they work is kind of like a protective order. So I have some Ethereum here now and I intend to hold it. But what if it went down to like $900? I wouldn't be very happy about that. I might not want to hold it if it's going down. So in order to protect myself, what I would do is I would click on here on stop limit. And what you do then is you select the stop price. So the stop price is the price where, say there's a support level at $900 and you think if it goes below $900, it could crash all the way down to 800, okay? So obviously you'd want to get out as quickly as possible. So what you would do is you would put the stop price here of 900, okay? And the limit price is the price that it will trigger once it hits the stop price. So basically it's like a trading robot essentially. So if the price was to go down to 900, what Binance would then do is it would create a limit sell order for you at a set price. And what I like to do is I like to have the limit sell order quite close to the stop order. So in this case, I'll put 895, okay? So in this scenario, if the price of Ethereum went down to $900, Binance will immediately set a sell order for 895. Now you may be thinking, why not just set it at 900? Well, that can work sometimes, but if the price fell very, very quickly, it may not trigger in time. Okay, so the price could go right through 900, right? And then because the limit sell order is all the way up at 900, when the price is say at $890, that limit order won't get triggered. So it's always good to put it a little bit lower. I could even put it a little bit more low just to be on the safe side. So we'll put it at 890. Okay, so that should give it enough time to trigger and to take me out of the trade. And then you basically say how much you want to sell. Okay, so you don't have to do all of it. You can do as little or as much as you like, but I'm going to sell all of it. So once that's done, I simply press sell ETH and I press confirm. And this order is waiting. So I haven't actually sold it yet, but it's a protective order just in case the price was to fall. So now we're going to look at one of my favorite order types, and this order type is the one cancel the other order. So let's picture the scenario. So you've just bought some Ethereum and you think it's going to go to a certain price. Okay, let's imagine the price now is, what's the price now? $1,053. Let's imagine that based on our trading, based on our technical analysis, we think it's going to go to 1,500. Okay, so in that scenario, what you would want to do is you would want to do a number of things. You'd want to put 1,500 here. And that is your limit price. So that's where you hope it's going to go. But what if it doesn't do that? Well, if it doesn't, then what you'd want to do is you'd want to have a stop. So if it goes down to 900, okay, I'd want to get out. So I put 900 here, and then you want to put a limit price that it will sell at if it goes to 900. You don't want to put 900 because when the price is falling quickly, there may not be enough time for that order to trigger. So it's always good to put the limit sell order and in a one cancel the other order situation a little bit lower. So I'm going to put it at 890. Okay. And then I want all of the Ethereum to be affected by this order. So I'll drag the slider all the way up to the top. So this is how the order looks. If this is the positive scenario, if Ethereum goes up to $1,500, it will sell the Ethereum and I'll make a nice profit. I'll make $444 profit. If it goes down to 900, I'll incur a loss. Okay. But even though it will be a loss, it will be a much less bad loss than if the price went down much, much further. Okay, so that's why we do these kind of orders. These kind of orders, orders that you make when you are expecting something good to happen, but you put stuff in place just in case something bad happens. And then you simply click sell ETH. And it says here that the OCO order is created. So this order is waiting for us. And we have two orders. Here we can see that we have a limit maker order at 1500. So that's if the positive scenario happens. And we have a stop loss limit order for 890. That's if the negative scenario happens. So we are covered both ways. And that's why these OCO orders are so powerful. They are really, really useful when it comes to trading. There are 5 order types that you will find on most crypto exchanges. These are limit, market, stop limit, stop market, and OCO, which stands for one cancels the other. The two simplest order types are limit and market. With a limit order, the trader is specifying a maximum price they are willing to buy at or a minimum price they are willing to sell at. For example, if a trader sets a limit order for Ethereum at $3,000, then $3,000 is the minimum price that his Ethereum will sell at. A great benefit of limit orders is that when placed, they just sit on the exchange's order book until the buy or sell condition is met. Market orders are useful when a trader wants to buy or sell immediately. With market orders, the priority is speed and not price. For example, if Ethereum currently costs $2,500 and a trader wants to market buy ETH immediately because she thinks that it is just about to go up, her order may be split up into many separate orders with a range of prices that multiple sellers are willing to sell at immediately. Because of this, she could end up paying more than $2,500 per ETH, as the exchange's order matching system seeks to find willing sellers as quickly as possible, whatever the price. Buying or selling with limit orders gives traders a much finer degree of control over the buying and selling process. The downside is that traders who use limit orders have to wait for buyers and sellers to turn up who will trade at the specified limit price. Stop limit orders are a very useful tool when it comes to risk management. They essentially act as a safety net and can prevent large losses from happening. In this example, we can see that there is a stop limit sell order on Ethereum. There are two main components to stop limit sell orders. There's the stop and then there's the limit sell order. If the price of Ethereum reaches the stop price, the exchange will then automatically place a limit sell order at the limit price. I like to set the limit price a bit lower than the stop price. That way it's likely to get filled quickly, which is something you would want to happen if a sudden drop occurred. Setting the limit price too close to the stop price can often result in it not being filled, as the price can often fall faster than the exchange can place the order. This is especially true during sudden drops, where thousands of traders' stops are getting triggered automatically. You may be thinking why a trader wouldn't just set limit sell orders instead of stop limit orders. In this scenario, our trader just bought Ethereum so is expecting it to go up. Setting a limit sell order below the current price would result in the Ethereum being sold at a price lower than the trader would want. A stop limit order is ideal as a safety net, just in case the price goes down instead of up. A stop market order is similar to a stop limit order. The only difference is that when placed, the exchange will aim to fill the order immediately at any available price. This can be quite dangerous during a flash crash, as there may be far fewer buyers than sellers. Because of this, stop market orders should be treated with extreme caution, as a trader who uses them has little control over the trade price. OCO is an acronym for one cancels the other. These orders are extremely powerful and versatile as they bring a degree of automation to the trade. Because of this, they are my favorite order type. The way that they work is that they essentially combine limit orders and stop loss orders. Whichever one happens first will cancel the other. For example, Joe places an order on Ethereum at $2,000. He thinks he can make a 5% profit on it, so wants to sell at $2,100. Joe has identified a support level at 1970 and thinks that if the price goes down below that, then it could go a lot further down. Joe sets an OCO order with a limit sell at 2100, a stop at 1970, and a stop loss limit order at 1965. There are two possible outcomes to every trade: a losing scenario and a winning scenario. In a loss scenario, where the price goes down to 1970, Joe's OCO order would trigger. It would immediately cancel his limit sell order at 2100, and then set a limit sell order at 1965, and his Ethereum would be sold. In a win scenario, where the price of Ethereum goes up to $2,100, the opposite happens. The 1970 stop trigger would be cancelled, and the Ethereum would be sold at $2,100, netting Joe a nice profit. Risk versus reward is one of the most important concepts that traders need to think about. It's so important that it should be the deciding factor when a trader is considering entering a trade. A trader needs to know how much money is being risked for the expected gain. If the amount of money being risked is higher than the expected gain, then eventually this would lead to a trader losing all their money, as they will lose more when they are wrong than they will make when they are right. There are 5 main aspects to every trade. There's the entry price, the exit price, which is often referred to as take profit or TP, the expected gain, which is our reward, the maximum tolerable loss amount, which is our risk, and the stop loss, which is the exit price we'll get out at if the trade goes against us. Distance from entry to stop loss is the risk. Distance from entry to take profit is the reward. To be consistently profitable, reward should be multiples bigger than the risk, so that one winning trade can pay off multiple losing trades. Risk-reward depends upon many factors. The first thing to consider is your win rate, which you can figure out through backtesting your strategy. If you have a win rate of 50%, then you should aim to make at least twice as much on your winning trades as you lose on your losing trades in order to be consistently profitable. Even if your strategy has a low win rate, let's say 30% are winners versus 70% which are losers, you can still make a lot of profit so long as you have the risk-reward ratio right and you make more money on your winning trades than you lose on your losing trades. To clarify, let's look at 3 risk-reward examples of 3 different swing traders. In scenario 1, Alex has a £1,000 position size and a risk-reward ratio of 1:1, where 10% is risked to make 10% profit. After 5 losses and 5 wins, Alex breaks even, as he has lost £500 and made £500. In scenario 2, Bella has a £1,000 position size and a risk-reward ratio of 1:2, where 10% is risked to make 20% profit. After 5 losses and 5 wins, Bella makes £500 profit, as she has lost 500 and made 1,000. In scenario 3, Cameron has a £1,000 position size and a risk-reward ratio of 1 to 3, where 10% is risked to make 30% profit. In this scenario, even though Cameron was unlucky and experienced more losing trades than winning trades, with 7 losses and only 3 wins, as the risk-reward ratio heavily favours rewards, Cameron's trading is still profitable and he makes a £200 profit. Whilst these trade examples are an oversimplification and don't account for the effect that compounding gains or losses can have on a trading account, they illustrate the different aspects of risk and reward and how it needs to be tweaked to fit the win rate for traders to be consistently profitable. To get a true picture of your strategy's risk and reward profile, you should backtest your strategy. Backtesting is absolutely essential to see how compounding gains and losses can affect the risk to reward ratio over time. When trading altcoins, it's really important to consider the exchange's daily trading volume for the trading pair that you want to trade, especially if you're trading a low market cap altcoin. Many low market cap alts have very low daily trading volumes on some exchanges, sometimes as low as $100,000 per day, which isn't a lot when compared to something like ETH BUSD on Binance, which has daily trading volumes in excess of $500 million on a quiet day. If the daily trading volume is too small and your position size, meaning the amount of money you're putting on the trade, is too big, then you'll have great difficulty getting into the trade and, more importantly, getting out of the trade. You can find out what the daily trading volume of a coin pair is by going to a website like coinmarketcap.com. Click on the altcoin, then you can see the volume for the exchange and the trading pair. As a general rule of thumb, your position size should equal no more than 0.5% of the daily trading volume for that coin pair. If you're investing in the coin, then volume isn't as important, but for trading, which depends on timely entries and exits, volume is crucial. Another method I use to quickly gauge the trading volume of a pair is to look at its chart. A chart like this is referred to as a barcode. It looks quite unlike charts of highly traded altcoins like Ethereum, as the price moves are restricted to narrow ranges. If I see a chart like this, I will stay away from this trading pair, as it is one of the biggest signs of a low volume altcoin that will be hard to get out of when it comes to exiting the trade. Trading and investing can trigger fear and greed, which are some of our deepest and oldest emotions. These emotions are so old in humans that they predate language, so it's very difficult for us to overcome them. In prehistoric days when life was harsh, food was scarce, and every day was a fight for survival, this made perfect sense. These days, in the 21st century, it's seemingly irrational for these emotions to come into play when we're sat in warm, safe homes with full bellies, spending the day looking at charts on the screen. Yet, despite the irrationality, these emotions affect us traders in the same way that they affected our ancestors. I'm sure you've heard stories or seen films depicting angry traders who've lost everything, who smash their computer screens in a fit of rage as if that would somehow bring their money back. These aren't just stories. All traders and investors have experienced heavy losses and battle with the fear of missing out on a daily basis. When you multiply the emotions of millions of market participants, all looking at the same charts, it can result in huge bubbles that can defy all logic and reason. As individual traders seeking to be consistently profitable, it's important to be aware of the irrational emotions that are at play when trading, and to come up with techniques to not only set aside these feelings, but to actively go against them. Trading journals are an essential tool in a trader's toolkit, as they are a permanent record of not only our trades, but the thinking behind those trades. What isn't measured can't be changed, and this is so true when it comes to trading and investing. Scientists, in their quest of discovery and truth, write down everything, no matter how seemingly insignificant. Every finding, however small, is meticulously recorded in order to build up a clear picture of what works and what doesn't. As market participants, we should behave as scientists do. Losses and mistakes are an unavoidable part of trading and investing. Detailing those losses and mistakes and the thought process that were behind them can help us to avoid making the same unprofitable mistakes in the future. Likewise, keeping a record of the chain of thoughts and events that led to profitable outcomes can increase the likelihood that these green days can be replicated in the future. A trading journal can also serve as a way to track your progress as a trader. This can provide a much needed confidence boost during losing days, as you can simply open your journal and see just how far you've come. Backtesting is an essential tool to combat decision fatigue and analysis paralysis. These two states of mind can afflict traders and investors all too often. A series of backtests over different time frames and market conditions can give a trader the green light when it comes to trading and investing decisions. As the backtest provides traders with information such as tolerable loss and drawdown as well as expected profit. This information can give traders the confidence to push the button when needed, as the potential upsides and downsides of the trade are known beforehand. This is important, especially when it comes to high time frame trading, as traders need to make decisions very quickly. Spending too long deciding whether or not to enter or exit a trade can result in missed opportunities at best and large losses at worst. Backtests also serve to remind a trader to focus on the process of becoming consistently profitable rather than focusing on the outcome of a single trade. By looking at the results of a backtest, we traders can see that the individual trade really doesn't matter that much in the grand scheme of things. This can help us to close losing trades quickly and to take profits when they become available. Traders who haven't done the crucial work of backtesting will treat each trade as the be-all and end-all of their career, which will result in missed opportunities and heavy losses. Quality sleep is something that is often overlooked in life, especially when we embark on new and exciting ventures. There are only 24 hours in the day after all, and sleeping time is often the first thing to be sacrificed when there is work to be done. This can seem like a good idea on the outset, as less time sleeping equals more time trading, especially in crypto, which is the only market where one can trade 24 hours a day, 7 days a week, all year round. Unfortunately, whilst it seems as though foregoing sleep can free up more time for a trader to make more money, this is not the case. Trading is quite different from many other vocations, as more time at the desk does not equate to more profit, however hard you work. Trading is one of the few careers where one can do all the right things and work really hard only to end the day without anything to show for it other than losses. Profitable trading is a combination of knowledge, skill, and luck. As traders, we look for probable outcomes that can lead to profits. Oftentimes, despite our skill in analyzing the market, it moves in the opposite direction than we thought it would. Even with the best of intentions in the world's best traders are often wrong over 50% of the time. There really is nothing to gain by spending more time in the markets than one needs to. A trader can spend all day looking at charts, only to end the day making a loss, whilst another can spend less than an hour at the screen and end up making huge profits. The one thing that has the biggest factor in your trading and investing is your decision-making ability. If you are constantly tired, then your ability to make rational decisions will be severely diminished. Countless studies in the science of sleep show that people who lack sleep find it much more difficult to regulate their emotions and are far more irritable. Unregulated emotions and irritability can lead to terrible outcomes for your trading account. This is something that I experienced firsthand when I started trading. I thought that if I just put in the hours like I did when I was at uni, then I would get the results that I desired. Unfortunately, this could not be further from the truth. Due to my lack of sleep, I made a series of increasingly rash and irrational decisions. Every small move in the market made me overreact, and after countless sleepless nights, not only did I not make any profit, but I made huge losses. Ensuring that I had enough sleep was one of the pivotal moments in my trading career. It meant that every day my mind was well rested and in a state that was conducive to good decision making. It took me a long time to learn that quality sleep is not optional. It's absolutely essential when doing mind-heavy tasks such as trading and investing. There are few things that have had as large an impact on my trading than alerts. As traders, we have to process large amounts of information on a daily basis. We then have to filter this information and use it to make decisions about what we will trade and how we should trade it. This can take a heavy toll on traders and lead to decision fatigue, a state of mind where the overwhelming number of possible choices that one can make it difficult to make any choices at all. Alerts can help to alleviate this burden as they effectively automate the decision-making process. Whilst alerts aren't suited to all trading styles, they can work really well for simple rules-based non-discretionary strategies. Once set up, all a trader needs to do is decide if they want to buy, sell, or avoid the trade. A properly configured alert strategy will tell you what to trade and in what direction to trade it, so you won't have to go searching for good trade setups, as that will already be done for you. All you'll have to do is create a watch list of altcoins that you want to trade. Then you create the trigger conditions for those trades, and your alerts will tell you exactly when to trade them. In the following video tutorials, we will go over how to set up alerts which can help to make your trading more profitable and much less stressful. In this tutorial, I'm going to show you how to set moving average crossover alerts that can be used on any market, on any time frame, and these alerts can alert you of big trend changes in markets 24 hours a day, 7 days a week. So firstly, what we want to do is we want to click on indicators, and then in the search field we simply type MA for moving average, and you can see it's the top one. So we want this top one here. Yours won't be, yours probably won't be favorited if you haven't favorited it, but it's going to be the top one. So we'll just click on this twice. So we get two moving averages. Okay, you can see two moving averages have been added to the chart. Now they're both exactly the same, which is not what we want. We want to change them. Okay, so we're going to change a few things. The first thing we're going to change is the color so you can see it properly, because you can't, the moving average lines are blue and the background is this kind of aqua blue color. So we're going to change it to yellow, and then we're going to go to inputs and we're going to change it to 50. This one's going to be 50. You can do any moving average crossover combination that you like, but I'm going to be using one of the most common ones. Okay, so everything else you can leave it as it is, that's fine, and then you just click OK. And then on this one here, we're going to change that as well. Firstly, we're going to change the color so it's easier to see. We'll change this to red. Then we're going to go to inputs, and then we're going to change this length to 200. Press 200, click OK. Okay, and now we can see that we have these two moving averages. Now, why would you want to have moving average alerts? Well, we can see that with Bitcoin, when we have these two moving average combinations, the 50 period and the 200 period on the 3-day chart, we can see that it generally signals big changes in the trend. Okay, it generally signals a change from a bear market to a bull market and vice versa. We can see it going all the way back. It doesn't do it here because there wasn't enough data here. The market wasn't around long enough, but it started doing it in December 2014. It signaled a shift into the bear market, and then in February 2016, it signaled the early beginnings of a bull market. And then here we can see in November 2018, it signaled, big push downwards. Okay. And then in July 2019, it signaled the very early beginnings, of a bull market, okay? And if we go all the way over here, we can see that in May 2022, it signaled a deepening bear market. So unless you're going to be looking at the charts all the time, you're probably going to miss this. So that is why you want to set alerts. So how do we set alerts? Well, what we do is we click on any one of these. So we're going to click on the top one, click on these three dots here, okay? And then we click on add alert. So we click add alert on MA50 and you click that. And here we can see some settings. So what we want to change is we want to change this thing here where it says value. It says crossing. So it says MA50, crossing and value. We don't want it to alert us when at any particular value. We want it to alert us when it crosses the 200 period moving average. So that can be either crossing above or below. So you just click on 200 here like this, and then you click on once per bar. So it will let you know on every 3-day bar that it happens, okay? Now we have a number of other very useful settings here. Now, depending upon your TradingView subscription, you may or may not be able to use this open-ended feature. If you do, if you are able to tick it like you see here, once you click create, this alert will be set and you'll never have to touch it again. It will be a set and forget alert. So it will alert you of any moving average crossover situation until you turn it off, okay? It's a very, very useful feature to have because, you know, you can set an alert today and in 5 years' time, it will still be alerting you when changes happen and you won't have to, it won't require any intervention on your part. But it does require the top TradingView subscription, which is not cheap. So if you don't have that, it's not a problem, okay? There's just a little bit more work that you have to do. So you won't be able to have it set to open-ended, but you will be able to, here where it says expiration time, you can set it up to a month ahead of the current date, okay? So it will keep on alerting you up to a month ahead. And then when 30 days comes, basically you'll have to set the alert again. So what you could do is you could put a little calendar reminder in your phone that says reset alerts every month. And then you just go back in and you reset your alerts. The alerts will be, they don't just disappear. They will be waiting for you. So firstly, I'm just going to set this one. So I click open-ended here and I click create. And if we go and click on this button here, we can see the side panel. Then you click on this alarm clock and you can see the alert we just set, okay? So it will be waiting for you. It's just going to be here and you can choose whether you want to turn it on or off, okay? And this moving average crossover alert system, you can use it on any time frame you want. So for instance, if you're doing some day trading or some swing trading, you may want to set it on a lower time frame like the 4 hour, the 1 hour, the 5 minutes if you're into that kind of trading. So let's set another one. Let's set another one for the 1 hour chart. And how we do that is we click these 3 dots and then we click add alert. And you can see here that it's the same as it was for the previous one. We want to change value to crossing and then you click on this and then you click once per bar. What that means is that it will trigger on every bar in the interval. So if your interval is 1 hour, it will trigger every hour. If your interval is 3 days, it will trigger every 3 days. Okay, and you see this message here. So this will pop up on your phone, this message here, or in your email if you select send email. And this is just what makes it so useful, because whatever you're doing, if you have the app installed on your phone, it will come up on your phone and it will alert you of this major trend change. So you just click create and it's all set for you. And it's just going to show up here in a minute. And then once it shows up, we can choose whether or not we want to keep it going, or here we go, it's shown up. So we can choose whether we want to pause it or restart it. So that's how you set moving average crossover alerts. Part 3. Crypto Investors Masterclass. Before investing, it's a good idea to think about why you're investing in crypto, as well as to define some investing goals. One of the biggest reasons for doing this is that all too often, after a long time has elapsed, crypto investors forget about why they decided to invest in the first place, as they get caught up in the manic hype of a bull run. When this happens, the opportunities they had hoped and dreamed about slip through their hands, and before they know it, they are right back where they started, no better off. This happened to me when I first got into crypto in 2013. I came in without a plan, but I knew that I wanted to be part of something big, and I wanted to make changes in my life. When November 2013 came, I was presented with the financial resources to make those changes, but I didn't seize the opportunity in time, as I listened to the hype and thought that prices would climb higher and higher forever. The price would soon collapse, and during the bear market that followed, I was right back where I started, no better off. The experience of having made a lot of money in 2013, only to lose most of it in 2014, taught me a valuable lesson. It taught me the importance of setting investing goals, so that during the next bull market, I could turn paper gains into real gains. The 2014 to 2016 bear market taught me many important lessons, and I was able to position myself to take advantage of new opportunities. In early 2017, I created a system for systematically taking profit that helped me keep my gains during the bull markets of 2017 and 2021. I will share this system with you later in the course. It was by no means perfect, and I left some profit on the table, but the truth is that nobody can predict tops and bottoms with any consistency. The best and most reliable thing to do is to average into the market during bear markets and average out of the market during bull markets. We want to be buying crypto when prices are cheap and selling crypto when prices become expensive. By identifying why you're investing and writing your goals on paper, you will be able to immunize yourself from FOMO, the fear of missing out, during the bull market. This will put you 10 steps ahead of most crypto investors. Whilst the mania is at its peak and everyone is screaming about how crypto will never stop going up, you will be able to keep a cool head and think rationally as you deliberately and systematically take profit off the table. By having investment goals, you will know when and how to turn your paper gains into cash that you can use to make changes in your life or simply save for the inevitable bear market, so that when prices are cheap, you can be a buyer instead of a seller. When it comes to investing, there are two primary ways to analyze the markets. There's the study of charts and chart patterns, known as technical analysis, and there's also fundamental analysis. In crypto, fundamental analysis is a method of measuring the real or fair value of a crypto asset by looking at factors such as the team behind the crypto, the problem that it aims to solve, and the size of its potential market, as well as technical aspects of the crypto asset, such as its scalability and the robustness of its cryptographic security. In addition to these factors, crypto fundamental analysis involves the discipline of tokenomics, where the total token supply, circulating supply, and distribution schedule are all looked at in an attempt to determine the crypto asset's value. Both technical and fundamental analysis are important in trading and investing, and are essential tools that should be used by market participants. In investing, fundamental analysis has a slight edge over technical analysis, as investors can be exposed to more risk than traders are due to the size of their positions and the length of time that they hold them. Due to this increased risk, it is essential that investors really know the projects that they're buying inside and out. This knowledge can help an investor to build up a profile of the project, which can help them decide just how much should be invested. Investors can't just rely on fundamental analysis. It's important to focus on both, as it really doesn't matter how great the tech and the team behind the project are if nobody wants to buy its altcoin. All too often in the crypto space, people find themselves falling in love with a project due to its potential, its technology, or the accomplishments of its team, while completely ignoring how it's valued by the market. Sometimes this love affair can lead to an investor putting in too much money into a single project, as it seems silly or even unnecessary to invest in other projects when they just don't compare. Investors who find themselves in this position pay little attention to the charts, which is the true indication of whether or not market participants love the project as much as they do. There have been many projects in the crypto space with amazing technology that flops, whilst a meme coin that brings nothing new to the space does 100x. This is not to say that one should ignore great projects' fundamentals and just buy meme coins with great charts. Far from it. I simply want to illustrate the limits of fundamental analysis when it comes to picking projects. It is a great tool for investing, but it is not without its dangers. In the crypto space, fundamental analysis is a very subjective way of valuing investment opportunities. This is true in all asset classes, but it's especially true in crypto, as unlike companies on the stock market, there are no company earnings records, balance sheets, or other tangible data that investors can use to get a good idea about the prospects of a crypto project. Instead, all crypto investors have to rely on are things like a quality white paper, past accomplishments of team members, and tokenomics. These are all important factors that we will cover in detail later, but they are still subjective, so must be used in conjunction with chart analysis. Every crypto project starts with a white paper. In this foundational document, we can read about the intricate workings of a crypto asset, the problems it aims to solve, and how it fits into the broader crypto ecosystem, as well as the tokenomics of the crypto project. The Bitcoin white paper was the original crypto white paper. At only 8 pages long, it is praised by both Bitcoin and altcoin fans for its elegance, simplicity, and effectiveness at communicating such complex subjects in a way that is easy to understand. Unfortunately, most altcoin white papers lack this level of simplicity, as they are often bloated and full of unnecessary buzzwords, marketing jargon, and needlessly complicated formulas and diagrams that often serve to deliberately confuse potential investors instead of enlightening them. Whilst there are good examples of altcoin white papers, they are unfortunately few and far between, and most of their authors could learn quite a lot from Satoshi Nakamoto when it comes to writing what is regarded as the foundational text of a cryptocurrency. Whilst it's not possible for most investors to completely understand the inner workings of an altcoin, it's still worth reading the white paper of a project that you're considering investing heavily in. If there are aspects of the white paper that you don't understand, then pay a visit to the project's forums, which are often in Discord or Telegram chats. If something doesn't make sense to you, then message one of the forum's moderators. The quality of the response you get should tell you whether or not the project is worth investing in. A key thing to look for in a white paper that does not need an understanding of programming is tokenomics. We will cover this in detail in the following module, but you're basically looking for supply and demand factors that will determine if the price will rise and if so, by how much. When looking at a project's tokenomics, you should be paying close attention to the size of team wallets and their proportion of the total supply. If the project's team have a large share of the total supply, then that is an obvious red flag. Tokenomics is a portmanteau of token and economics. It's the study of token supply, distribution, governance models, and other factors in crypto ecosystems to see how these factors could affect the current and future price of a cryptocurrency. Whilst it has token in the name, tokenomics refers to the economics of all cryptocurrencies, not just ones that are tokens. The token distribution of a crypto asset can make or break the project. This is why it's such an important area of study when it comes to tokenomics. How fair was the token distribution? You should be able to find this out by looking at the project's website and white paper, but you should confirm this by looking at the project's token contract, if this is applicable. Oftentimes, large wallets that hold over 30% of the supply may be exchange wallets. These are often marked with a label like Binance Hot Wallet. If this is the case, then this should not be a cause for concern. If the biggest wallets are unlabeled, some may be exchange cold wallets. Sometimes these are unlabeled for privacy and security reasons. However, large unlabeled wallets are always worth investigating further to find out who owns them. This is especially true with low and microcap altcoins that aren't on centralized exchanges, as large single wallets are one of the clearest signs that the coin is part of a rug pull scam. A rug pull scheme often involves low liquidity coins, which are hyped up by the project's founders who own most of the tokens in a number of large wallets. Once the hype has pumped the price up to the founders' satisfaction, they sell large amounts of their tokens, which leaves the remaining holders with worthless tokens. If you're looking to buy low or microcap altcoins that aren't on any big exchanges yet, then you should assume that the large wallets are part of a pump and dump scheme until proven otherwise. A crucial thing to check is the amount of tokens that were bought at launch prices. Token launches are often referred to as ICO, initial coin offering, or IDO, initial DEX offering. IDO refers to token offerings on DEXs, which are decentralized exchanges. During a token offering, the price will likely have been substantially lower than when the coin was made available on centralized exchanges. So even though you may be looking at charts thinking that the price may look cheap now, you should be aware that the price was probably much cheaper before there were any charts for the token. In this case, the people who got in early were probably venture capitalists who may have bought huge amounts of the token at a 90% discount to the current price. If this is the case, then these large holders may already be up 1000% plus on their investment, which could add tremendous selling pressure to the project. What often happens with new projects is that coins bought on launch are subject to vesting. What this means is that the tokens that were sold in the pre-sale stage of the initial coin offering may be locked up for a period of time. This prevents coins from being moved out of their wallets, which stops them from being sold. This is done in an effort to control the supply of coins on the market, which makes things fairer for new buyers. The token distribution of a crypto asset can make or break the project. This is why it's such an important area of study when it comes to tokenomics. How fair was the token distribution? You should be able to find this out by looking at the project's website and white paper, but you should confirm this by looking at the project's token contract, if this is applicable. If there are a series of big token releases coming up soon, then you may want to wait until this new supply hits the markets, as prices will almost certainly be cheaper when that happens. In addition to the process of token distribution, there are other supply and demand dynamics to think about. Factors such as staking and airdrops can incentivize and influence the behavior of market participants. Staking has a big effect on supply and demand, as it can lock up a large percentage of the supply for a set period of time. This takes the supply out of circulation so that the amount that can be sold is reduced. When a holder puts their coins into a staking contract or service, they are basically signing up to a period of enforced hodling where they are unable to move or sell their coins for a set period of time. To reward and incentivize holders to stake their coins, they are given a percentage of new coins that comes into circulation in proportion to the amount that they are staking. In addition to staking, holders of coins can also lock them up in liquidity pools, which provides liquidity for decentralized exchange users. During an airdrop, holders of eligible coins may receive new tokens, provided they meet the criteria specified by the airdrop issuer. Airdrops can often have a temporary effect on supply and demand. They usually have something called a snapshot, where holders of the coin needed to receive the airdrop have their wallet balances recorded. This is done in order to work out what percentage of the airdropped coins each wallet holder will receive. In the days and weeks leading up to a popular airdrop snapshot, the price of the coin needed to be eligible can often shoot up. A famous example of this happened in December 2020 in the run-up to the Spark token airdrop. XRP holders who set up their wallets to receive the free Spark tokens had their wallet balances recorded on December 12, 2020. In the run-up to this event, the price of XRP increased by over 200% as people rushed to buy it so that they could be eligible to receive the free Spark tokens. If you're considering joining in this mad snapshot rush, then you should be very careful. What almost always happens directly after an airdrop snapshot date is that the very coins that people were eager to buy in the run-up to the snapshot get dumped back on the market, as most airdrops don't require that holders keep their coins after the snapshot date. This happened to XRP after the Spark token snapshot, as the price dropped all the way back down to where it was pre-snapshot. The market cap of a cryptocurrency is the combined value of all of its units in circulation. It's calculated by multiplying the current market price by the circulating supply of coins or tokens. Crypto market caps can be a useful way to gauge how successful a crypto project is in relation to other crypto projects. Looking at market caps can also help when speculating about the potential future value of a cryptocurrency if it were to go up by a specific percentage. By calculating the market cap, we can see if the predicted price of a cryptocurrency is reasonable or ridiculous. To illustrate this, let's look at Shiba Inu, the dog-themed meme coin that was very popular during the bull run of 2021. At the time, just before its peak, many were calling for a price of $1 per Shiba Inu token. Let's look at the market cap metrics of Shiba Inu at the time to see if such a price prediction is reasonable or ridiculous. During 2021, the circulating supply of Shiba Inu was around 500 trillion tokens. If we multiply those tokens by the predicted price, we get a total market cap of $500 trillion. If Shiba Inu, the dog-themed meme coin, were to reach $1, it would be worth almost 6 times larger than the world's total GDP during 2020, which was $84.71 trillion. Whilst this is an extreme example, there were many YouTube videos where people were making such outlandish predictions. If you want to giggle, take a look for yourself. In crypto, as with all markets, being able to identify a possible trend change early before it happens is key to making and, more importantly, keeping big gains. In every market, there are 4 main phases to the market cycle. These are the accumulation phase, the markup phase, the distribution phase, and the markdown phase. Each market cycle goes through several phases. In the beginning, there's the accumulation phase, where the market spends a period of time going sideways, giving savvy investors plenty of time to slowly and steadily accumulate as many coins as they want. Then there's the markup phase, where the market begins to trend upwards. During this phase, all news surrounding the coin is positive, and buyers start to flood in. Price goes increasingly vertical and gets further and further above the 50-week moving average. The distribution phase, or blow off top, ends the markup phase as sellers step in as they start reducing their exposure to the market. Sell volume increases whilst buy volume declines. The final phase is the markdown phase. In this phase, the price starts to fall. It happens slowly at first, then gathers momentum as fear builds and holders capitulate in order to avoid further losses. This is the stage where Bitcoin crashes down below the 50-week moving average. Unfortunately, this is where most investors find themselves selling, which is one of the worst times to be a seller. As a savvy investor, you'll want to make sure that you do all of your selling in the distribution phase. Here are 2 ways that you can identify when the distribution phase is about to end, which signals the end of the bull market and the beginning of the bear market. 1. Look at what Bitcoin does. 2. Calculate the length of time since the last Bitcoin halving. As of 2022, the crypto market is still dominated by Bitcoin, which is currently the largest crypto by market cap. Whilst this may change in the future, for now at least, Bitcoin runs the show and sets the pace for the rest of the market. Bitcoin and the 50 and 200 period moving averages. If we look at Bitcoin's price history on a 3-day chart, we can see that it's generally in a bull market when the price is both above the 50 and 200 period moving averages. When Bitcoin's price dips below the 50 period moving average, then that should be seen as a warning signal that the bear market could be approaching soon. When the price eventually goes below the 200 period moving average on the 3-day chart, that should be seen as a confirmation that Bitcoin is in a bear market. Ideally, you should have done all your selling before Bitcoin's price goes below this level, especially if it's been above it for over a year. How long has it been since the Bitcoin halving? The Bitcoin halving occurs roughly every 4 years. During this event, the supply of new Bitcoins rewarded to miners every 10 minutes gets cut in half. The last Bitcoin halving occurred on May 11, 2020, when the mining reward was reduced from 12.5 to 6.25 every 10 minutes. Currently, the next Bitcoin halving is scheduled to happen around April 1, 2024, when the supply will drop to 3.125 new Bitcoins every 10 minutes. Looking at the past 3 bull cycles, we can see a clear pattern. Bull runs typically end between 12 and 18 months after the Bitcoin halving. The first Bitcoin halving occurred on November 28, 2012. Bitcoin peaked just 12 months later in November 2013. The second Bitcoin halving occurred on July 9, 2016. Bitcoin and the entire crypto market peaked 18 months later in mid-January 2018. The third Bitcoin halving occurred on May 11, 2020. Bitcoin peaked 18 months later in mid-November 2021. The altcoin market peaked a few weeks later. By using these 2 methods of market identification, you can get a rough idea of when the bull market is about to come to an end, so that you can make the necessary preparations for the coming bear market. Being able to identify this before others will give you the advantage of being able to sell easily at prices that are attractive to you. There will be plenty of eager buyers who will be happy to buy from you in the remaining frantic months and weeks of the bull market. In 2018, people who bought coins like Chainlink, Ren, RV and Synthetics were able to beat the bear market and went on to make outsized gains during the bull market. I like to call this class of coins the Phoenix coins, as they rose from the ashes of the bear market. What separates these coins from others is that they appeared either late in the previous bull run or at the beginning of the subsequent bear market. Here are 3 ways that will help you to find these profitable Phoenix coins. Look for new altcoins that came out in late 2021 to 2022 and beyond. Projects like these are new and fresh. They didn't really have a bull run, so don't have an army of angry bag holders who bring negativity and selling pressure to it in the future. Look for projects that aim to do something brand new in DeFi, Web3, crypto gaming, or come up with a new way of bridging crypto to the real world. Original projects like these will stand out from the sea of thousands of altcoins that brought nothing new to the space. Look for projects that have a great community that is happy and excited about their project's future direction. Community is everything, and memes mean much more to the success of a project than you might think. Don't buy last season's altcoins. During a bull run, there will always be a coin that you missed out on that ends up making huge 100x gains for those who bought early. In the bear market that follows, these coins, like all others, will fall 80 to 90% in a dramatic crash. It may be tempting to buy these coins during this time, as many think that if it was a smart buy in the bull market, then it should be the same in the bear market too. Don't make this mistake. Many of last season's most popular alts that had amazing pumps in the bull market will fail and will never make a new all-time high. This is because they already had their moonshots, and all the people who didn't get out in time will stop those alts from ever pumping again. If we look back at some of the most popular alts of 2017, most of those coins never made a new all-time high. Of the top 20 altcoins in December 2017, only 5 made a new all-time high. 75% failed to make a new all-time high. What many don't realize is that these coins in the top 20 were super popular. Many of them were seen as the Avalanche or Solana of their day. Despite this, they completely fell out of favor in the bear market. 2017's top 50 coins fared even worse. Many of them are either dead or completely unknown nowadays, and they are lucky to be in the top 2,000 coins, let alone the top 50. The biggest difference between the stock market and crypto, which is still a relatively immature market, is that crypto is mostly narrative driven. During a bull market, it's easy to spin a positive narrative about a coin, as buyers are almost always rewarded due to prices going up all the time. During a bear market, even coins with amazing fundamentals will often vanish into insignificance, as no amount of good news can halt the drop in price. When the next bull market comes around, the popular alts from last cycle are forgotten, as there is a wave of new altcoins that steals everyone's attention. There will only be a small handful of altcoins that remain relevant from cycle to cycle, but the truth is that most of last cycle's most popular altcoins will become totally irrelevant during the next cycle. During a bear market, it's better to research new developments in the crypto space so that you can catch a project that aims to fix a new problem or connect crypto to the real world in a way that has yet to be imagined. One great example of this is Chainlink, which appeared in late 2017 at the tail end of that bull run. Due to its late entry into the crypto space, it didn't really have a big pump in 2017, so there weren't a lot of buyers who lost loads of money in the bear market that followed. Chainlink was doing something totally new in the crypto space, as its Oracle network aimed to bring in real-world data, such as stock and forex pricing, into the crypto space, so that this information could be used in DeFi, which was a blossoming segment of crypto at the time. Due to these factors, Chainlink was one of the first coins to pump, as it started its bull market in summer 2018, which was in stark contrast to most altcoins, which didn't start rising until 2021. Another reason why you shouldn't buy last season's altcoins is that many of these projects will simply run out of money. As someone who has worked for crypto companies in the past, I can tell you that the money runs out during the bear market. During the bull market, investors pump unlimited funds into projects. Many of these projects find that they suddenly have a lot of money, too much money, more money than they know what to do with. Unfortunately, many altcoin teams don't use the funds wisely. They often hire far too many people, they throw lavish parties, and if there's any money left over, they'll spend that on development and branding. When working at crypto startups during this time, it really feels like the good times will never end. They will. As soon as the bear market comes around, the money stops flowing in. The music stops and people put down the champagne. This is when the cost cutting starts. Contracts get cancelled, development gets scaled back. Everyone is wondering when the money will start coming in again, as the rate of expenditure is so high that without new funds, all the money will be gone soon. With this in mind, you should avoid buying most of last year's altcoins, as many of these projects will run out of money before the next bull run. Instead, focus on new Phoenix alts that aim to do something new and fresh in the crypto space. Bear markets can last a long time. They can often last much longer than many can tolerate, which is why the focus should be on capital preservation and researching new projects to invest in. There are two big mistakes that most people make in bear markets that can ruin their chances of having a profitable bull run. The first mistake is buying crypto all at once at the beginning of the bull run. The second mistake is waiting too long to buy anything at all, in a vain attempt at trying to time the market so that one can buy at the lowest possible price. As soon as it's widely accepted that the market is bearish, many will rush to buy their favorite altcoins from last season, as well as any new coins that come out. We already discussed why buying last season's altcoins is a bad idea in one of the prior lessons, but it's also a bad idea to buy new altcoins too quickly. Instead of investing all of your cash at once, it's much better to spend a small amount on a consistent basis. None of us can predict the future, so the best way to invest is to buy a little bit all the time instead of buying a lot all at once. Once you've found high quality projects and you've built up a buy list, you shouldn't invest in them too quickly. Instead, it's best to buy a small, fixed amount each and every month, whether prices are high or low. This way of investing is called dollar cost averaging. It's an investing method that helps buyers get a better average buy price during bear markets. Investors who dollar cost average build up their position over time by investing the same amount of money over regular intervals, regardless of price. A steady stream of new and exciting projects will come out during the bear market. If you invest all of your money all at once into the first shiny new altcoin you find, then you might end up missing on the next Chainlink or Avalanche. In this example, we have two investors who bought during the crypto bear market of 2018 to 2020. They both budgeted $2,400, which is just under £2,000, to spend on Ethereum. Harry was in a hurry to buy, so bought all at once, whilst Hannah bought a small amount each and every month over 2 years. Let's look at how they both did. Depending on how lucky or skilled Harry was as an investor, his $2,400 could have bought him as much as 22.68 ETH, or as little as 3.89 ETH. Harry would have to be exceptionally good at market timing in order to buy at the bottom of the market, which would get him the most ETH. Here we can see that Harry had a 50% chance of buying at a cost lower than the average buy price of a dollar cost averaging strategy. Whilst Harry could have made a decent amount of profit at the end of the 2-year period by buying at the bottom, he could have been much worse off had he bought Ethereum in November 2020 when it was at its most expensive during the bear market. Hannah bought $100 worth of Ethereum every month for 24 months. At the end, she spent a total of $2,400 on Ethereum. This bought Hannah 12.43 Ethereum for an average buy price of $233.44. She could have acquired much more Ethereum if she correctly timed the market, but if she messed up, she could have bought a lot less. By buying consistently over 24 months, she was able to take advantage of some very low prices, which lowered her average buy price. Out of these two strategies, we can see that dollar cost averaging is one of the best ways to invest over the long term. Whilst great market timing can yield better results, dollar cost averaging is the most stress-free way to invest, as it doesn't require market timing or luck. All it requires is consistency and buying the same amount every month regardless of price. Crypto bull markets typically begin 6 months before the Bitcoin halving occurs, as investors start accumulating both Bitcoin and altcoins in anticipation of this event. If we look back in time at Bitcoin's price movements, it typically moves above the 3-day, 50 and 200 period moving averages 6 to 9 months before the halving happens. A move above these moving averages has signaled the start of the bull run twice before. This happened just prior to the 2016 Bitcoin halving and again prior to 2020's Bitcoin halving, although during 2020, Bitcoin's price movements were complicated by the pandemic. This black swan event, which caused a global stock market crash in March, pushed the price back below both moving averages after moving above them just 2 months earlier. Despite 2020's black swan event, it's clear that the 9 to 6 month period before the next halving occurs is generally a good window of opportunity to start getting bullish on Bitcoin and altcoins again. This is the time to start accumulating small positions in the promising small and low market cap altcoins, a topic we will discuss in depth in the following lesson. When Bitcoin's 3-day 50-period moving average crosses over the 200-period moving average in an event called the Golden Cross, this should be seen as a tentative confirmation that the bull run has begun. By combining the pre-halving 9 to 6 month window with the Golden Cross, you can get a good idea about when it's time to start preparing for the coming bull market. In this tutorial, we'll be looking at how we can create take-profit plans in order to ensure that paper gains are turned into real gains. Creating a take-profit plan is absolutely essential for 2 reasons. The first is that it helps you come up with reasonable price targets using technical and fundamental analysis. The second reason is that a written down plan will help to inoculate you against FOMO during the peaks of the bull market. This is really important on a psychological level because it will be much easier for you to sell when you know that you have a plan that you need to stick to. We'll be using the Mooncalc to create our take profit plan, and it's a Google Sheet that's available to you in the resources section of this section of the course. And you have lifetime access to this, and it's always changing, so I'm always going to be improving it. We're already on version 3 and I've got some big plans for it, so you have a lifetime access to that. When you're creating a take profit plan, there are 2 main factors that you need to consider. The first one is all about technical analysis. So you're looking for technical evidence that the coin that you intend to buy or that you already hold can reach the potential price targets that you have in mind. The second factor is you're looking at the niche that the coin is in, okay? So you're looking at where other coins are in that niche, where they lie, and you should be paying particular attention to the ones that are at the top of the niche. So looking at this crypto gaming category, we can see that Mana is at the top of the niche. It was a very, very popular game in 2021, and there's still lots of people playing it. It's a working product, so it has a very high market cap. So we're going to copy this market cap, and we're going to put it in our Mooncalc, and we're going to use that later. So what we want to do is we want to go down this list, and we're looking for coins that could potentially be at a similar market cap, coins that have potentially high growth potential. So VRA is an interesting coin. It's all about game streaming, a market that's growing very, very rapidly. And we can see that it has a very, very small market cap. So it's only 51 million at the moment. And there's 10.34 billion in circulation. So we're going to put this information into our Mooncalc. So first of all, we're going to write the ticker here, and we're going to use this as a potential buy price. And in here, we're going to put the market cap. Okay, so we have 10.34 billion there. So we can see immediately that if VRA was to reach Mana's market cap, remember Mana's market cap was 1.55 billion, VRA would be worth 15 cents. So that's quite interesting to know. That's quite a increase. So let's look at the charts and see if we can find evidence to corroborate our theory that VRA could reach that level. So we just want to search for VRA. On this one here, there's lots of price history. So we can see that in 2021, it reached 9 cents. And 9 cents isn't too far off from 15 cents. When you look at the move in its entirety, okay, it started the year way under a cent, okay, and then it ended the year up at 9 cents. So it's possible, and the market cap wouldn't be ridiculous, okay? We're not talking about, hundreds of billions of dollars. We're just talking about $1.5 billion, very small in crypto terms. And if we were to draw some Fibonacci levels, we can see that this swing high to this swing low came up with this 1.618 level, which it hit perfectly, okay? So when people say that Fibonacci doesn't matter and it doesn't work, I mean, this is clear evidence that it worked, because, people back here, drawing this from this swing high to this swing low, they wouldn't see the future. And this perfectly predicted that it was hit. So there is potential that it could get up to here. I mean, the 2.618 level is 13.6 cents, okay? The 3.618 level is 18 cents. So we're going to use this information here. And what we're going to do to make life easier is we're going to add price levels to the Fibonacci. So we're going to put these prices into here. And the first one we're going to do is 13 cents. The second one is 18 cents. Actually, we'll do this for the second one because that was our original target. And then we'll do 18.6. And then we'll do the 4.618 level, which is 23 cents. Okay. So now we want to come up with a budget. I mean, we want to work out if it's worth our while buying VRA. So let's put in $1,000. That seems like a decent amount. So if we budgeted $1,000 into VRA at the current price, we'd be able to buy just over 200,000 VRA. Okay. So we're going to copy this and we're going to put it into holdings. Paste special, and then you paste values only. Okay, so now we have some holdings here. So now we have holdings, and we have we know how big the circulating supply is, and we have potential price targets. Okay, so now we want to work out how much we should sell at each price target. So we'll just play around with it. So we'll start off small. We'll sell 10% at 13 cents. So if we did that, that would yield £2,290, okay? And there'd be £20,000 worth left at that price. And then if we say we want to do 20% at 15 cents, okay, that would bring a cumulative return of £7,313. What if we wanted to get bigger? Because we're looking at 18 cents here right now. And 18 cents is very, very close to the top of this extension. So it would be wise to maybe have a much bigger take profit percentage here. So let's do 50%. We can see that the TP3 cumulative returns is almost 23K. So we still have 20% left in terms of our total holdings. So we're going to put that 20% in here. And that is for the last take profit, which is the 4.618 fib. So all of these 618 fibs are very important. The price just seems to love anything that's 618, okay? So now that we filled it out, we can see that from the $1,000 investment, it's yielded $37,000 in terms of returns. So it's best used as a guide really, and it's best used as a way to see what's possible and to serve as a reminder that's written down so that, because when in a market, what happens is during this stage of the market, in the doldrums, everybody's thinking, how amazing it would be if, VRA gets to 9 cents, I'll sell everything and I'll be able to buy this and buy that and buy this. But unless people write it down, by the time the price gets to that level, people forget. And people are made to forget by all the people on YouTube and on Twitter who say things like, oh, it will go up to $1. And they think, oh, well, I can't sell now because it will go to $1. But if you have a Mooncalc, if you have a take profit plan that you can refer to and you can see, how much you could potentially make, then that can help to aid your decision. And you can really play around with this. You can play around with the budget. If we change the budget, it changes everything here. So it will basically just increase. Well, we'll need to change the holdings first. So once you've changed the budget, copy the quantity and you paste it into the holdings. And you can see that it's just tripled everything. So it's a really good way to get an idea of the potential of the assets that you're holding. And this is this doesn't just work well as a calculator, it also works well as a log. So once you fill this out for VRA, you can simply right click on it and duplicate it and you make a new one. Okay. And what I like to do is I like to name these tabs. So this one is VRA. And if I go on here, say I want to do it with, PGX, for instance. Okay. I'll just go on here and then I'll delete all of this stuff and I'll make a new one for PGX. So it's a calculator and a record that you can look back on, and you can use this to set your limit sell orders during the next bull run. Trading and investing in microcap altcoins is highly risky, but microcaps offer much greater returns per amount risked. Microcap altcoins typically have a market cap of under $50 million. There are many coins in this category that are microcaps, but they are far from equal. If you want to trade microcap alts, you should only be looking at brand new ones that were released within the past 6 months to a year. Ideally 6 months, as new microcaps tend to have more buzz surrounding them, which equates to more interest from buyers. There are thousands and thousands of microcap altcoins that are more than a year old. These should all be avoided, as these are all dead coins that nobody is interested in anymore. Coins like these trade sideways for years and have such low trading volume that they are simply not worth touching. Microcap swing trading requires a far different mindset to investing. It is a high risk, high reward activity, so you wouldn't want to risk more than a tiny amount of your capital. When I say tiny, I really do mean that. We're not talking about putting 10% of your portfolio into a microcap altcoin. Personally, when trading microcaps, I never allocate more than 1% of my portfolio on any one of these coins. And in total, microcap coins as a niche have never amounted to more than 10% of my portfolio. The thing is, you really don't need to put huge amounts of money into microcaps. As they're so small, they don't take a huge amount of buyers to move them up. This works in the opposite direction too, which is why you should not put too much money into microcaps. These altcoins are not ones that you should hold long term. Microcaps should be treated very differently to top 20 coins. When it comes to microcaps, you're not trading them based on the tech or the team behind the coin. You are simply trading based on narrative, hype, and buzz. Good timing is crucial when it comes to microcaps. These are not coins that you want to dollar cost average into. They're coins that you should only be trading in an uptrending market. Your aim is to identify them, wait for high probability trade setups, and then buy when the setup is in your favor. I have to reiterate that these coins are not buy and holds. You should be buying with the intention of aggressively selling once they start going up parabolically. When microcap trading, I rarely hold a coin for more than 2 months. I find a popular uptrending coin in a popular niche, and then I'll buy and sell a few weeks to a few months later for a 5 to 10x profit. I'll then repeat the process a few times, always keeping half of the profit in a stable coin and then putting the other half into a new microcap. I'll do this until the general bullish momentum in altcoins starts to die down. Many people wrongly think that they'll make 100x on a single microcap. This misconception is largely due to crypto influencers shilling microcap altcoins. The likelihood of doing this is very low. The reality of microcap trading is that you have to flip many coins multiple times whilst being very disciplined about taking profits in order to get anywhere close to 100x. By the time the altcoin market dies down, you will most likely be caught off guard as microcaps can drop in an instant. Any microcaps that you're still holding will lose most of their value very quickly, so you'll need to accept this and sell at a loss. When trading microcap alts, the sell button is your friend. Once you have identified that you are in the markup or distribution phase of the market cycle, you need to start preparing for the eventual end to the bull run and the good times that go with it. At the time, it will seem like the bull run will simply go on forever. Spirits will be sky high and everyone on crypto YouTube and Twitter will say that the party will never end. These people are very dangerous and have the potential to ruin your portfolio if you listen to them. I know just how difficult it is to avoid listening to them, but you must block out the noise as much as possible and focus on your investing take-profit plan instead. During the mid to late stages of a bull run, you should not be buying anything. Instead, your focus must be about selling and selling aggressively and consistently. During a bull run, the sell button is your friend. By focusing on your plan, you won't sell at the very top, nobody can do that, but you will average out of the market, which should put you in a better position than most people. During a bull run, I like to get into the mindset of a farmer who's harvesting crops for the winter. As sunny as it is in the middle of August, as much as it may feel as though the sun will shine forever, it is inevitable that the summer will eventually end because winter is coming. Just as a farmer has a narrow window to finish the harvest, you will have a narrow window to take profits on your crypto, to reward yourself for months and years of deferred gratification, hard work, and time spent researching. Be sure not to let this golden time go to waste. Take profit so that you can be ready for the crypto winter. A key part of risk management when it comes to investing is understanding risk versus reward. All investing carries risk, so it's important to define how much you're willing to risk for an expected reward. Even if it looks as though you could easily make 20 times your money on a particular altcoin, you never want to be in a position where you are at the risk of total ruin. By this I mean that you should never invest all your funds into one altcoin. As we have seen time and time again in the crypto space, altcoins can easily lose over 90% of their value in a few weeks due to smart contract bugs and code exploits. Terra Luna is a recent example of this. During 2021 to early 2022, Luna was one of the most popular altcoins, and the team behind it were seen as innovators in the space. The Luna ecosystem was based around UST, their algorithmic stablecoin that was backed by a basket of crypto assets such as Bitcoin and Luna. In April 2021, Luna reached an all-time high of $120, which was quite a feat, especially as the crypto market was in a confirmed bear market. Then, mere weeks later, flaws in UST's stablecoin were exploited that led to it depegging from its $1 value and crashing all the way down to 15 cents. During this time, Luna crashed to mere fractions of a cent. As UST was backed partially by Luna, this forced the algorithm to print insane amounts of Luna. This, combined with market panic, led to the price of Luna dropping over 99%, from its high of $120 to mere fractions of a cent just a few weeks later. This was a terrible moment in the crypto community and a tragedy for holders of the coin, many of whom were paper millionaires in April only to find themselves in a state of complete financial ruin a few weeks later, when their $1 million Luna portfolios were barely worth a few dollars. What makes this situation even more tragic is that Terra Luna, being a top 10 coin at the time, with a seemingly respectable team behind it, was viewed as a safe investment that was a far cry from the many degenerate, high-risk altcoins that were well understood to be pure gambles. Despite Luna's high market cap rankings and good reputation, anyone who put all their eggs in the Luna basket had their hopes and dreams turned into a scrambled mess in the space of a few weeks. This is why you should never ever invest too much in any single crypto, however safe you think it may be. If a top 10 coin can fall over 99% in the space of a few days, then so can any other. Personally, 20% per altcoin is the absolute maximum, as that is the most that I would be prepared to lose if my chosen altcoin suffered the same fate as Terra Luna. Whilst nobody wants to see 20% of their portfolio evaporate, it's far less worse than losing half or all of your portfolio, as such losses are almost impossible to recover from. Position sizing relative to trade volume. Whilst this is more important when it comes to short-term trading, it's still important to think about how much of an altcoin you're buying relative to its daily trading volume on an exchange. When it comes to buying and selling effectively, you don't want your buy and sell orders to be the biggest ones on the order book, as you'll have a difficult time when it comes to averaging in and out of a coin. If you find that your buy orders are pushing the price up too much, then it may simply be that the pair you're trading is not very liquid. For example, on Binance, the Mana USDT trading pair currently has 12 times more volume than the Mana BTC pair. In this case, it would make more sense to sell BTC for USDT and then trade that USDT for Mana. When it comes to setting limit sell orders, you want to be using the most liquid trading pair possible in order to ensure that your orders get filled. A great tool I use to find the most liquid trading pairs is coinmarketcap.com. I search for the altcoin I want to invest in and then I click on the market tab. It will then rank all the trading pairs from most liquid to most illiquid. If you find that all the available exchanges have low volume for an altcoin you're investing in, then you should seriously consider whether you should be investing in it at all. If the altcoin hasn't been out for a very long time, then low volume is understandable. If the project is good and people want the coin, the volume will increase. As you dollar cost average into an altcoin, you should make a note of changes in the exchange volume to see if it increases over time. However, if the coin has been out for a long time and the volume is still low on all the trading pairs, then you should factor that into your risk analysis for that particular investment and resize your allocation accordingly. After all, if few people want to buy the coin, then it's unlikely to go up a lot. DeFi and Metaverse Essentials. DeFi stands for Decentralized Finance. DeFi allows anyone with an internet connection to lend, borrow, bank, earn interest, and do other complex financial transactions on the blockchain, all without middlemen or intermediaries of any kind. DeFi apps are financial services that run on permissionless blockchains such as Ethereum, Binance Chain, and Avalanche. Permissionless means that users do not need to seek permission from bank managers or credit brokers in order to use these services. DeFi apps are open to everyone, regardless of credit status or perceived worthiness. This is a real game changer that will forever change the way people access financial services. Finance can now be made available to all, regardless of background or financial situation. DeFi makes it possible for people to access microloans of £50 or £100, something that would not be possible from a traditional finance provider without having to pay levels of interest that were orders of magnitude greater than the loan. In DeFi, loans are peer-to-peer, meaning that people can lend or borrow any amount to each other. This will have a big impact, especially in the developing world where options for finance are limited. To use these services, Users interact with smart contracts via wallets such as MetaMask, which is a gateway to the world of DeFi products and services. If a user wants to get a DeFi loan, there is no need for credit checks. There are no credit managers who will look down on you because you're wearing casual clothes. In DeFi, you could be sat on the sofa in a dressing gown, and all you'd need for a loan is the collateral to back it. DeFi loans are usually over-collateralized in order to limit risk and to protect lenders. For example, if you wanted to take out a DeFi loan of £1,000, you would need to put up £2,000 worth of collateral in the form of Ethereum, Bitcoin, or another cryptocurrency. You may be thinking why someone would want to do this. Well, putting up more collateral than one wishes to borrow, whilst it may seem counterproductive, as someone who needs £1,000 may not just have £2,000 lying around, it's actually quite common in the crypto space, where holders of crypto need liquid cash to spend on things like living expenses or a new car without having to cash out completely. For example, let's imagine a typical DeFi user called Martin. Now, Martin holds a lot of Ethereum and he believes the price will go up, and he thinks it will go up quite a lot because it's in a strong bull market. But there's a problem. He really wants a new car, and he's had his eye on one for quite some time now, and he's just found someone online who's willing to sell the model he wants for an attractive price. And unfortunately, this person online, he doesn't want to wait, he wants a quick sale. So what's a DeFi user like Martin to do? Well, if he was to sell his Ethereum and withdraw the cash, then he might incur an opportunity cost, as Ethereum could go up more and, he would have sold his Ethereum at a lower price than he wanted. So a DeFi stablecoin loan may be the answer for Martin. The car he wants costs £20,000, and Martin's willing to put up £40,000 worth of Ethereum as collateral. In return, Martin can borrow £20,000 worth of the stablecoin USDC, which he can then send to an exchange and cash out to his bank account. He's then able to withdraw the cash and buy the car of his dreams. If the price of Ethereum were to double, which is what Martin believes will happen, then his loan will have been paid off, and he's happy as he gets to keep his Ethereum and he has a new car. However, if the price of Ethereum were to drop by, say, 50%, then he would lose half of his collateral in order to cover the amount borrowed. Whilst this scenario is an oversimplification, it does illustrate a typical DeFi loan, as well as the risks and benefits of DeFi loans. DeFi ecosystems are comprised of multiple core components that are open and interoperable. The main components of DeFi applications are blockchains, digital assets, wallets, smart contracts, decentralized applications, governance systems, decentralized autonomous organizations or DAOs, stablecoins, and oracles. We will cover how these components work in this lesson. Blockchains are the distributed ledgers that work as the settlement layer for transactions in DeFi. Ethereum used to be the only ledger that served the DeFi applications, but now competing blockchains such as Binance Smart Chain, Avalanche, and Polygon are now core blockchains in the DeFi space. Digital assets are tokens that are both fungible and non-fungible that represent value or ownership and are transacted across DeFi networks. Wallets are the main software interface that allow users to interact with blockchains in order to use DeFi services. There are two main types of wallets. There's custodial and non-custodial. Custodial wallets are the type that live on an exchange or DeFi service where the user needs to log in to use them. The benefit of these is that the exchange manages them for you. There is a huge drawback to these wallets, however. As you're not in control of the private keys, this can make you more vulnerable to hacks or loss of control of the wallet. With non-custodial wallets, you have total control of the private key and the ability to make transactions from the wallet. With great freedom comes great responsibility, which brings us to the downside of these wallets. As the private keys are in your possession, you have total responsibility when it comes to the management and security of that wallet. Only you can protect your funds and prevent them from being stolen by hackers or lost through mismanagement of the keys. Smart contracts are lines of code that live on the blockchain. that follow the predefined rules outlined in the contract. The beauty of smart contracts is that they operate in a decentralized, open, and transparent way. Anyone and everyone can see the code, and those that can read and understand it can check to see that it works as it should. Caution is needed, however, as all software contains bugs, and blockchain software is no different. If a smart contract that manages your money is buggy, you could lose much more than a few documents. Decentralized applications, otherwise known as dApps, are applications built out of multiple connected smart contracts. These apps make it easy for users to interact with the smart contracts, as they often have web-based graphical user interfaces which allow users to perform smart contract actions with a few clicks. Some of the most popular decentralized apps of 2022 are Uniswap and PancakeSwap, two of the most popular decentralized exchanges, and Aave, the decentralized lending platform. Governance systems are code-based systems that manage changes and upgrades to protocols and smart contracts. In DeFi, there are many forms of governance, with some protocols being more democratic than others. Most DeFi protocols give voting rights to token holders, which gives the community a say in how and when changes happen to the DeFi protocol. Decentralized autonomous organizations, shortened to DAOs, are digital entities that enforce the rules laid out in smart contracts. DAOs reflect the will of the people as their actions are directed by the governance systems of the DeFi protocol. Stablecoins are digital assets that maintain a value that is equal to a national currency. The most popular stablecoins maintain a one-to-one peg to the US dollar by using a basket of currencies and assets or an equal amount of dollars in the stablecoin issuer's bank accounts. Not all stablecoins are equal. Before using any stablecoin, it's worth checking out the composition of its reserves as well as the reliability of reserve audits. Although stablecoins are always meant to be worth $1, there have been many occasions where the peg has been broken, sometimes permanently, as was the case with Terra Luna's UST stablecoin, which lost its $1 peg in May 2022. Oracles are the eyes of DeFi. These programs provide real-world data feeds to DeFi applications, such as fiat currency rates, stock prices, and even things such as election results. Chainlink is one of the most popular blockchain oracles. The Metaverse is an emerging network of interconnected virtual worlds that will be the immersive digital future of the internet. The term Metaverse was first coined by Neil Stephenson in the sci-fi novel Snow Crash, which depicted a dystopian, ultra-corporatized world that people would escape from by entering the Metaverse, a virtual world where you could be whoever you wanted to be. One of the first real-life iterations of the Metaverse was the virtual world called Second Life, first released in 2003, where people could use avatars to explore user-created spaces where people could meet, play games, and trade with the in-game currency called Linden Dollars. The in-game currency aspect of virtual worlds is what has gotten people in the crypto space excited, as cryptocurrencies are a perfect fit for virtual worlds. Unlike the Linden Dollars used in Second Life, in-game currencies used in popular crypto metaverses, such as Decentraland and Sandbox, use decentralized cryptocurrencies which allow for totally decentralized economies in these virtual spaces. In terms of technology and user adoption, we are super early when it comes to anything metaverse related. The virtual reality headsets that are required if users want a truly immersive experience are expensive and clunky and can make some people feel motion sick when using them. When we look back over the past 20 years, we can see that the same problems existed for internet users at one point. Back in the early 2000s, high-quality video streaming was science fiction, and video conferencing was super expensive and was only available to presidents and CEOs who paid a high price for low-quality video. Today, we can all watch 4K video and enjoy high-quality video calling all for free with devices in our pockets. Investors who ignored the technological shortcomings of early 2000s internet technology and ignored the skeptics who predicted that the internet was a fad were able to make life-changing gains from their investments. Investing in the metaverse niche today is basically like investing in internet companies in the 2000s. It's a highly experimental niche with hundreds of startups attempting to define what our new virtual future will look like. Most will fail due to being too ambitious or coming up with products that are so far ahead of their time that people simply aren't ready for them yet. Despite the failures, there will be metaverse projects that will become the next Apple or Google. These experimental projects will one day be products that everyone will use. Right now, it's so early that we can't say for sure who will be successful. It could be one of today's popular projects in the metaverse space, such as Sandbox, Decentraland, or Somnium Space, or it could be one of the new projects that isn't out yet. Investors who want to take advantage of this once-in-a-generation opportunity will need to do deep research and practice good risk management. Despite the risks and potential pitfalls, the potential upside of the space is one that must not be ignored, which is why every crypto investor should have at least one metaverse project in their long-term portfolio. Metaverse is the perfect home for DeFi, as unlike the real world, the metaverse can be crypto native with an economy that exists entirely on the blockchain. As the metaverse will have its own self-contained economy that runs in crypto, DeFi will be the driving force behind these economies and the transactions that people make in virtual worlds. DeFi will power in-game payments and rewards for players who achieve certain milestones. DeFi will power in-game NFTs and collectibles that can be moved from game to game and can be changed based on player achievements. Both the metaverse and DeFi are in their early stages right now, but in a few years it will become clear that DeFi is to the metaverse what PayPal is to online commerce. The difference is that the PayPal of the crypto space won't be one big company. There will be many different interoperable and decentralized services that will work together and empower people in these virtual worlds. As people spend more and more time in virtual spaces, DeFi will eventually become a seamless part of these spaces, and people will eventually interact with DeFi applications without even knowing it. Staking, or proof of stake, is a method that many cryptocurrencies use to validate transactions as well as to mint new currency units into existence. Not all cryptocurrencies use proof of stake. Cryptos such as Bitcoin and Ethereum currently use proof of work consensus methods in a process called mining, which validates transactions and brings new coins into existence. Ethereum aims to transition from proof of work to proof of stake, as this will enable faster, more efficient transactions on the network. There are many proof-of-stake cryptocurrencies. Some of the most popular include Polygon, Solana, and Avalanche. Proof-of-stake consensus processes transactions slightly differently to proof-of-work consensus methods. In proof-of-stake systems, validators process blocks which contain transactions, just as miners do in Bitcoin and other proof-of-work cryptocurrencies. The big difference between proof-of-stake and proof-of-work is that in a proof-of-stake system, validators gain the rights to validate transactions by setting aside a portion of their crypto holdings, which are locked up and kept out of circulation for a certain time period. Validators who stake their coins are chosen at random. The validator then validates transactions, which are then checked over by other validators to ensure authenticity. Validators who process genuine transactions are then rewarded for their efforts with new coins. There are many benefits to staking your crypto. By staking, you can become an active member of the coins community, as you will be contributing to the network, which can be quite rewarding. Staking can also be a source of passive income, as you can earn staking rewards on a daily basis. There are two main ways to stake your coins. You can become a validator by setting up a node on a spare computer at home or a cloud server, or you can loan or delegate your coins to someone else who will do the validation for you and pay you a share of the rewards in return for loaning your coins. This process is called delegated proof of stake. Most proof of stake cryptocurrencies allow users to do this, as it enables everyone to benefit from staking without the need for costly hardware or technical expertise. There are benefits and drawbacks to being a validator. One of the benefits is that you contribute to decentralization. Being a validator yourself is best for network decentralization, as networks with more validators are some of the most decentralized, which makes them more resistant to censorship. Another benefit is that you don't have to trust others. Validators who stake coins on other users' behalf have immense power. Most delegated proof-of-stake systems have methods in place that prevent delegators abusing their power, such as review systems, where delegators can see ratings which can help them to avoid dishonest validators. There is still a risk that you could lose some of your coins, which is one of the biggest drawbacks to being a delegator as opposed to validating yourself. One of the downsides to being a validator is that you need a high level of technical skill to run a node securely and effectively, especially if you intend to stake other people's coins on their behalf. In addition to technical skill, there is also a large cost to running a node, as it will need to run 24/7 and you'll need to invest in some form of protection against malicious users who try to flood the network with spam transactions in order to slow down your node. Due to the drawbacks associated with being a validator, most people prefer to be a delegator. If you are interested in staking, you will have to take into account your skills and access to resources when deciding whether you should be a validator yourself or to delegate your coins to someone who will do the staking for you. The upsides of being a delegator are that it's quick, easy, and cheap to set up. The whole process can take as little as 10 minutes. All you need are a laptop, a web browser, and a coin wallet. There's no need for expensive servers or the maintenance that comes with them. As we covered before, the biggest downside to being a delegator is that you will have to entrust your coins to someone else. Whilst most delegation platforms prevent outright theft of your coins by a validator, if the validator you choose is dishonest, then they will be punished by losing a percentage of the state's coins in order to disincentivize dishonest behavior. If you have delegated your coins to a dishonest validator who gets punished, then you will also lose a percentage of your coins. So this is how I work out what to stake and what kind of rewards I can get from staking. So I go on this website here, it's called stakingrewards.com. And what we're going to do is we're going to see what kind of rewards we can get from staking. So what you want to do is you want to look down here and you want to look at the crypto that you're interested in. So Atom is pretty cool crypto, so we'll go with that one because it's had a nice kind of price increase and the rewards are pretty good as well. So we'll click on that here. And what we want to do is we want to scroll down here to the calculator. So here we can see a number of things. You can calculate it in terms of USD, or we can calculate it in terms of Atom. And you can see the term, the staking term. So if we look at this, you've got 7 days all the way through to 10 years. 10 years is a ridiculous time to be staking anything. I mean, yeah, the gains could be good, but 10 years in the crypto space is like 100 years in the real world. Nobody knows if our Cosmos is still going to be around then. Hopefully it will, but yeah, 10 years is a long time. So we'll just choose 1 year. Okay, 1 year. And you can choose if you want to delegate Cosmos, if you want to run a validator node, if you want to lend Cosmos, and they all come up with different results. So let's choose delegate. And you can go with the current price. And then you can say that you want to compound your gains. So everything you stake, all of your staking rewards, you can choose whether you want to keep them and siphon them off and sell them, or you can choose to compound them and you'll get greater gains by doing that. And over here, you can see the results. So you can see the total reward rate over a year, it's annualized. And you can see total monthly earnings. You can see estimated yearly earnings. And, you can play around with this. So, if you have a bigger balance, say you've got $10,000 worth of Atom, then the earnings are obviously going to be bigger. And we can play around with this as well. This is pretty interesting. So if you're really, really bullish on the crypto that you intend to stake, say you think it's going to go to the moon, okay? So 1,000%. I mean, 1,000% is really not that much in crypto, but you know, they think it's moon, so we'll just go with that. So yeah, if you think it's going to go to the moon in a year and you have 10K's worth of Cosmos, I mean, those are the kind of returns that you could expect to see. So you can also look at the different validators, okay, that you can delegate to, and you can look at their different rewards and what kind of balances they have. So it's a really useful site overall for gauging staking rewards, and it's a really good kind of first stop when it comes to staking crypto. In this tutorial, we're going to learn about how you can add alternative networks to MetaMask. So when I say alternative networks, I mean stuff like Binance Smart Chain, like Phantom, like Avalanche. You can add these networks to MetaMask so that you can have it there in addition to Ethereum, which is the default network on MetaMask. So first of all, you want to go to the MetaMask website, metamask.io, and you scroll all the way down to support, and then you click on support. And this is the support site, and then you scroll all the way down again, and you click on network profiles. Now, you don't have to do this. You can go to the individual chain websites. You can go to Binance chain website or Polygon or Avalanche, and there will be details there that will tell you how you can add these networks to MetaMask. But I find this quite handy because it's all in one place. So let's say we want to add Binance Smart Chain. We click on Binance Smart Chain, and these are the details for Binance Smart Chain. So how do we get these details? How do we get these network details into MetaMask? Well, we click on MetaMask here, and then we click these three dots and expand view. And what that will do is it will just keep it open in a separate tab for us. So it's always open and nice and easy to use. Then we click on this circle and we click on settings, and then we click on networks. Now, these are the Ethereum network details. You want to leave those alone. We don't need to touch those. And we don't need to touch these either. These are test networks for developers. So we're not worried about that. We just want to click on add network, add a network. And then it's basically just copy and paste. So we copy and paste the network name into here, and a new RPC URL. We just simply copy and paste this RPC URL, paste it in there, get rid of some of the spaces. The chain ID is 56. You can either copy and paste or type 56. And the currency symbol is BNB. Just type that in. It will highlight orange because it can't verify it, but it's really nothing to worry about. It basically, any network that's not Ethereum, it won't be able to verify. But it's perfectly fine. It's just a ticker symbol. And then you want to add the block explorer. So for this, you right click on here and you click copy link, and then you paste the block explorer link into here. So what the block explorer is basically is if you want to, when you have a transaction that's progressing, if you want to check its progress, you can click on it and it will go to the block explorer and it will show you how it's progressing on the blockchain. So you click save, and now we have Binance Smart Chain, and you can see a little BNB logo on there. And if you want to select it, you just click this drop down menu and you click Binance Smart Chain, and you can do stuff on Binance Smart Chain, like you can go on PancakeSwap and all the other stuff on BSC. And if you want to go back to Ethereum, you simply click on Ethereum and you're back in Ethereum. And that's how you do it. And you can add all of these different networks, Binance Smart Chain, Polygon, Avalanche, Phantom, Harmony, anything you want. You can add it all into MetaMask and access all of these networks through the same wallet, through the same address. So it's really, really handy. In this tutorial, we are going to learn about how we can buy Ethereum tokens using Uniswap, the decentralized exchange. So this is the website you need to go on. It's app.uniswap.org. And then the first thing we need to do is unlock MetaMask. So I'm going to type the password in. Okay. MetaMask is unlocked. And now the next thing we need to do is click Connect Wallet to connect MetaMask to Uniswap. So that's done. I already did this before, so it's very quick. But if you're new to this, there's an extra confirmation that you need to do in MetaMask. So now that it's connected, there's two balances here. So there's an Ethereum balance and there's a USDC balance. Now I want to buy using USDC because I want to save the Ethereum for fees. So I click on USDC and I want to use the maximum amount. So I click max. If you don't want to use the maximum, you just type in whatever amount you want to use. Okay. And now I want to select the token that I want to buy. So the most common tokens, the most popular ones will all be here. You can just quickly find them. But if there is a token that is not so common, so something like a small cap or a microcap, then you will need to turn on one of these token lists. So the coin Marketcap token list, we can see here that it's got over 6,700 tokens. And the CoinGecko one has almost 4,900 tokens there. So you can click on these lists and they will expand the amount of tokens that you can buy, basically. But the token we want is quite a common, popular one, so we don't need to do that. So I'll just click on this and I'll type in the token I want, which is Mana Decentraland. So I click on that and it's now going to show how many I can buy. So with my 200 USDC, I can buy 243 Mana. And now I need to click on this, which will allow Uniswap to use my USDC. So I click on that. And this is the message. So I have to click on this to sign it. Then this basically grants Uniswap permission to use my USDC for this transaction. So I click sign. And I'm using my Ledger wallet. So I'm actually signing it on my Ledger wallet. This is the safest way to use MetaMask. But, if you're just using it on the app, then you just sign it on the app. So I have signed the message and you can now see the swap button is highlighted. So all I need to do is click swap. And this will show all of the details that I need to check just to confirm that everything's all good. So this is what I'm expecting to get, 243 Mana. Although sometimes there's slippage. So this could be the minimum. This is the minimum that I will receive. And then we can see the network fee. So it's going to cost $4.85 worth of Ethereum, which is pretty cheap compared to last year. I remember last year I was paying sometimes like $50 to do a Uniswap transaction. So it's pretty good at the moment. So basically we just click confirm. And then we need to confirm it again in here. This is going to show us the gas fee. So there is a gas fee in addition to the Uniswap fee. And this gas fee is not too bad. And then click confirm. And I'll need to confirm it in my ledger as well. Okay, transaction submitted. And that's basically it. So I'll just close this. And we can see it's pending and it's already done. Okay, so now I have 243 Mana and we can see the balance is reflected there. So if we go up to here in assets, it doesn't show. Now that's not something that we should be worried about. The Mana is there, but what you'll need to do is sometimes refreshing the list works. Okay, so refreshing the list has shown it there for us. If that doesn't work, if you're buying a token that's more of an obscure token, so something like a small cap or a micro cap, then you'll need to click on import tokens, and you can either search for this directly by just typing the name in, or you can enter in the token contract. And the way you enter the token contract is you'll go to a website like Etherscan. So we'll do that right now. So we'll see how we can do that. So we'll just type Etherscan into Google. And let's search for mana. Okay. So this is the token contract. So basically we want to copy these details here into MetaMask. So we'll open MetaMask, we'll expand it so it's always there for us. And we don't actually need to do this, but this is the process you need to do if your token doesn't show up. So we'll paste the contract address in. It says it's already been added. Okay, let's just add a different one so we can see how to do it. We're going to add synthetics. So what you need to do is copy this address, paste it there, and it just comes up with the rest. It says SNX and 18. If it doesn't do that, because synthetics is quite a popular one, so it's just populated it by itself. If it doesn't, you'll just need to type in those details there, and you're basically just copying this, the decimal, and you just type in SNX. So if we add custom token, it will show up and we don't have a balance of SNX. So yeah, that's basically it. We now have 0 USDC and 243 mana. And that's how you buy tokens on Uniswap. In this tutorial, we're going to buy Binance Smart Chain tokens on PancakeSwap, the decentralized exchange that runs on Binance Smart Chain. Now, the first thing we're going to do is we're going to make sure that our network is on Binance Smart Chain. And if you don't know how to add additional custom networks to MetaMask, check out the tutorial on that. So what we do is we click down this and then we click Smart Chain. So we're now on Binance Smart Chain and we can see that we have some BNB on there. So what we need to do now is we need to connect our wallet. So we click connect, we click MetaMask, and then we select the address we want. So I want this address here, which has some BNB in it. And then I click next and I click connect. Okay, so that's all connected now. So now what we want to do is we want to click on trade and we want to click swap. And what I want to do is I have some BUSD on here. So I want to click on this. And we can see the BUSD I have on here. I've got 200 BUSD. So I want to click on this. And the token I will buy is, let's buy some pancake. We might as well. And I'm going to spend 200 BUSD on pancake. And that will get me 67.7 pancake. So yeah, I'll click enable. And I just have to give PancakeSwap permission to access my BUSD. So I click confirm. And I'll need to confirm that in my ledger because I'm securing my MetaMask account with my ledger, which is the correct and it should be the only way to do it really. Okay, that's done. So I just got to wait for this to be enabled. Shouldn't take too long. Okay, it's done. And now I can press swap. I confirm it here. And then I need to confirm it in MetaMask. And we can see that there's this fee, which is like next to nothing basically. That's the really good thing about Binance Smart Chain. Very, very low fees. And then I need to confirm it in my ledger again. So I'm just doing that now. Okay. And the transaction's been submitted. And now we have this menu here. So this is really useful, especially for small caps and micro caps on Binance Smart Chain. You want to click this so it's added to your balances. So you click on this. And then it will add cake to my list of tokens. and we press close. And now if I look in my assets, I can see the cake there. Okay. If I didn't do that, if I didn't add it, I would have to manually import it. And the way you do that is you go on here and then you go into a website like BSC Scan. So we'll do that now. And then you just search for it. So we'd search for like pancake. And we basically enter these details here. So the contract, the decimal, and we would enter all of that in here. I'll just bring it up here. Import tokens. So you'd enter all of that information in here. But we don't need to do that because it's already there. So yeah, that's how you buy tokens on PancakeSwap. You did it. Well done. Congratulations for completing this course. The time you've dedicated towards focused trading and investing education puts you ahead of 99% of crypto investors. There are many pitfalls on the road to profitability, but as with anything worth pursuing in life, perseverance really pays off. The journey of a crypto investor can be quite challenging at times, as the highs and lows of the market can make the path to profitability just as volatile as any crypto chart. I hope that this course will help make your journey to success a little less volatile, as you continue on your own unique path towards being a consistently profitable crypto trader and investor. If you'd like to stay updated with everything that's going on in the crypto space and continue your crypto education, please check out my Linktree where you'll find links to all my social media pages. Thank you for taking the time and effort to complete this course. I wish you great success as you continue on your crypto journey.